The Intelligent Investor. Benjamin Graham. Through chances various, through all vicissitudes, we make our way. Aeneid. Preface to the 4th edition, by Warren E. Buffett. I read the first edition of this book early in 1950, when I was 19. I thought then that it was by far the best book about investing ever written. I still think it is. To invest successfully over a lifetime does not require a stratospheric IQ, unusual business insights, or inside information. What's needed is a sound intellectual framework for making decisions and the ability to keep emotions from corroding that framework. This book precisely and clearly prescribes the proper framework. You must supply the emotional discipline. If you follow the behavioral and business principles that Graham advocates, and if you pay special attention to the invaluable advice in chapters 8 and 20a, you will not get a poor result from your investments. That represents more of an accomplishment than you might think. Whether you achieve outstanding results will depend on the effort and intellect you apply to your investments, as well as on the amplitudes of stock market folly that prevail during your investing career. The sillier the market's behavior, the greater the opportunity for the business-like investor. Follow Graham and you will profit from folly rather than participate in it. To me, Ben Graham was far more than an author or a teacher. More than any other man except my father, he influenced my life. Shortly after Ben's death in 1976, I wrote the following short remembrance about him in the Financial Analyst's Journal. As you read the book, I believe you'll perceive some of the qualities I mentioned in this tribute. Benjamin Graham. 1894A 1976. Several years ago Ben Graham, then almost 80, expressed to a friend the thought that he hoped every day to do something foolish, something creative and something generous. The inclusion of that first whimsical goal reflected his knack for packaging ideas in a form that avoided any overtones of sermonizing or self-importance. Although his ideas were powerful, their delivery was unfailingly gentle. Readers of this magazine need no elaboration of his achievements as measured by the standard of creativity. It is rare that the founder of a discipline does not find his work eclipsed in rather short order by successors. But over 40 years after publication of the book that brought structure and logic to a disorderly and confused activity, it is difficult to think of possible candidates for even the runner-up position in the field of security analysis, in an area where much looks foolish within weeks or months. After publication, Ben's principles have remained sound to their value, often enhanced and better understood in the wake of financial storms that demolished flimsier intellectual structures. His counsel of soundness brought unfailing rewards to his followers, even to those with natural abilities inferior to more gifted practitioners who stumbled while following counsels of brilliance or fashion. A remarkable aspect of Ben's dominance of his professional field was that he achieved it without that narrowness of mental activity that concentrates all effort on a single end. It was, rather, the incidental byproduct of an intellect whose breadth almost exceeded definition. Certainly I have never met anyone with a mind of similar scope, virtually total recall, unending fascination with new knowledge, and an ability to recast it in a form applicable to seemingly unrelated problems made exposure to his thinking in any field a delight. But his third imperative, generosity, was where he succeeded beyond all others. I knew Ben as my teacher, my employer, and my friend. In each relationship, just as with all his students, employees, and friends, there was an absolutely open-ended, no scores kept generosity of ideas, time, and spirit. If clarity of thinking was required, there was no better place to go. And if encouragement or counsel was needed, Ben was there. Walter Lippmann spoke of men who plant trees that other men will sit under. Ben Graham was such a man. Reprinted from the Financial Analyst's Journal, November/December 1976. A Note about Benjamin Graham. By Jason Zweig. Who was Benjamin Graham, and why should you listen to him? Graham was not only one of the best investors who ever lived, he was also the greatest practical investment thinker of all time. Before Graham, money managers behaved much like a medieval guild, guided largely by superstition, guesswork, and arcane rituals. Graham's Security Analysis was the textbook that transformed this musty circle into a modern profession. Point 1. And The Intelligent Investor is the first book ever to describe, for individual investors, the emotional framework and analytical tools that are essential to financial success. It remains the single best book on investing ever written for the general public. The Intelligent Investor was the first book I read when I joined Forbes magazine as a cub reporter in 1987, and I was struck by Graham's certainty that, sooner or later, all bull markets must end badly. That October, U.S. stocks suffered their worst one-day crash in history, and I was hooked. Today, after the wild bull market of the late 1990s and the brutal bear market that began in early 2000, The Intelligent Investor reads more prophetically than ever. Graham came by his insights the hard way, by feeling firsthand the anguish of financial loss and by studying for decades the history and psychology of the markets. He was born Benjamin Grossbaum on May 9, 1894, in London. His father was a dealer in china dishes and figurines. Point 2. The family moved to New York when Ben was a year old. At first they lived the good life with a maid, a cook, and a French governess on Upper Fifth Avenue. But Ben's father died in 1903, the porcelain business faltered, and the family slid haltingly into poverty. Ben's mother turned their home into a boarding house, then, borrowing money to trade stocks on margin, she was wiped out in the crash of 1907. For the rest of his life, Ben would recall the humiliation of cashing a check for his mother and hearing the bank teller ask, "Is Dorothy Grossbaum good for $5? Fortunately, Graham won a scholarship at Columbia, where his brilliance burst into full flower. He graduated in 1914, second in his class. Before the end of Graham's final semester, 3 departments, English, philosophy, and mathematics, asked him to join the faculty. He was all of 20 years old. Instead of academia, Graham decided to give Wall Street a shot. He started as a clerk at a bond trading firm, soon became an analyst, then a partner, and before long was running his own investment partnership. The internet boom and bust would not have surprised Graham. In April 1919, he earned a 250% return on the first day of trading for Save Old Tire, a new offering in the booming automotive business. By October, the company had been exposed as a fraud and the stock was worthless. Graham became a master at researching stocks in microscopic, almost molecular, detail. In 1925, plowing through the obscure reports filed by oil pipelines with the U.S. Interstate Commerce Commission, he learned that Northern Pipeline Co. then trading at $65 per share held at least $80 per share in high-quality bonds. He bought the stock, pestered its managers into raising the dividend, and came away with $110 per share 3 years later. Despite a harrowing loss of nearly 70% during the Great Crash of 1929–1932, Graham survived and thrived in its aftermath, harvesting bargains from the wreckage of the bull market. There is no exact record of Graham's earliest returns, but from 1936 until he retired in 1956, his Graham-Newman Corp gained at least 14.7% annually. versus 12.2% for the stock market as a whole, one of the best long-term track records on Wall Street history. Graham-Newman Corp. was an open-end mutual fund, see Chapter 9. That Graham ran in partnership with Jerome Newman, a skilled investor in his own right. For much of its history, the fund was closed to new investors. How did Graham do it? Combining his extraordinary intellectual powers with profound common sense and vast experience, Graham developed his core principles, which are at least as valid today as they were during his lifetime. A stock is not just a ticker symbol or an electronic blip, it is an ownership interest in an actual business, with an underlying value that does not depend on its share price. The market is a pendulum that forever swings between unsustainable optimism, which makes stocks too expensive, and unjustified pessimism, which makes them too cheap. The intelligent investor is a realist who sells to optimists and buys from pessimists. The future value of every investment is a function of its present price. The higher the price you pay, the lower your return will be. No matter how careful you are, the one risk no investor can ever eliminate is the risk of being wrong. Only by insisting on what Graham called the margin of safety, never overpaying, no matter how exciting an investment seems to be, can you minimize your odds of error. The secret to your financial success is inside yourself. If you become a critical thinker who takes no Wall Street fact on faith, and you invest with patient confidence, you can take steady advantage of even the worst bear markets. By developing your discipline and courage, you can refuse to let other people's mood swings govern your financial destiny. In the end, how your investments behave is much less important than how you behave. The goal of this revised edition of The Intelligent Investor is to apply Graham's ideas to today's financial markets while leaving his text entirely intact, with the exception of footnotes for clarification. Point 4. After each of Graham's chapters you'll find a new commentary. In these reader's guides, I've added recent examples that should show you just how relevant and how liberating Graham's principles remain today. Grateful to Walter Schloss for providing data essential to estimating Graham Newman's returns. The 20% annual average return that Graham cites in his postscript, p. 532, appears not to take management fees into account. I envy you the excitement and enlightenment of reading Graham's masterpiece for the first time or even the third or fourth time. Like all classics, it alters how we view the world and renews itself by educating us. And the more you read it, the better it gets. With Graham as your guide, you are guaranteed to become a vastly more intelligent investor. Introduction. What this book expects to accomplish. The purpose of this book is to supply, in a form suitable for laymen, guidance in the adoption and execution of an investment policy. Comparatively little will be said here about the technique of analyzing securities. Attention will be paid chiefly to investment principles and investors' attitudes. We shall, however, provide a number of condensed comparisons of specific securities, chiefly in pairs appearing side by side in the New York Stock Exchange lista, in order to bring home in concrete fashion the important elements involved in specific choices of common stocks. But much of our space will be devoted to the historical patterns of financial markets, in some cases running back over many decades. To invest intelligently in securities, one should be forearmed with an adequate knowledge of how the various types of bonds and stocks have actually behaved under varying conditions, some of which, at least, one is likely to meet again in one's own experience. No statement is more true and better applicable to Wall Street than the famous warning of Santayana: those who do not remember the past are condemned to repeat it. Our text is directed to investors as distinguished from speculators, and our first task will be to clarify and emphasize this now all but forgotten distinction. We may say at the outset that this is not a how to make a million book. There are no sure and easy paths to riches on Wall Street or anywhere else. It may be well to point up what we have just said by a bit of financial history, especially since there is more than one moral to be drawn from it. In the climactic year 1929, John J. Raskob, a most important figure nationally, as well as on Wall Street, extolled the blessings of capitalism in an article in the Ladies' Home Journal, entitled "Everybody Ought to Be Rich." His thesis was that savings of only $15 per month invested in good common stocks with dividends reinvested would produce an estate of $80,000 in 20 years against total contributions of only $3,600. If the General Motors tycoon was right, this was indeed a simple road to riches. How nearly right was he? R. Rough calculation based on assumed investment in the 30 stocks making up the Dow Jones Industrial Average, DJIA, indicates that if Raskob's prescription had been followed during 1929-1948, the investor's holdings at the beginning of 1949 would have been worth about $8,500. This is a far cry from the great man's promise of $80,000, and it shows how little reliance can be placed on such optimistic forecasts and assurances. But, as an aside, we should remark that the return actually realized by the 20-year operation would have been better than 8% compounded annually, and this despite the fact that the investor would have begun his purchases with the DJIA at 300 and ended with a valuation based on the 1948 closing level of 177. This record may be regarded as a persuasive argument for the principle of regular monthly purchases of strong common stocks through thick and thin, a program known as dollar cost averaging. Since our book is not addressed to speculators, it is not meant for those who trade in the market. Most of these people are guided by charts or other largely mechanical means of determining the right moments to buy and sell. The one principle that applies to nearly all these so-called technical approaches is that one should buy because a stock or the market has gone up, and one should sell because it has declined. This is the exact opposite of sound business sense everywhere else, and it is most unlikely that it can lead to. Raskob, 1879-1950, was a director of DuPont, the giant chemical company, and chairman of the finance committee at General Motors. He also served as national chairman of the Democratic Party and was the driving force behind the construction of the Empire State Building. Calculations by finance professor Jeremy Siegel confirm that Raskob's plan would have grown to just under $9,000 after 20 years, although inflation would have eaten away much of that gain. For the best recent look at Raskob's views on long-term stock investing, see the essay by financial advisor William Bernstein at www.efficientfrontier.com. Lasting success on Wall Street. In our own stock market experience and observation, extending over 50 years, we have not known a single person who has consistently or lastingly made money by thus following the market. We do not hesitate to declare that this approach is as fallacious as it is popular. We shall illustrate what we have just said, though, of course this should not be taken as proof by a later brief discussion of the famous Dow theory for trading in the stock market *. Since its first publication in 1949, revisions of the Intelligent Investor have appeared at intervals of approximately 5 years. In updating the current version, we shall have to deal with quite a number of new developments since the 1965 edition was written. These include an unprecedented advance in the interest rate on high-grade bonds. A fall of about 35% in the price level of leading common stocks, ending in May 1970. This was the highest percentage decline in some 30 years. Countless issues of lower quality had a much larger shrinkage. A persistent inflation of wholesale and consumers' prices, which gained momentum even in the face of a decline of general business in 1970. The rapid development of conglomerate companies, franchise operations, and other relative novelties in business and finance. These include a number of tricky devices such as letter stock, one proliferation of stock option warrants, misleading names, use of foreign banks, and others. Introduction. Bankruptcy of our largest railroad, excessive short and long-term debt of many formerly strongly entrenched companies, and even a disturbing problem of solvency among Wall Street houses. The advent of the performance vogue in the management of investment funds, including some bank-operated trust funds, with disquieting results. These phenomena will have our careful consideration, and some will require changes in conclusions and emphasis from our previous edition. The underlying principles of sound investment should not alter from decade to decade, but the application of these principles must be adapted to significant changes in the financial mechanisms and climate. The last statement was put to the test during the writing of the present edition, the first draft of which was finished in January 1971. At that time the DJIA was in a strong recovery from its 1970 low of 632 and was advancing toward a 1971 high of 951, with attendant general optimism. As the last draft was finished, in November 1971, the market was in the throes of a new decline, carrying it down to 797 with a renewed general uneasiness about its future. We have not allowed these fluctuations to affect our general attitude towards sound investment policy, which remains substantially unchanged since the first edition of this book in 1949. The extent of the market's shrinkage in 1969-70 should have served to dispel an illusion that had been gaining ground during the past 2 decades. This was that leading common stocks could be bought at any time and at any price, with the assurance not only of ultimate profit but also that any intervening loss would soon be recouped by a renewed advance of the market to new high lef. The Penn Central Transportation Co., then the biggest railroad in the United States, sought bankruptcy protection on June 21, 1970. A shocking. Investors, who had never expected such a giant company to go under, c. p. 423. Among the companies with excessive debt Graham had in mind were Temco Vought and National General Corp., see pages 425 and 463. The problem of solvency on Wall Street emerged between 1968 and 1971, when several prestigious brokerages suddenly went bust. Else, that was too good to be true. At long last the stock market has returned to normal, in the sense that both speculators and stock investors must again be prepared to experience significant and perhaps protracted falls as well as rises in the value of their holdings. In the area of many secondary and third-line common stocks, especially recently floated enterprises, the havoc wrought by the last market break was catastrophic. This was nothing new in itself. It had happened to a similar degree in 1961-62, but there was now a novel element in the fact that some of the investment funds had large commitments in highly speculative and obviously overvalued issues of this type. Evidently it is not only the tyro who needs to be warned that while enthusiasm may be necessary for great accomplishments elsewhere, on Wall Street it almost invariably leads to disaster. The major question we shall have to deal with grows out of the huge rise in the rate of interest on first-quality bonds. Since late 1967, the investor has been able to obtain more than twice as much income from such bonds as he could from dividends on representative common stocks. At the beginning of 1972 the return was 7.19% on highest grade bonds versus only 2.76% on industrial stocks. This compares with 4.40% and 2.92% respectively at the end of 1964. It is hard to realize that when we first wrote this book in 1949, the figures were almost the exact opposite. The bonds returned only 2.66% and the stocks yielded 6.82%. In previous editions we have consistently urged that at least 25% of the conservative investors' portfolio be held in common stocks, and we have favored in general a 50-50 division between the two media. We must now consider whether the current great advantage of bond yields over stock yields would justify an all-bond policy until a more sensible relationship returns, as we expect it will. Naturally, the question of continued inflation will be of great importance in reaching our decision. Here, a chapter will be devoted to this discussion. See Chapter 2. As of the beginning of 2003, U.S. Treasury bonds maturing in 10 years yielded 3.8%, while stocks, as measured by the Dow Jones Industrial Average, yielded 1.9%. Note that this relationship is not all that different from the 1964 figures that Graham cites. The income generated by top-quality bonds has been falling steadily since 1981. Introduction. In the past we have made a basic distinction between two kinds of investors to whom this book was addressed: the defensive and the enterprising. The defensive, or passive, investor will place his chief emphasis on the avoidance of serious mistakes or losses. His second aim will be freedom from effort, annoyance, and the need for making frequent decisions. The determining trait of the enterprising, or active, or aggressive, investor is his willingness to devote time and care to the selection of securities that are both sound and more attractive than the average. Over many decades, an enterprising investor of this sort could expect a worthwhile reward for his extra skill and effort, in the form of a better average return than that realized by the passive investor. We have some doubt whether a really substantial extra recompense is promised to the active investor under today's conditions. But next year or the years after may well be different. We shall accordingly continue to devote attention to the possibilities for enterprising investment, as they existed in former periods and may return. It has long been the prevalent view that the art of successful investment lies first in the choice of those industries that are most likely to grow in the future, and then in identifying the most promising companies in these industries. For example, smart investors or their smart advisors would long ago have recognized the great growth possibilities of the computer industry as a whole, and of international business machines in particular. And similarly for a number of other growth industries and growth companies. But this is not as easy as it always looks in retrospect. To bring this point home at the outset, let us add here a paragraph that we included first in the 1949 edition of this book. Such an investor may, for example, be a buyer of air transport stocks because he believes their future is even more brilliant than the trend the market already reflects. For this class of investor, the value of our book will lie more in its warnings against the pitfalls lurking in this favorite investment approach than in any positive technique that will help him along his path. Air transport stocks, of course, generated as much excitement in the late 1940s and early 1950s as internet stocks did a half-century later. Among the hottest mutual funds of that era were aeronautical securities, and the pitfalls have proved particularly dangerous in the industry we mentioned. It was, Of course, easy to forecast that the volume of air traffic would grow spectacularly over the years. Because of this factor, their shares became a favorite choice of the investment funds. But despite the expansion of revenue ESA at a pace even greater than in the computer industry, a combination of technological problems and overexpansion of capacity made for fluctuating and even disastrous profit figures. In the year 1970, despite a new high in traffic figures, the airline sustained a loss of some $200 million for their shareholders. They had shown losses also in 1945 and 1961. The stocks of these companies once again showed a greater decline in 1969-70 than did the general market. The record shows that even the highly paid full-time experts of the mutual funds were completely wrong about the fairly short-term future of a major and non-esoteric industry. On the other hand, while the investment funds had substantial investments and substantial gains in IBM, the combination of its apparently high price and the impossibility of being certain about its rate of growth prevented them from having more than, say, 3% of their funds in this wonderful performer. Hence the effect of this excellent choice on their overall results was by no means decisive. Furthermore, many if not most of their investments in computer industry companies other than IBM appear to have been unprofitable. From these two broad examples we draw two morals for our readers. Obvious prospects for physical growth in a business do not translate into obvious profits for investors. The experts do not have dependable ways of selecting and concentrating on the most promising companies in the most promising industries. Missiles, rockets, jets, and automation fund. They, like the stocks they owned, turned out to be an investing disaster. It is commonly accepted today that the cumulative earnings of the airline industry over its entire history have been negative. The lesson Graham is driving at is not that you should avoid buying airline stocks, but that you should never succumb to the certainty that any industry will outperform all others in the future. Introduction. The author did not follow this approach in his financial career as fund manager, and he cannot offer either specific counsel or much encouragement to those who may wish to try it. What then will we aim to accomplish in this book? Our main objective will be to guide the reader against the areas of possible substantial error and to develop policies with which he will be comfortable. We shall say quite a bit about the psychology of investors. For indeed, the investor's chief problem and even his worst enemy is likely to be himself. The fault, dear investor, is not in our stars and not in our stocks but in ourselves. This has proved the more true over recent decades as it has become more necessary for conservative investors to acquire common stocks and thus to expose themselves, willy-nilly, to the excitement and the temptations of the stock market. By arguments, examples, and exhortation, we hope to aid our readers to establish the proper mental and emotional attitudes toward their investment decisions. We have seen much more money made and kept by ordinary people who were temperamentally well suited for the investment process than by those who lacked this quality, even though they had an extensive knowledge of finance, accounting, and stock market lore. Additionally, we hope to implant in the reader a tendency to measure or quantify. For 99 issues out of 100 we could say that at some price they are cheap enough to buy and at some other price they would be so dear that they should be sold. The habit of relating what is paid to what is being offered is an invaluable trait in investment. In an article in a women's magazine many years ago, we advised the readers to buy their stocks as they bought their groceries, not as they bought their perfume. The really dreadful losses of the past few years, and on many similar occasions before, were realized in those common stock issues where the buyer forgot to ask how much. In June 1970, the question how much could be answered by the magic figure 9.40%, the yield obtainable on new offerings of high-grade public utility bonds. This has now dropped to about 7.3%, but even that return tempts us to ask, why give any other answer? But there are other possible answers, and these must be carefully considered. Besides which, we repeat that both we and our readers must be prepared in advance for the possibly quite different conditions of, say, 1973A 1977. We shall therefore present in some detail a positive program for common stock investment, part of which is within the purview of both classes of investors and part is intended mainly for the enterprising group. Strangely enough, we shall suggest as one of our chief requirements here that our readers limit themselves to issues selling not far above their tangible asset value. The reason for this seemingly outmoded counsel is both practical and psychological. Experience has taught us that, while there are many good growth companies worth several times net assets, the buyer of such shares will be too dependent on the vagaries and fluctuations of the stock market. By contrast, the investor in shares, say, of public utility companies at about their net asset value can always consider himself the owner of an interest in sound and expanding businesses, acquired at a rational price regardless of what the stock market might say to the contrary. The ultimate result of such a conservative policy is likely to work out better than exciting adventures into the glamorous and dangerous fields of anticipated growth. The art of investment has one characteristic that is not generally appreciated. A creditable, if unspectacular, result can be achieved by the lay investor with a minimum of effort and capability, but to improve this easily attainable standard requires much application, and more than a trace of wisdom. If you merely try to bring just a little extra knowledge and cleverness to bear upon your investment program, instead of realizing a little better than normal results, you may well find that you have done worse. Since anyone by just buying and holding a representative list can equal the performance of the market averages, it would seem a comparatively simple matter to beat the averages, but as a matter of fact the proportion of smart people who try this and fail is surprisingly large. Even the majority of the investment funds, with all their experienced personnel, have not performed so well. Tangible assets include a company's physical property, like real estate, factories, equipment, and inventories, as well as its financial balances, such as cash, short-term investments, and accounts receivable. Among the elements not included in tangible assets are brands, copyrights, patents, franchises, goodwill, and trademarks. To see how to calculate tangible asset value, see footnote on p. 198. Introduction. Over the years, as has the general market, allied to the foregoing is the record of the published stock market predictions of the brokerage houses, for there is strong evidence that their calculated forecasts have been somewhat less reliable than the simple tossing of a coin. In writing this book we have tried to keep this basic pitfall of investment in mind. The virtues of a simple portfolio policy have been emphasized to the purchase of high-grade bonds plus a diversified list of leading common stocks of which any investor can carry out with a little expert assistance. The adventure beyond the safe and sound territory has been presented as fraught with challenging difficulties, especially in the area of temperament. Before attempting such a venture, the investor should feel sure of himself and of his advisor, so particularly as to whether they have a clear concept of the differences between investment and speculation and between market price and underlying value. A strong-minded approach to investment, firmly based on the margin of safety principle, can yield handsome rewards. But a decision to try for these emoluments rather than for the assured fruits of defensive investment should not be made without much self-examination. A final retrospective thought. When the young author entered Wall Street in June 1914, no one had any inkling of what the next half-century had in store. The stock market did not even suspect that a world war was to break out in 2 months, and close down the New York Stock Exchange. Now, in 1972, we find ourselves the richest and most powerful country on earth, but beset by all sorts of major problems and more apprehensive than confident of the future. Yet if we confine our attention to American investment experience, there is some comfort to be gleaned from the last 57 years. Through all their vicissitudes and casualties, as earth-shaking as they were unforeseen, it remained true that sound investment principles produce generally sound results. We must act on the assumption that they will continue to do so. Note to the reader, this book does not address itself to the overall financial policy of savers and investors, it deals only with that portion of their funds which they are prepared to place in marketable, or redeemable, securities, that is, in bonds and stocks. Consequently, we do not discuss such important media as savings and time deposits, savings and loan association accounts, life insurance, annuities, and real estate mortgages or equity ownership. The reader should bear in mind that when he finds the word now, or the equivalent, in the text, it refers to late 1971 or early 1972. Commentary on the introduction. If you have built castles in the air, your work need not be lost. That is where they should be. Now put the foundations under them. A. Henry David Thoreau, Walden. Notice that Graham announces from the start that this book will not tell you how to beat the market. No truthful book can. Instead, this book will teach you 3 powerful lessons. How you can minimize the odds of suffering irreversible losses. How you can maximize the chances of achieving sustainable gains. How you can control the self-defeating behavior that keeps most investors from reaching their full potential. Back in the boom years of the late 1990s, when technology stocks seemed to be doubling in value every day, the notion that you could lose almost all your money seemed absurd. But, by the end of 2002, many of the dot-com and telecom stocks had lost 95% of their value, or more. Once you lose 95% of your money, you have to gain 1,900%. Just to get back to where you started. Point 1. Taking a foolish risk can put you so deep in the hole that it's virtually impossible to get out. That's why Graham constantly emphasizes the importance of avoiding losses, and not just in chapters 6, 14, and 20, but in the threads of warning that he has woven throughout his entire text. But no matter how careful you are, the price of your investments will go down from time to time, while no one can eliminate that risk. To put this statement in perspective, consider how often you are likely to buy a stock at $30 and be able to sell it at $600. Commentary on the introduction. Graham will show you how to manage ETA and how to get your fears under control. Are you an intelligent investor? Now let's answer a vitally important question. What exactly does Graham mean by an intelligent investor? Back in the first edition of this book, Graham defines the term, and he makes it clear that this kind of intelligence has nothing to do with IQ or SAT scores. It simply means being patient, disciplined, and eager to learn. You must also be able to harness your emotions and think for yourself. This kind of intelligence, explains Graham, is a trait more of the character than of the brain. 2. There's proof that high IQ and higher education are not enough to make an investor intelligent. In 1998, Long-Term Capital Management LP, a hedge fund run by a battalion of mathematicians, computer scientists, and two Nobel Prize-winning economists, lost more than $2 billion in a matter of weeks on a huge bet that the bond market would return to normal. But the bond market kept right on becoming more and more abnormal, and LTCM had borrowed so much money that its collapse nearly capsized the global financial system. Point 3. And back in the spring of 1720, Sir Isaac Newton owned shares in the South Sea Company, the hottest stock in England. Sensing that the market was getting out of hand, the great physicist muttered that he could calculate the motions of the heavenly bodies, but not the madness of the people. Newton dumped his South Sea shares, pocketing a 100% profit totaling £7,000. But just months later, swept up in the wild enthusiasm of the market, Newton jumped back in at a much higher price and lost £2,000, or more than $3 million in today's money. For the rest of his life, he forbade anyone to speak the words South Sea in his presence. Benjamin Graham, The Intelligent Investor, Harper & Row, 1949, p. 4. A hedge fund is a pool of money, largely unregulated by the government, invested aggressively for wealthy clients. For a superb telling of the LTCM story, see Roger Lowenstein, When Genius Failed, Random House, 2000. John Carswell, The South Sea Bubble, Cresset Press, London, 1960. Pages 131, 199. Commentary on the Introduction. Sir Isaac Newton was one of the most intelligent people who ever lived, as most of us would define intelligence. But, in Graham's terms, Newton was far from an intelligent investor. By letting the roar of the crowd override his own judgment, the world's greatest scientist acted like a fool. In short, if you've failed at investing so far, it's not because you're stupid. It's because, like Sir Isaac Newton, you haven't developed the emotional discipline that successful investing requires. In Chapter 8, Graham describes how to enhance your intelligence by harnessing your emotions and refusing to stoop to the market's level of irrationality. There you can master his lesson that being an intelligent investor is more a matter of character than brain. A Chronicle of Calamity. Now let's take a moment to look at some of the major financial developments of the past few years. The worst market crash since the Great Depression, with U.S. stocks losing 50.2% of their value, or $7.40 trillion between March 2000 and October 2002. Far deeper drops in the share prices of the hottest companies of the 1990s, including AOL, Cisco, JDS Uniphase, Lucent, and Qualcomm, plus the utter destruction of hundreds of Internet stocks. Accusations of massive financial fraud at some of the largest and most respected corporations in America, including Enron, Tyco, and Xerox. The bankruptcies of such once glistening companies as Conseco, Global Crossing, and WorldCom. Allegations that accounting firms cooked the books, and even destroyed records, to help their clients mislead the investing public. Charges that top executives at leading companies siphoned off hundreds of millions of dollars for their own personal gain. Proof that security analysts on Wall Street praised stocks publicly, but admitted privately that they were garbage. A stock market that, even after its blood-curdling decline, seems overvalued by historical measures, suggesting to many experts that stocks have further yet to fall. Commentary on the Introduction. 9. A relentless decline in interest rates that has left investors with no Attractive alternative to stocks. 10. An investing environment bristling with the unpredictable menace of global terrorism and war in the Middle East. Much of this damage could have been, and was, avoided by investors who learned and lived by Graham's principles. As Graham puts it, while enthusiasm may be necessary for great accomplishments elsewhere, on Wall Street it almost invariably leads to disaster. By letting themselves get carried away on internet stocks, on big growth stocks, on stocks as a whole, many people made the same stupid mistakes as Sir Isaac Newton. They let other investors' judgments determine their own. They ignored Graham's warning that the really dreadful losses always occur after the buyer forgot to ask how much. Most painfully of all, by losing their self-control just when they needed it the most. These people proved Graham's assertion that the investor's chief problem and even his worst enemy is likely to be himself. The sure thing that wasn't he. Many of those people got especially carried away on technology and internet stocks, believing the high-tech hype that this industry would keep outgrowing every other for years to come, if not forever. In mid-1999, after earning a 117.3% return in just the first 5 months of the year, Monument Internet Fund portfolio manager Alexander Chung predicted that his fund would gain 50% a year over the next 3 to 5 years and an annual average of 35% over the next 20 years. Constance Loizos, Q&A, Alex Chung, Investment News, May 17, 1999. p. 38. The highest 20-year return in mutual fund history was 25.8% per year, achieved by the legendary Peter Lynch of Fidelity Magellan over the 2 decades ending December 31, 1994. Lynch's performance turned $10,000 into more than $982,000 in 20 years. Chung was predicting that his fund would turn $10,000 into more than $4 million over the same length of time. Instead of regarding Chung as ridiculously over-optimistic, investors threw commentary on the introduction. After his Amerindo Technology Fund rose an incredible 248.9%. In 1999, portfolio manager Alberto Villar ridiculed anyone who dared to doubt that the internet was a perpetual money-making machine. If you're out of this sector, you're going to underperform. You're in a horse and buggy, and I'm in a Porsche. You don't like tenfold growth opportunities? Then go with someone else. 6. In February 2000, hedge fund manager James J. Cramer proclaimed that internet-related companies are the only ones worth owning right now. These winners of the new world, as he called them, are the only ones that are going higher consistently in good days and bad. Cramer even took a pot shot at Graham. You have to throw out all of the matrices and formulas and texts that existed before the web. If we used any of what Graham and Dodd teach us, we wouldn't have a dime under management. 7. All these so-called experts ignored Graham's sober words of warning: obvious prospects for physical growth in a business do not translate into obvious profits for investors. While it seems easy to foresee which industry will grow the fastest, that foresight has no real value if most other investors are already expecting the same thing. By the time everyone decides that a given industry is obviously the best money at him, flinging more than $100 million into his fund over the next year. A $10,000 investment in the Monument Internet Fund in May 1999 would have shrunk to roughly $2,000 by year-end 2002. The Monument Fund no longer exists in its original form and is now known as Orbitex Emerging Technology Fund. Lisa Riley Cullen, The Triple-Digit Club, Money, December, 1999, p. 170. If you had invested $10,000 in Villar's fund at the end of 1999, you would have finished 2002 with just $1,195 left, one of the worst destructions of wealth in the history of the mutual fund industry. See www.thestreet.com/fund/smarter/89182.html. Kramer's favorite stocks did not go higher consistently in good days and bad. By year-end 2002, one of the 10 had already gone bankrupt, and a $10,000 investment spread equally across Kramer's picks would have lost 94%, leaving you with a grand total of $597.44. Perhaps Kramer meant that his stocks would be winners not in the new world, but in the world to come. Commentary on the introduction. 1. To invest in, the prices of its stocks have been bid up so high that its future returns have nowhere to go but down. For now at least, no one has the gall to try claiming that technology will still be the world's greatest growth industry. But make sure you remember this: the people who now claim that the next sure thing will be healthcare, or energy, or real estate, or gold, are no more likely to be right in the end than the hypostasis of high-tech turned out to be. The silver lining G. If no price seemed too high for stocks in the 1990s, in 2003 we've reached the point at which no price appears to be low enough. The pendulum has swung, as Graham knew it always does, from irrational exuberance to unjustifiable pessimism. In 2002, investors yanked $27 billion out of stock mutual funds, and a survey conducted by the Securities Industry Association found that 1 out of 10 investors had cut back on stocks by at least 25%. The same people who were eager to buy stocks in the late 1990s when they were going up in price and therefore becoming expensive sold stocks as they went down in price and, by definition, became cheaper. As Graham shows so brilliantly in Chapter 8, this is exactly backwards. The intelligent investor realizes that stocks become more risky, not less, as their prices rise, and less risky, not more, as their prices fall. The intelligent investor dreads a bull market, since it makes stocks more costly to buy. And conversely, so long as you keep enough cash on hand to meet your spending needs, you should welcome a bear market, since it puts stocks back on sale. Point 8. So take heart, the death of the bull market is not the bad news everyone believes it to be. Thanks to the decline in stock prices, now is a considerably safer and saner time to be building wealth. Read on, and let Graham show you how. The only exception to this rule is an investor in the advanced stage of retirement, who may not be able to outlast a long bear market. Yet even an elderly investor should not sell her stocks merely because they have gone down in price. That approach not only turns her paper losses into real ones, but deprives her heirs of the potential to inherit those stocks at lower costs. For tax purposes. Chapter 1. Investment versus speculation, results to be expected by the intelligent investor. His chapter will outline the viewpoints that will be set forth in the remainder of the book. In particular, we wish to develop at the outset our concept of appropriate portfolio policy for the individual, non-professional investor. Investment versus speculation. What do we mean by investor? Throughout this book the term will be used in contradistinction to speculator. As far back as 1934, in our textbook Security Analysis 1 we attempted a precise formulation of the difference between the two, as follows: an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. While we have clung tenaciously to this definition over the ensuing 38 years, it is worthwhile noting the radical changes that have occurred in the use of the term investor during this period. After the great market decline of 1929 a 1932, all common stocks were widely regarded as speculative by nature. A leading authority stated flatly that only bonds could be bought for investment. Point 2. Thus we had then to defend our definition against the charge that it gave too wide scope to the concept of investment. Now our concern is of the opposite sort. We must prevent our readers from accepting the common jargon which applies the term investor to anybody and everybody in the stock market. In our last edition we cited the following headline of a front-page article of our leading financial journal in June 1962. Investment versus speculation. Small investors bearish, they are selling odd lots short. In October 1970 the same journal had an editorial critical of what it called reckless investors, who this time were rushing in on the buying side. These quotations well illustrate the confusion that has been dominant for many years in the use of the words investment and speculation. Think of our suggested definition of investment given above, and compare it with the sale of a few shares of stock by an inexperienced member of the public, who does not even own what he is selling, and has some largely emotional conviction that he will be able to buy them back at a much lower price. It is not irrelevant to point out that when the 1962 article appeared, the market had already experienced a decline of major size, and was now getting ready for an even greater upswing. It was about as poor a time as possible for selling short. In a more general sense, the later used phrase reckless investors could be regarded as a laughable contradiction in terms of something like spendthrift misers were. This misuse of language not so mischievous. The newspaper employed the word investor in these instances because, in the easy language of Wall Street, everyone who buys or sells a security has become an investor, regardless of what he buys, or for what purpose, or at what price, or whether for cash or on margin. Compare this with the attitude of the public toward common stocks in 1948, when over 90% of those queried expressed themselves as opposed to the purchase of common stocks. Point 3. About half gave as their reason not safe, a gamble, and about half, the reason not familiar with. Asterisk. It is indeed ironical. Asterisk. The survey Graham cites was conducted for the Fed by the University of Michigan and was published in the Federal Reserve Bulletin, July, 1948. People were asked, suppose a man decides not to spend his money. He can either put it in a bank or in bonds, or he can invest it. What do you think would be the wisest thing for him to do with the money nowadays? Put it in the bank, buy savings bonds with it, invest it in real estate, or buy common stock with it. Only 4% thought common stock would offer a satisfactory return, 26% considered it not safe or a gamble. From 1949 through 1958, the stock market earned one of its highest 10-year returns in history. Though not surprising, that common stock purchases of all kinds were quite generally regarded as highly speculative or risky at a time when they were selling on a most attractive basis, and due soon to begin their greatest advance in history. Conversely, the very fact they had advanced to what were undoubtedly dangerous levels as judged by past experience later transformed them into investments, and the entire stock buying public into investors. The distinction between investment and speculation in common stocks has always been a useful one, and its disappearance is a cause for concern. We have often said that Wall Street as an institution would be well advised to reinstate this distinction and to emphasize it in all its dealings with the public. Otherwise, the stock exchanges may someday be blamed for heavy speculative losses, which those who suffered them had not been properly warned against. Ironically, once more, much of the recent financial embarrassment of some stock exchange firms seems to have come from the inclusion of speculative common stocks in their own capital funds. We trust that the reader of this book will gain a reasonably clear idea of the risks that are inherent in common stock commitments, risks which are inseparable from the opportunities of profit that they offer, and both of which must be allowed for in the investor's calculations. What we have just said indicates that there may no longer be such a thing as a Simon pure investment policy comprising representative common stocks in the sense that one can always wait to buy them at a price that involves no risk of a market or quotational loss large enough to be disquieting. In most periods the investor must recognize the existence of a speculative factor in his common stock holdings. It is his task to keep this component within minor limits, and to be prepared financially and psychologically for adverse results that may be of short or long duration. 2 paragraphs should be added about stock speculation for SE, as distinguished from the speculative component now inherent, averaging 18.7% annually. In a fascinating echo of that early Fed survey, a poll conducted by Business Week at year-end 2002 found that only 24% of investors were willing to invest more in their mutual funds or stock portfolios, down from 47% just 3 years earlier. Investment versus speculation. In most representative common stocks, outright speculation is neither illegal, immoral, nor, for most people, fattening to the pocketbook. More than that, some speculation is necessary and unavoidable, for in many common stock situations there are substantial possibilities of both profit and loss, and the risks therein must be assumed by someone. There is intelligent speculation as there is intelligent investing. But there are many ways in which speculation may be unintelligent. Of these the foremost are, 1. Speculating when you think you are investing, 2. Speculating seriously instead of as a pastime, when you lack proper knowledge and skill for it, and 3. Risking more money in speculation than you can afford to lose. In our conservative view, every non-professional who operates on margin should recognize that he is ipso facto speculating, and it is his broker's duty so to advise him. And everyone who buys a so-called hot common stock issue, or makes a purchase in any way similar thereto, is either speculating or gambling. Speculation is always fascinating, and it can be a lot of fun while you are ahead of the game. If you want to try your luck at it, put aside a portion of the smaller the better of your capital in a separate fund for this purpose. Never add more money to this account just because the speculation is beneficial on 2 levels. First, without speculation, untested new companies, like Amazon.com or, in earlier times, the Edison Electric Light Co., would never be able to raise the necessary capital for expansion. The alluring, long-shot chance of a huge gain is the grease that lubricates the machinery of innovation. Secondly, risk is exchanged, but never eliminated, every time a stock is bought or sold. The buyer purchases the primary risk that this stock may go down. Meanwhile, the seller still retains a residual risk of the chance that the stock he just sold may go up. A margin account enables you to buy stocks using money you borrow from the brokerage firm. By investing with borrowed money, you make more when your stocks go up, but you can be wiped out when they go down. The collateral for the loan is the value of the investments in your account, so you must put up more money if that value falls below the amount you borrowed. Market has gone up and profits are rolling in. That's the time to think of taking money out of your speculative fund. Never mingle your speculative and investment operations in the same account, nor in any part of your thinking. Results to be expected by the defensive investor. We have already defined a defensive investor as one interested chiefly in safety plus freedom from bother. In general, what course should he follow and what return can he expect under average normal conditions, if such conditions really exist? To answer these questions we shall consider first what we wrote on the subject 7 years ago, next what significant changes have occurred since then in the underlying factors governing the investor's expectable return, and finally what he should do and what he should expect under present-day, early 1972, conditions. 1. What we said 6 years ago. We recommended that the investor divide his holdings between high-grade bonds and leading common stocks, that the proportion held in bonds be never less than 25% or more than 75%, with the converse being necessarily true for the common stock component. That his simplest choice would be to maintain a 50-50 proportion between the two, with adjustments to restore the equality when market developments had disturbed it by as much as, say, 5%. As an alternative policy, he might choose to reduce his common stock component to 25% if he felt the market was dangerously high, and conversely to advance it toward the maximum of 75% if he felt that a decline in stock prices was making them increasingly attractive. In 1965 the investor could obtain about 4.5% on high-grade taxable bonds and 3.14% on good tax-free bonds. The dividend return on leading common stocks, with the DJIA at 892, was only about 3.2%. This fact, and others, suggested caution. We implied that at normal levels of the market the investor should be able to obtain an initial dividend return of between 3.5% and 4.5% on his stock purchases, to which should be added a steady increase in underlying value, and in the normal market price, of a representative investment versus speculation stock list of about the same amount, giving a return from dividends and appreciation combined of about 7.5% per year. The half and half division between bonds and stocks would yield about 6%. Before income tax, we added that the stock component should carry a fair degree of protection against a loss of purchasing power caused by large-scale inflation. It should be pointed out that the above arithmetic indicated expectation of a much lower rate of advance in the stock market than had been realized between 1949 and 1964. That rate had averaged a good deal better than 10% for listed stocks as a whole, and it was quite generally regarded as a sort of guarantee that similarly satisfactory results could be counted on in the future. Few people were willing to consider seriously the possibility that the high rate of advance in the past means that stock prices are now too high, and hence that the wonderful results since 1949 would imply not very good but bad results for the future. 4. 2. What has happened since 1964? The major change since 1964 has been the rise in interest rates on first-grade bonds to record high levels, although there has since been a considerable recovery from the lowest prices of 1970. The obtainable return on good corporate issues is now about 7.5% and even more against 4.5% in 1964. In the meantime, the dividend return on DJIA-type stocks had a fair advance also during the market decline of 1969-70, but as we write, with the Dow at 900, it is less than 3.5% against 3.2% at the end of 1964. The change in going interest rates produced a maximum decline of about 38% in the market price of medium-term, say 20-year, bonds during this period. There is a paradoxical aspect to these developments. In 1964 we discussed at length the possibility that the price of stocks might be too high and subject ultimately to a serious decline, but we did not Consider specifically the possibility that the same might happen to the price of high-grade bonds. Neither did anyone else that we know of. We did warn, on P90, that a long-term bond may vary widely in price in response to changes in interest rates. In the light of what has since happened, we think that this warning with attendant example SA was insufficiently stressed. For the fact is that, if the investor had a given sum in the DJIA at its closing price of 874 in 1964, he would have had a small profit thereon in late 1971. Even at the lowest level, 631, in 1970, his indicated loss would have been less than that shown on good long-term bonds. On the other hand, if he had confined his bond-type investments to U.S. savings bonds, short-term corporate issues, or savings accounts, he would have had no loss in market value of his principal during this period. And he would have enjoyed a higher income return than was offered by good stocks. It turned out, therefore, that true cash equivalents proved to be better investments in 1964 than common stocks, in spite of the inflation experience that in theory should have favored stocks over cash. The decline in quoted principal value of good longer-term bonds was due to developments in the money market, an abstruse area which ordinarily does not have an important bearing on the investment policy of individuals. This is just another of an endless series of experiences over time that have demonstrated that the future of security prices is never predictable. Almost always bonds have fluctuated much less than stock prices, and investors generally could buy good bonds of any maturity without having to worry about changes in their market value. There were a few exceptions to this rule, and the period after 1964 proved to be one of them. We shall have more to say about change in bond prices in a later chapter. 3. Expectations and policy in late 1971 and early 1972. Toward the end of 1971 it was possible to obtain 8% taxable interest on good medium-term corporate bonds, and 5.7% tax-free on good state or municipal securities. In the shorter-term field, the investor could realize about 6% on U.S. government issues due in 5 years. In the latter case, the buyer need not be concerned about. Read Graham's sentence again, and note what this greatest of investing experts is saying: the future of security prices is never predictable. And as you read ahead in the book, notice how everything else Graham tells you is designed to help you grapple with that truth. Since you cannot predict the behavior of the markets, you must learn how to predict and control your own behavior. Investment versus speculation. A possible loss in market value, since he is sure of full repayment, including the 6% interest return, at the end of a comparatively short holding period. The DJIA at its recurrent price level of 900 in 1971 yields only 3.5%. Let us assume that now, as in the past, the basic policy decision to be made is how to divide the fund between high-grade bonds, or other so-called cash equivalents, and leading DJIA type stocks. What course should the investor follow under present conditions, if we have no strong reason to predict either a significant upward or a significant downward movement for some time in the future? First, let us point out that if there is no serious adverse change, the defensive investor should be able to count on the current 3.5% dividend return on his stocks, and also on an average annual appreciation of about 4%. As we shall explain later, this appreciation is based essentially on the reinvestment by the various companies of a corresponding amount annually out of undistributed profits. On a before-tax basis, the combined return of his stocks would then average, say, 7.5%, somewhat less than his interest on high-grade bonds * on an after-tax basis. The average return on stocks would work out at some 5.3%. This would be about the same as is now obtainable on good tax-free medium-term bonds. These expectations are much less favorable for stocks against bonds than they were in our 1964 analysis. That conclusion follows inevitably from the basic fact that bond yields have gone up much more than stock yields since 1964. We must never lose sight. How well did Graham's forecast pan out? At first blush, it seems, very well. From the beginning of 1972 through the end of 1981, stocks earned an annual average return of 6.5%. Graham did not specify the time period for his forecast, but it's plausible to assume that he was thinking of a 10-year time horizon. However, inflation raged at 8.6% annually over this period, eating up the entire gain that stocks produced. In this section of his chapter, Graham is summarizing what is known as the Gordon equation, which essentially holds that the stock market's future return is the sum of the current dividend yield plus expected earnings growth. With a dividend yield of just under 2% in early 2003, and long-term earnings growth of around 2%, plus inflation at a bit over 2%, a future average annual return of roughly 6% is plausible. See the commentary on Chapter 3 of the fact that the interest and principal payments on good bonds are much better protected and therefore more certain than the dividends and price appreciation on stocks. Consequently, we are forced to the conclusion that now, toward the end of 1971, bond investment appears clearly preferable to stock investment. If we could be sure that this conclusion is right, we would have to advise the defensive investor to put all his money in bonds and none in common stocks until the current yield relationship changes significantly in favor of stocks. But of course we cannot be certain that bonds will work out better than stocks from today's levels. The reader will immediately think of the inflation factor as a potent reason on the other side. In the next chapter we shall argue that our considerable experience with inflation in the United States during this century would not support the choice of stocks against bonds at present differentials in yield. But there is always the possibility, although we consider it remote, of an accelerating inflation, which in one way or another would have to make stock equities preferable to bonds payable in a fixed amount of dollars *. There is the alternative possibility, which we also consider highly unlikely, that American business will become so profitable, without stepped-up inflation, as to justify a large increase in common stock values in the next few years. Finally, there is the more familiar possibility that we shall witness another great speculative rise in the stock market without a real justification in the underlying values. Any of these reasons, and perhaps others we haven't thought of, might cause the investor to regret a 100% concentration on bonds even at their more favorable yield levels. Hence, after this foreshortened discussion of the major considerations, we once again enunciate the same basic compromise policy. Since 1997, when Treasury inflation-protected securities, or TIPS, were introduced, stocks have no longer been the automatically superior choice for investors who expect inflation to increase. TIPS, unlike other bonds, rise in value if the consumer price index goes up, effectively immunizing the investor against losing money after inflation. Stocks carry no such guarantee, and, in fact, are a relatively poor hedge against high rates of inflation. For more details, see the commentary to Chapter 2. Investment versus speculation. For defensive investors saw namely that at all times they have a significant part of their funds in bond-type holdings and a significant part also in equities. It is still true that they may choose between maintaining a simple 50-50 division between the two components, or a ratio, dependent on their judgment, varying between a minimum of 25% and a maximum of 75% of either. We shall give our more detailed view of these alternative policies in a later chapter. Since at present the overall return envisaged from common stocks is nearly the same as that from bonds, the presently expectable return, including growth of stock values, for the investor would change little regardless of how he divides his fund between the two components. As calculated above, the aggregate return from both parts should be about 7.8% before taxes or 5.5% on a tax-free or estimated tax-paid basis. A return of this order is appreciably higher than that realized by the typical conservative investor over most of the long-term past. It may not seem attractive in relation to the 14%, or so, return shown by common stocks during the 20 years of the predominantly bull market after 1949. But it should be remembered that between 1949 and 1969 the price of the DJIA had advanced more than fivefold while its earnings and dividends had about doubled. Hence the greater part of the impressive market record for that period was based on a change in investors' and speculators' attitudes rather than in underlying corporate values. To that extent it might well be called a bootstrap operation. In discussing the common stock portfolio of the defensive investor, we have spoken only of leading issues of the type included in the 30 components of the Dow Jones Industrial Average. We have done this for convenience, and not to imply that these 30 issues alone are suitable for purchase by him. Actually, there are many other companies of quality equal to or excelling the average of the Dow Jones list. These would include a host of public utilities, which have a separate Dow Jones average to represent them. But today, the most widely available alternatives to the Dow Jones Industrial Average are the Standard & Poor's 500 Stock Index, the S&P, and the Wilshire 5000 Index. The S&P focuses on 500 large, well-known companies that make up roughly 70% of the total value of the U.S. equity market. The Wilshire 5000 follows the returns of nearly every significant, publicly. The major point here is that the defensive investor's overall results are not likely to be decisively different from one diversified or representative list than from another, or more accurately that neither he nor his advisors could predict with certainty whatever differences would ultimately develop. It is true that the art of skillful or shrewd investment is supposed to lie particularly in the selection of issues that will give better results than the general market. For reasons to be developed elsewhere, we are skeptical of the ability of defensive investors generally to get better than average results, which in fact would mean to beat their own overall performance. Our skepticism extends to the management of large funds by experts. Let us illustrate our point by an example that at first may seem to prove the opposite. Between December 1960 and December 1970, the DJIA advanced from 616 to 839, or 36%. But in the same period, the much larger Standard & Poor's weighted index of 500 stocks rose from 58.11 to 92.15, or 58%. Obviously the second group had proved a better buy than the first. But who would have been so rash as to predict in 1960 that what seemed like a miscellaneous assortment of all sorts of common stocks would definitely outperform the aristocratic 30 tyrants of the Dow? All this proves, we insist, that only rarely can one make dependable predictions about price changes, absolute or relative. We shall repeat here without apology, for the warning cannot be given too often that the investor cannot hope for better than average results by buying new offerings, or hot issues of any Sort, meaning thereby those recommended for a quick profit. The contrary is almost certain to be true in the long run. The defensive investor must confine himself to the shares of important companies with a long record of profitable operations and in strong financial condition. Any security analyst worth his salt could make up such traded stock in America, roughly 6,700 in all, but, since the largest companies account for most of the total value of the index, the return of the Wilshire 5000 is usually quite similar to that of the S&P 500. Several low-cost mutual funds enable investors to hold the stocks in these indexes as a single, convenient portfolio. Investment versus speculation. A list. Aggressive investors may buy other types of common stocks, but they should be on a definitely attractive basis as established by intelligent analysis. To conclude this section, let us mention briefly three supplementary concepts or practices for the defensive investor. The first is the purchase of the shares of well-established investment funds as an alternative to creating his own common stock portfolio. He might also utilize one of the common trust funds, or commingled funds, operated by trust companies and banks in many states, or, if his funds are substantial, use the services of a recognized investment counsel firm. This will give him professional administration of his investment program along standard lines. The third is the device of dollar cost averaging, which means simply that the practitioner invests in common stocks the same number of dollars each month or each quarter. In this way he buys more shares when the market is low than when it is high, and he is likely to end up with a satisfactory overall price for all his holdings. Strictly speaking, this method is an application of a broader approach known as formula investing. The latter was already alluded to in our suggestion that the investor may vary his holdings of common stocks between the 25% minimum and the 75% maximum, in inverse relationship to the action of the market. These ideas have merit for the defensive investor, and they will be discussed more amply in later chapters. Results to be expected by the aggressive investor. Our enterprising security buyer, of course, will desire and expect to attain better overall results than his defensive or passive companion. But first he must make sure that his results will not be worse. It is no difficult trick to bring a great deal of energy, study, and native ability into Wall Street and to end up with losses instead of profits. These virtues, if channeled in the wrong directions, become indistinguishable from handicaps. Thus it is most essential that the enterprising investor start with a clear conception as to for more advice on well-established investment funds, see Chapter 9. Professional administration by a recognized investment counsel firm is discussed in Chapter 10. Dollar cost averaging is explained in Chapter 5. Which courses of action offer reasonable chances of success and which do not. First, let us consider several ways in which investors and speculators generally have endeavored to obtain better than average results. These include 1. Trading in the market. This usually means buying stocks when the market has been advancing and selling them after it has turned downward. The stocks selected are likely to be among those which have been behaving better than the market average. A small number of professionals frequently engage in short selling. Here they will sell issues they do not own but borrow through the established mechanism of the stock exchanges. Their object is to benefit from a subsequent decline in the price of these issues, by buying them back at a price lower than they sold them for. As our quotation from the Wall Street Journal on p19 indicates, even small investors perish the term, sometimes try their unskilled hand at short selling. 2. Short-term selectivity. This means buying stocks of companies which are reporting or expected to report increased earnings, or for which some other favorable development is anticipated. 3. Long-term selectivity. Here the usual emphasis is on an excellent record of past growth, which is considered likely to continue in the future. In some cases also the investor may choose companies which have not yet shown impressive results, but are expected to establish a high earning power later. Such companies belong frequently in some technological area, e.g., computers, drugs, electronics, and they often are developing new processes or products that are deemed to be especially promising. We have already expressed a negative view about the investors' overall chances of success in these areas of activity. The first we have ruled out, on both theoretical and realistic grounds, from the domain of investment. Stock trading is not an operation which, on thorough analysis, offers safety of principle and a satisfactory return. More will be said on stock trading in a later chapter. Investment versus speculation. In his endeavor to select the most promising stocks either for the near term or the longer future, the investor faces obstacles of two kinds, the first stemming from human fallibility and the second from the nature of his competition. He may be wrong in his estimate of the future, or even if he is right, the current market price may already fully reflect what he is anticipating. In the area of near-term selectivity, the current year's results of the company are generally common property on Wall Street. Next year's results, to the extent they are predictable, are already being carefully considered. Hence the investor who selects issues chiefly on the basis of this year's superior results, or on what he is told he may expect for next year, is likely to find that others have done the same thing for the same reason. In choosing stocks for their long-term prospects, the investors' handicaps are basically the same. The possibility of outright error in the prediction which we illustrated by our airlines example on P6A is no doubt greater than when dealing with near-term earnings. Because the experts frequently go astray in such forecasts, it is theoretically possible for an investor to benefit greatly by making correct predictions when Wall Street as a whole is making incorrect ones. But that is only theoretical. How many enterprising investors could count on having the acumen or prophetic gift to beat the professional analysts at their favorite game of estimating long-term future earnings? We are thus led to the following logical if disconcerting conclusion: to enjoy a reasonable chance for continued better than average results, the investor must follow policies which are 1. Inherently sound and promising, and 2. Not popular on Wall Street. Are there any such policies available for the enterprising investor? In theory, once again, the answer should be yes, and there are broad reasons to think that the answer should be affirmative in practice as well. Everyone knows that speculative stock movements are carried too far in both directions, frequently in the general market and at all times in at least some of the individual issues. Furthermore, a common stock may be undervalued because of lack of interest or unjustified popular prejudice. We can go further and assert that in an astonishingly large proportion of the trading in common stocks, those engaged therein don't appear to know in polite terms one part of their anatomy from another. In this book we shall point out numerous examples of past discrepancies between price and value. Thus it seems that any intelligent person, with a good head for figures, should have a veritable picnic on Wall Street, battening off other people's foolishness. So it seems, but somehow it doesn't work out that simply. Buying a neglected and therefore undervalued issue for profit generally proves a protracted and patience-trying experience. And selling short a Too popular and therefore overvalued issue is apt to be a test not only of one's courage and stamina but also of the depth of one's pocketbook. The principle is sound, its successful application is not impossible, but it is distinctly not an easy art to master. There is also a fairly wide group of special situations, which, over many years could be counted on to bring a nice annual return of 20% or better, with a minimum of overall risk to those who knew their way around in this field. They include intersecurity arbitrages, payouts or workouts in liquidations, protected hedges of certain kinds. The most typical case is a projected merger or acquisition which offers a substantially higher value for certain shares than their price on the date of the announcement. The number of such deals increased greatly in recent years, and it should have been a highly profitable period for the conoscenti. But with the multiplication of merger announcements came a multiplication of obstacles to mergers and of deals that didn't go through. Quite a few individual losses were thus realized in these once reliable operations. Perhaps, too, the overall rate of profit was diminished by too much competition. In selling short, or shorting, a stock, you make a bet that its share price will go down, not up. Shorting is a three-step process. First, you borrow shares from someone who owns them, then you immediately sell the borrowed shares. Finally, you replace them with shares you buy later. If the stock drops, you will be able to buy your replacement shares at a lower price. The difference between the price at which you sold your borrowed shares and the price you paid for the replacement shares is your gross profit, reduced by dividend or interest charges, along with brokerage costs. However, if the stock goes up in price instead of down, your potential loss is unlimited, making short sales unacceptably speculative for most individual investors. In the late 1980s, as hostile corporate takeovers and leveraged buyouts multiplied, Wall Street set up institutional arbitrage desks to profit from any investment versus speculation. The lessened profitability of these special situations appears one manifestation of a kind of self-destructive process akin to the law of diminishing returns, which has developed during the lifetime of this book. In 1949 we could present a study of stock market fluctuations over the preceding 75 years, which supported a formula based on earnings and current interest rates for determining a level to buy the DJIA below its central or intrinsic value, and to sell out above such value. It was an application of the governing maxim of the Rothschilds, buy cheap and sell dear. And it had the advantage of running directly counter to the ingrained and pernicious maxim of Wall Street that stocks should be bought because they have gone up and sold because they have gone down. Alas, after 1949 this formula no longer worked. A second illustration is provided by the famous Dow theory of stock market movements, in a comparison of its indicated splendid results for 1897 1933 and its much more questionable performance since 1934. A third and final example of the golden opportunities not recently available, a good part of our own operations on Wall Street had been concentrated on the purchase of bargain issues easily identified as such by the fact that they were selling at less than their share in the net current assets, working capital, alone, not counting the plant account and other assets, and after deducting all liabilities ahead of the stock. It is clear that these issues were selling at a price well below the value of the enterprise as a private business. No proprietor or majority holder would think of selling what he owned at so ridiculously low a figure. Strangely enough, such errors in pricing these complex deals, they became so good at it that the easy profits disappeared and many of these desks have been closed down. Although Graham does discuss it again, See pages 174a-175, this sort of trading is no longer feasible or appropriate for most people, since only multimillion-dollar trades are large enough to generate worthwhile profits. Wealthy individuals and institutions can utilize this strategy through hedge funds that specialize in merger or event arbitrage. The Rothschild family, led by Nathan Mayer Rothschild, was the dominant power in European investment banking and brokerage in the 19th century. For a brilliant history, see Niall Ferguson, The House of Rothschild. Money's Profits, 1798-1848, Viking, 1998. Anomalies were not hard to find. In 1957 a list was published showing nearly 200 issues of this type available in the market. In various ways practically all these bargain issues turned out to be profitable. And the average annual result proved much more remunerative than most other investments. But they too virtually disappeared from the stock market in the next decade, and with them a dependable area for shrewd and successful operation by the enterprising investor. However, at the low prices of 1970 there again appeared a considerable number of such sub-working capital issues, and, despite the strong recovery of the market, enough of them remained at the end of the year to make up a full-sized portfolio. The enterprising investor under today's conditions still has various possibilities of achieving better than average results. The huge list of marketable securities must include a fair number that can be identified as undervalued by logical and reasonably dependable standards. These should yield more satisfactory results on the average than will the DJIA or any similarly representative list. In our view, the search for these would not be worth the investor's effort unless he could hope to add, say, 5% before taxes to the average annual return from the stock portion of his portfolio. We shall try to develop one or more such approaches to stock selection for use by the active investor. Commentary on Chapter 1. All of human unhappiness comes from one single thing, not knowing how to remain at rest in a room. A. Blaise Pascal. Why do you suppose the brokers on the floor of the New York Stock Exchange always cheer at the sound of the closing bell, no matter what the market did that day? Because whenever you trade, they make money whether you did or not. By speculating instead of investing, you lower your own odds of building wealth and raise someone else's. Graham's definition of investing could not be clearer. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. One note that investing, according to Graham, consists equally of three elements. You must thoroughly analyze a company, and the soundness of its underlying businesses, before you buy its stock. You must deliberately protect yourself against serious losses. You must aspire to adequate, not extraordinary, performance. Graham goes even further, fleshing out each of the key terms in his definition. Thorough analysis means the study of the facts in the light of established standards of safety and value, while safety of principle signifies protection against loss under all normal or reasonably likely conditions or variations, and adequate, or satisfactory, return refers to any rate or amount of return, however low, which the investor is willing to accept, provided he acts with reasonable intelligence. Security Analysis, 1934 ed. Pages 55a-56. Commentary on Chapter 1. An investor calculates what a stock is worth, based on the value of its businesses. A speculator gambles that a stock will go up in price because somebody else will pay even more for it. As Graham once put it, investors judge the market price by established standards of value, while speculators base their standards of value upon the market price. 2. For a speculator, the incessant stream of stock quotes is like oxygen, cut it off and he dies. For an investor, what Graham called quotational values matter much less. Graham urges you to invest only if you would be comfortable owning a stock even if you had no way of knowing its daily share price. Point 3. Like casino gambling or betting on the horses, speculating in the market can be exciting or even rewarding, if you happen to get lucky. But it's the worst imaginable way to build your wealth. That's because Wall Street, like Las Vegas or the racetrack, has calibrated the odds so that the house always prevails, in the end, against everyone who tries to beat the house at its own speculative game. On the other hand, investing is a unique kind of casino, one where you cannot lose in the end, so long as you play only by the rules that put the odds squarely in your favor. People who invest make money for themselves, people who speculate make money for their brokers. And that, in turn, is why Wall Street perennially downplays the durable virtues of investing and hypes the gaudy appeal of speculation. Unsafe at high speed. Confusing speculation with investment, Graham warns, is always a mistake. In the 1990s, that confusion led to mass destruction. Almost everyone, it seems, ran out of patience at once, and America became the speculation nation, populated with traders who went shooting from stock to stock like grasshoppers whizzing around in an August hayfield. People began believing that the test of an investment technique was simply whether it worked. If they beat the market over any security analysis, 1934 ed. p. 310. As Graham advised in an interview, ask yourself, if there was no market for these shares, would I be willing to have an investment in this company on these terms? Forbes, January 1, 1972, p. 90. Commentary on Chapter 1. Period. No matter how dangerous or dumb their tactics, people boasted that they were right. But the intelligent investor has no interest in being temporarily right. To reach your long-term financial goals, you must be sustainably and reliably right. The techniques that became so trendy in the 1990s SA day trading, ignoring diversification, flipping hot mutual funds, following stock-picking systems seemed to work. But they had no chance of prevailing in the long run, because they failed to meet all three of Graham's criteria for investing. To see why temporarily high returns don't prove anything, imagine that two places are 130 miles apart. If I observe the 65 mph speed limit, I can drive that distance in 2 hours. But if I drive 130 miles per hour, I can get there in 1 hour. If I try this and survive, am I right? Should you be tempted to try it, too, because you hear me bragging that it worked? Flashy gimmicks for beating the market are much the same, in short streaks, so long as your luck holds out, they work. Over time, they will get you killed. In 1973, when Graham last revised The Intelligent Investor, the annual turnover rate on the New York Stock Exchange was 20%, meaning that the typical shareholder held a stock for 5 years before selling it. By 2002, the turnover rate had hit 105%, a holding period of only 11.4 months. Back in 1973, the average mutual fund held onto a stock for nearly 3 years. By 2002, that ownership period had shrunk to just 10.9 months. It's as if mutual fund managers were studying their stocks just long enough to learn they shouldn't have bought them in the first place, then promptly dumping them and starting all over. Even the most respected money management firms got antsy. In early 1995, Jeffrey Vinik, manager of Fidelity Magellan, then the world's largest mutual fund, had 42.5% of its assets in technology stocks. Zweig proclaimed that most of his shareholders have invested in the fund for goals that are years away. I think their objectives are the same as mine, and that they believe, as I do, that a long-term approach is best. But 6 months after he wrote those high-minded words, Zweig sold off almost all his technology shares, unloading nearly $19 billion worth in 8 frenzied weeks. So much for the long term. And by 1999, Fidelity's discount brokerage division was egging on its clients to trade anywhere, anytime, using a Palm handheld computer, which was perfectly in tune with the firm's new slogan, "Every second counts." Commentary on Chapter 1. Stocks on speed. Average length of ownership, in days. And on the Nasdaq exchange, turnover hit warp speed, as figure 1:1 shows. 4. In 1999, shares in Puma Technology, for instance, changed hands an average of once every 5.7 days. Despite Nasdaq's grandiose motto, the stock market for the next 100 years, many of its customers could barely hold onto a stock for 100 hours. The financial video game Wall Street made online trading sound like an instant way to mint money. Discover Brokerage, the online arm of the venerable firm of Source, Steve Galbraith, Sanford C. Bernstein & Co. Research Report, January 10, 2000. The stocks in this table had an average return of 1,196.4% in 1999. They lost an average of 79.1% in 2000, 35.5% in 2001, and 44.5% in 2002, destroying all the gains of 1999, and then some. Commentary on Chapter 1. Morgan Stanley ran a TV commercial in which a scruffy tow truck driver picks up a prosperous-looking executive. Spotting a photo of a tropical beachfront posted on the dashboard, the executive asks, "Vacation?" "Actually," replies the driver, "that's my home." Taken aback, the suit says, "Looks like an island." With quiet triumph, the driver answers, "Technically, it's a country." The propaganda went further. Online trading would take no work and require no thought. A television ad from Ameritrade, the online broker, showed 2 housewives just back from jogging. One logs on to her computer, clicks the mouse a few times, and exults, "I think I just made about $1,700. In a TV commercial for the Waterhouse brokerage firm, someone asked basketball coach Phil Jackson, "You know anything about the trade?" His answer, "I'm going to make it right." Now, how many games would Jackson's NBA teams have won if he had brought that philosophy to courtside? Somehow, knowing nothing about the other team, but saying, "I'm ready to play them right now," doesn't sound like a championship formula. By 1999, at least 6 million people were trading on Linea, and roughly a tenth of them were day trading, using the internet to buy and sell stocks at lightning speed. Everyone from showbiz diva Barbra Streisand to Nicholas Burbus, a 25-year-old former waiter in Queens, New York, was flinging stocks around like live coals. "Before," scoffed Burbus, "I was investing for the long term and I found out that it was not smart." Now, Burbus traded stocks up to 10 times a day and expected to earn $100,000 in a year. "I can't stand to see red in my profit or loss column," Streisand shuddered in an interview with Fortune. "I'm Taurus, the bull, so I react to red. If I see red, I sell my stocks quickly." 5. By pouring continuous data about stocks into bars and barbershops, kitchens and coffee copyright taxi cabs and truck stops, financial websites and financial TV turned the stock market into a non-stop national video game. The public felt more knowledgeable about the markets than ever before. Unfortunately, while people were drowning in data, knowledge was nowhere to be found. Stocks became entirely deku. Instead of stargazing, Streisand should have been channeling Graham. The intelligent investor never dumps a stock purely because its share price has fallen. She always asks first whether the value of the company's underlying businesses has changed. Commentary on Chapter 1. Pled from the companies that had issued theme of pure abstractions, just blips moving across a TV or computer screen. If the blips were moving up, nothing else mattered. On December 20, 1999, Juno Online Services unveiled a trailblazing business plan, to lose as much money as possible, on purpose. Juno announced that it would henceforth offer all its retail services for free, no charge for email, no charge for internet access, and that it would spend millions of dollars more on advertising over the next year. On this declaration of corporate harakiri, Juno's stock roared up from $16.375 to $66.75 in 2 days. 6. Why bother learning whether a business was profitable, or what goods or services a company produced, or who its management was, or even what the company's name was? All you needed to know about stocks was the catchy code of their ticker symbols: CBLT, INKT, PCLN, TGLO, VRSN, WBVN.7. That way you could buy them even faster, without the pesky 2-second delay of looking them up on an internet search engine. In late 1998, the stock of a tiny, rarely traded building maintenance company, Temco Services, nearly tripled in a matter of minutes on record high volume. Why? In a bizarre form of financial dyslexia, thousands of traders bought Temco after mistaking its ticker symbol, TMCO, for that of Ticketmaster Online, TMCS, an internet darling whose stock began trading publicly for the first time that day. 8. Oscar Wilde joked that a cynic knows the price of everything, and the value of nothing. Under that definition, the stock market is always cynical, but by the late 1990s it would have shocked Oscar himself. A single half-baked opinion on price could double a company's stock, even as its value went entirely unexamined. In late 1998, Henry Blodgett, an analyst at CIBC Oppenheimer, warned that, as with all internet stocks, a valuation is clearly more art than science. Then, citing only the possibility of future growth, he jacked up his price target on. Just 12 months later, Juno's shares had shriveled to $1.093. A ticker symbol is an abbreviation, usually 1 to 4 letters long, of a company's name used as shorthand to identify a stock for trading purposes. This was not an isolated incident. On at least 3 other occasions in the late 1990s, day traders sent the wrong stock soaring when they mistook its ticker symbol for that of a newly minted internet company. Commentary on Chapter 1. Amazon.com from $150 to $400 in one fell swoop. Amazon.com shot up 19% that day, and despite Blodgett's protest that his price target was a 1-year forecast, soared past $400 in just 3 weeks. A year later, PaineWebber analyst Walter P. Sick predicted that Qualcomm stock would hit $1,000 a share over the next 12 months. The stock, already up 1,842% that year, soared another 31% that day, hitting $659 a share. 9. From formula to fiasco. But trading as if your underpants are on fire is not the only form of speculation. Throughout the past decade or so, One speculative formula after another was promoted, popularized, and then thrown aside. All of them shared a few traits of this is quick. This is easy. And it won't hurt a bit, and all of them violated at least one of Graham's distinctions between investing and speculating. Here are a few of the trendy formulas that fell flat. Cash in on the calendar. The January effect. The tendency of small stocks to produce big gains around the turn of the year was widely promoted in scholarly articles and popular books published in the 1980s. These studies showed that if you piled into small stocks in the second half of December and held them into January, you would beat the market by 5 to 10 percentage points. That amazed many experts. After all, if it were this easy, surely everyone would hear about it, lots of people would do it, and the opportunity would wither away. What caused the January jolt? First of all, many investors sell their crummiest stocks late in the year to lock in losses that can cut their tax bills. Second, professional money managers grow more cautious as the year draws to a close, seeking to preserve their outperformance, or minimize their underperformance. That makes them reluctant to buy, or even hang on to, a falling stock. And if an underperforming stock is also small and obscure, a money manager will be even less eager to show it in his year-end. In 2000 and 2001, Amazon.com and Qualcomm lost a cumulative total of 85.8% and 71.3% of their value, respectively. Commentary on Chapter 1. List of holdings. All these factors turn small stocks into momentary bargains. When the tax-driven selling ceases in January, they typically bounce back, producing a robust and rapid gain. The January effect has not withered away, but it has weakened. According to finance professor William Schwartz of the University of Rochester, if you had bought small stocks in late December and sold them in early January, you would have beaten the market by 8.5 percentage points from 1962 through 1979, by 4.4 points from 1980 through 1989, and by 5.8 points from 1990 through 2001.10. As more people learned about the January effect, more traders bought small stocks in December, making them less of a bargain, and thus reducing their returns. Also, the January effect is biggest among the smallest stocks but according to Plexus Group, the leading authority on brokerage expenses, the total cost of buying and selling such tiny stocks can run up to 8% of your investment. 11 Sadly, by the time you're done paying your broker, all your gains on the January effect will melt away. Just do what works. In 1996, an obscure money manager named James O'Shaughnessy published a book called What Works on Wall Street. In it, he argued that investors can do much better than the market. O'Shaughnessy made a stunning claim: from 1954 through 1994, you could have turned $10,000 into $8,074,504, beating the market by more than 10-fold, a towering 18.2% average annual return. How? By buying a basket of 50 stocks with the highest one-year returns, 5 straight years of rising earnings, and share prices less than 1.5 times their corporate revenues. 12 As if he were the Edison of Wall Street, O'Shaughnessy obtained U.S. patent number 5,978,778 for his automated strategies and launched a group of 4 mutual funds based on his findings. By late 1999, the funds had sucked in more than $175 million from the public, and, in his annual letter to shareholders, O'Shaughnessy stated grandly, "As always, I hope that together, we can reach our long-term goals by staying the course and sticking with our time-tested investment strategies." but what works on Wall Street stopped working right after. O'Shaughnessy publicized it. As figure 1 to 2 shows, 2 of his funds stank so badly that they shut down in early 2000, and the what used to work on Wall Street value of $100 invested on November 1, 1996. Commentary on Chapter 1. Overall stock market, as measured by the S&P 500 index, walloped every O'Shaughnessy fund almost non-stop for nearly 4 years running. In June 2000, O'Shaughnessy moved closer to his own long-term goals by turning the funds over to a new manager, leaving his customers to fend for themselves with those time-tested investment strategies. 13 O'Shaughnessy's shareholders might have been less upset if he had given his book a more precise title. For instance, what used to work on Wall Street until I wrote this book. Follow the Foolish Four. In the mid-1990s, The Motley Fool website, and several books, hyped the daylights out of a technique called the Foolish Four. According to The Motley Fool, you would have trashed the market averages over the last 25 years, and could crush your mutual funds by spending only 15 minutes a year on planning your investments. Best of all, this technique had minimal risk. All you needed to do was this. 1. Take the 5 stocks in the Dow Jones Industrial Average with the lowest stock prices and highest dividend yields. 2. Discard the one with the lowest price. 3. Put 40% of your money in the stock with the second lowest price. 4. Put 20% in each of the 3 remaining stocks. 5. 1 year later, sort the Dow the same way and reset the portfolio according to steps 1 through 4. 6. Repeat until wealthy. Over a 25-year period, the Motley Fool claimed, this technique would have beaten the market by a remarkable 10.1%. In a remarkable irony, the surviving 2 O'Shaughnessy funds, now known as the Hennessy funds, began performing quite well just as O'Shaughnessy announced that he was turning over the management to another company. The fund's shareholders were furious. In a chat room at www.morningstar.com, one fumed, I guess a long term for Oz is 3 years. I feel your pain. I, too, had faith in Oz's method. I had told several friends and relatives about this fund, and now am glad they didn't act on my advice. Points annually. Over the next 2 decades, they suggested, $20,000 invested in the Foolish Four should flower into $1,791,000. And, they claimed, you could do still better by picking the 5 Dow stocks with the highest ratio of dividend yield to the square root of stock price, dropping the one that scored the highest, and buying the next 4. Let's consider whether this strategy could meet Graham's definitions of an investment. What kind of thorough analysis could justify discarding the stock with the single most attractive price and dividend but keeping the 4 that score lower for those desirable qualities? How could putting 40% of your money into only one stock be a minimal risk? And how could a portfolio of only 4 stocks be diversified enough to provide safety of principle? The Foolish Four, in short, was one of the most cockamamie stock-picking formulas ever concocted. The fools made the same mistake as O'Shaughnessy. If you look at a large quantity of data long enough, a huge number of patterns will emerge, if only by chance. By random luck alone, the companies that produce above-average stock returns will have plenty of things in common. But unless those factors cause the stocks to outperform, they can't be used to predict future returns. None of the factors that the Motley Fools discovered with such fanfare, dropping the stock with the best score, doubling up on the one with the second highest score, dividing the dividend yield by the square root of stock price, could possibly cause or Explain the future performance of a stock. Money magazine found that a portfolio made up of stocks whose names contained no repeating letters would have performed nearly as well as the foolish four, and for the same reason, luck alone. 14 As Graham never stops reminding us, stocks do well or poorly in the future, because the businesses behind them do well or poorly on nothing more, and nothing less. Sure enough, instead of crushing the market, the foolish four crushed the thousands of people who were fooled into believing that it was a form of investing. In 2000 alone, the four foolish stocks, Caterpillar, Eastman Kodak, SBC, and General Motors saw lost 14%, while the Dow dropped by just 4.7%. As these examples show, there's only one thing that never suffers a bear market on Wall Street: dopey ideas. Each of these so-called investing approaches fell prey to Graham's law. All mechanical formulas for earning higher stock performance are a kind of self-destructive process akin to the law of diminishing returns. There are two reasons the returns fade away. If the formula was just based on random statistical flukes, like the foolish four, the mere passage of time will expose that it made no sense in the first place. On the other hand, if the formula actually did work in the past, like the January effect, then, by publicizing it, market pundits always erode and usually eliminate its ability to do so in the future. All this reinforces Graham's warning that you must treat speculation as veteran gamblers treat their trips to the casino. You must never delude yourself into thinking that you're investing when you're speculating. Speculating becomes mortally dangerous the moment you begin to take it seriously. You must put strict limits on the amount you are willing to wager. Just as sensible gamblers take, say, $100 down to the casino floor, and leave the rest of their money locked in the safe in their hotel room. The intelligent investor designates a tiny portion of her total portfolio as a mad money account. For most of us, 10% of our overall wealth is the maximum permissible amount to put at speculative risk. Never mingle the money in your speculative account with what's in your investment accounts. Never allow your speculative thinking to spill over into your investing activities, and never put more than 10% of your assets into your mad money account, no matter what happens. For better or worse, the gambling instinct is part of human nature, so it's futile for most people even to try suppressing it. But you must confine and restrain it. That's the single best way to make sure you will never fool yourself into confusing speculation with investment. Chapter 2. The Investor and Inflation. Inflation, and the fight against it, has been very much in the public's mind in recent years. The shrinkage in the purchasing power of the dollar in the past, and particularly the fear, or hope, by speculators, of a serious further decline in the future, has greatly influenced the thinking of Wall Street. It is clear that those with a fixed dollar income will suffer when the cost of living advances, and the same applies to a fixed amount of dollar principal. Holders of stocks, on the other hand, have the possibility that a loss of the dollar's purchasing power may be offset by advances in their dividends and the prices of their shares. On the basis of these undeniable facts, many financial authorities have concluded that, 1. Bonds are an inherently undesirable form of investment, and, 2. Consequently, common stocks are by their very nature more desirable investments than bonds. We have heard of charitable institutions being advised that their portfolios should consist 100% of stocks and 0% of bonds. This is quite a reversal from the earlier days when trust investments were by the late 1990s. This advice, which can be appropriate for a foundation or endowment with an infinitely long investment horizon, had spread to individual investors, whose lifespans are finite. In the 1994 edition of his influential book, Stocks for the Long Run, finance professor Jeremy Siegel of the Wharton School recommended that risk-taking investors should buy on margin, borrowing more than a third of their net worth to sink 135% of their assets into stocks. Even government officials got in on the act. In February 1999, the Honorable Richard Dixon, State Treasurer of Maryland, told the audience at an investment conference, "It doesn't make any sense for anyone to have any money in a bond fund, restricted by law to high-grade bonds, and a few choice preferred stocks." Our readers must have enough intelligence to recognize that even high-quality stocks cannot be a better purchase than bonds. Under all conditions, i.e., regardless of how high the stock market may be and how low the current dividend return compared with the rates available on bonds. A statement of this kind would be as absurd as was the contrary only too often heard years ago that any bond is safer than any stock. In this chapter we shall try to apply various measurements to the inflation factor, in order to reach some conclusions as to the extent to which the investor may wisely be influenced by expectations regarding future rises in the price level. In this matter, as in so many others in finance, we must base our views of future policy on a knowledge of past experience. Is inflation something new for this country, at least in the serious form it has taken since 1965? If we have seen comparable, or worse, inflations in living experience, what lessons can be learned from them in confronting the inflation of today? Let us start with Table 2:1, a condensed historical tabulation that contains much information about changes in the general price level and concomitant changes in the earnings and market value of common stocks. Our figures will begin with 1915, and thus cover 55 years, presented at 5-year intervals. We use 1946 instead of 1945 to avoid the last year of wartime price controls. The first thing we notice is that we have had inflation in the past, lots of it. The largest 5-year dose was between 1915 and 1920, when the cost of living nearly doubled. This compares with the advance of 15% between 1965 and 1970. In between, we have had 3 periods of declining prices and then 6 of advances at varying rates, some rather small. On this showing, the investor should clearly allow for the probability of continuing or recurrent inflation to come. Can we tell what the rate of inflation is likely to be? No clear answer is suggested by our table. It shows variations of all sorts. It would seem sensible, however, to take our cue from the rather consistent record of the past 20 years. The average annual rise in the consumer price level for this period has been 2.5%, that for 1965 1970 was 4.5%, that for 1970 alone was 5.4%. Official govern. Percent change from previous level. Stock. Stock. Consumer. Wholesale. Prices. Earnings. Prices. Prices. S&P 500 Stock Index. Price. Earnings. Annual averages. For price level 1957 equals 100 in table, but using new base, 1967 equals 100, the average for 1970 is 116.3 for consumers' prices and 110.4 for wholesale prices for the stock index. B. 1941 A 1943 average equals 10. C. 1946 used, to avoid price controls. Year. Price level A. Consumer. Wholesale. Ment policy has been strongly against large-scale inflation, and There are some reasons to believe that federal policies will be more effective in the future than in recent years. We think it would be reasonable for an investor at this point to base his thinking and decisions on a probable, far from certain, rate of future inflation of, say, 3% per annum. This would compare with an annual rate of about 2.5% for the entire period 1915–1970. 1. What would be the implications of such an advance? It would eat up, in higher living costs, about one-half the income now obtainable on good medium-term tax-free bonds, or are assumed after-tax equivalent from high-grade corporate bonds. This would be a serious shrinkage, but it should not be exaggerated. It would not mean that the true value, or the purchasing power, of the investor's fortune need be reduced over the years. If he spent half his interest income after taxes, he would maintain this buying power intact, even against a 3% annual inflation. But the next question, naturally, is, can the investor be reasonably sure of doing better by buying and holding other things than high-grade bonds, even at the unprecedented rate of return offered in 1970–1971? Would not, for example, an all-stock program be preferable to a part bond, part stock program? Do not common stocks have a built-in protection against inflation, and are they not almost certain to give a better return over the years than will bonds? Have not in fact stocks treated the investor far better than have bonds over the 55-year period of our study? The answer to these questions is somewhat complicated. Common stocks have indeed done better than bonds over a long period of time in the past. The rise of the DJIA from an average of 77 in 1915 to an average of 753 in 1970 works out at an annual compounded rate of just about 4%, to which we may add another 4% for average dividend return. The corresponding figures for the S&P composite are about the same. These combined figures of 8%. This is one of Graham's rare misjudgments. In 1973, just 2 years after President Richard Nixon imposed wage and price controls, inflation hit 8.7%, its highest level since the end of World War II. The decade from 1973 through 1982 was the most inflationary in modern American history, as the cost of living more than doubled per year are of course much better than the return enjoyed from bonds over the same 55-year period. But they do not exceed that now offered by high-grade bonds. This brings us to the next logical question: is there a persuasive reason to believe that common stocks are likely to do much better in future years than they have in the last 5.5 decades? Our answer to this crucial question must be a flat no. Common stocks may do better in the future than in the past, but they are far from certain to do so. We must deal here with two different time elements in investment results. The first covers what is likely to occur over the long-term future, say, the next 25 years. The second applies to what is likely to happen to the investor both financially and psychologically over short or intermediate periods, say 5 years or less. His frame of mind, his hopes and apprehensions, his satisfaction or discontent with what he has done, above all his decisions what to do next, are all determined not in the retrospect of a lifetime of investment but rather by his experience from year to year. On this point we can be categorical. There is no close time connection between inflationary, or deflationary, conditions and the movement of common stock earnings and prices. The obvious example is the recent period, 1966–1970. The rise in the cost of living was 22%, the largest in a 5-year period since 1946-1950. But both stock earnings and stock prices as a whole have declined since 1965. There are similar contradictions in both directions in the record of previous 5-year periods. Inflation and corporate earnings. Another and highly important approach to the subject is by a study of the earnings rate on capital shown by American business. This has fluctuated, of course, with the general rate of economic activity, but it has shown no general tendency to advance with wholesale prices or the cost of living. Actually, this rate has fallen rather markedly in the past 20 years in spite of the inflation of the period. To some degree the decline was due to the charging of more liberal depreciation rates. See Table 2-2. Our extended studies have led to the conclusion that the investor cannot count on much above the recent 5-year rate earned on the DJIA Group. About 10% on net tangible assets, book value, behind the shares. Point 2. Since the market value of these issues is well above their book value, say, 900 market versus 560 book in mid-1971, the earnings on current market price work out only at some 6.4%. This relationship is generally expressed in the reverse, or times earnings manner, e.g., that the DJIA price of 900 equals 18 times the actual earnings for the 12 months ended June 1971. Our figures gear indirectly with the suggestion in the previous chapter * that the investor may assume an average dividend return of about 3.5% on the market value of his stocks, plus an appreciation of, say, 4% annually resulting from reinvested profits. Note that each dollar added to book value is here assumed to increase the market price by about $1.60. The reader will object that in the end our calculations make no allowance for an increase in common stock earnings and values to result from our projected 3% annual inflation. Our justification is the absence of any sign that the inflation of a comparable amount in the past has had any direct effect on reported per-share earnings. The cold figures demonstrate that all the large gain in the earnings of the DJIA unit in the past 20 years was due to a proportionately large growth of invested capital coming from reinvested profits. If inflation had operated as a separate favorable factor, its effect would have been to increase the value of previously existing capital. This in turn should increase the rate of earnings on such old capital and therefore on the old and new capital combined. But nothing of the kind actually happened in the past 20 years, during which the wholesale price level has advanced nearly 40%. Business earnings should be influenced more by wholesale prices than by consumer prices. The only way that inflation can add to common stock values is by raising the rate of earnings on capital investment. On the basis of the past record, this has not been the case. In the economic cycles of the past, good business was accompanied by a rising price level and poor business by falling prices. It was generally felt that a little inflation was helpful to business profits. This view is not contradicted by the history of 1950–1970, which reveals a combination of generally continued prosperity and generally rising prices. But the figures indicate that the effect of all this on the earning power of common stock capital, equity capital, has been quite limited. In fact, it has not even served to maintain the rate of earnings on the investment. Clearly there have been important offsetting influences which have prevented any increase in the real profitability of American corporations as a whole. Perhaps the most important of these have been, 1. A rise in wage rates exceeding the gains in productivity, and, 2. The need for huge amounts of new capital, thus holding down the ratio of sales to capital employed. Our figures in Table 2-2 indicate that so far from inflation having benefited our corporations and their shareholders, its effect has been quite the opposite. The most striking figures in our table are those for the growth of corporate debt between 1950 and 1969. It is surprising how little attention has been paid by economists and by Wall Street to this development. The debt of corporations has expanded nearly fivefold while their profits before taxes a little more than doubled. With the great rise in interest rates during this period, it is evident that the aggregate corporate debt is now in earnings of Standard & Poor's Industrial Index divided by average book value for year. B. Figures for 1950 and 1955 from Cottle and Whitman, those for 1960 and 1969 from Fortune. Adverse economic factor of some magnitude and a real problem for many individual enterprises. Note that in 1950 net earnings after interest but before income tax were about 30% of corporate debt, while in 1969 they were only 13.2% of debt. The 1970 ratio must have been even less satisfactory. In sum, it appears that a significant part of the 11% being earned on corporate equities as a whole is accomplished by the use of a large amount of new debt costing 4% or less after tax credit. If our corporations had maintained a debt ratio of 1950, their earnings rate on stock capital would have fallen still lower, in spite of the inflation. The stock market has considered that the public utility enterprises have been a chief victim of inflation, being caught between a great advance in the cost of borrowed money and the difficulty of raising the rates charged under the regulatory process. But this may be the place to remark that the very fact that the unit costs of electricity, gas, and telephone services have advanced so much less than the general price index puts these companies in a strong strategic position for the future. Point 3. They are entitled by law to charge rates sufficient for an adequate return on their invested capital, and this will probably protect their shareholders in the future as it has in the inflations of the past. All of the above brings us back to our conclusion that the investor has no sound basis for expecting more than an average overall return of, say, 8% on a portfolio of DJIA-type common stocks purchased at the late 1971 price level. But even if these expectations should prove to be understated by a substantial amount, the case would not be made for an all-stock investment program. If there is one thing guaranteed for the future, it is that the earnings and average annual market value of a stock portfolio will not grow at the uniform rate of 4%, or any other figure. In the memorable words of the elder J.P. Morgan, they will fluctuate. This means, first, that the common stock buyer at today's price John Pierpont Morgan was the most powerful financier of the late 19th and early 20th centuries. Because of his vast influence, he was constantly asked what the stock market would do next. Morgan developed a mercifully short and unfailingly accurate answer: it will fluctuate. See Gene Strauss, Morgan, American Financier, Random House, 1999. Or tomorrow SA will be running a real risk of having unsatisfactory results therefrom over a period of years. It took 25 years for General Electric, and the DJIA itself, to recover the ground lost in the 1929 1932 debacle. Besides that, if the investor concentrates his portfolio on common stocks, he is very likely to be led astray either by exhilarating advances or by distressing declines. This is particularly true if his reasoning is geared closely to expectations of further inflation. For then, if another bull market comes along, he will take the big rise not as a danger signal of an inevitable fall, not as a chance to cash in on his handsome profits, but rather as a vindication of the inflation hypothesis and as a reason to keep on buying common stocks no matter how high the market level nor how low the dividend return. That way lies sorrow. Alternatives to common stocks as inflation hedges. The standard policy of people all over the world who mistrust their currency has been to buy and hold gold. This has been against the law for American citizens since 1935. Luckily for them, in the past 35 years the price of gold in the open market has advanced from $35 per ounce to $48 in early 1972, a rise of only 35%. But during all this time the holder of gold has received no income return on his capital, and instead has incurred some annual expense for storage. Obviously, he would have done much better with his money at interest in a savings bank, in spite of the rise in the general price level. The near-complete failure of gold to protect against a loss in the purchasing power of the dollar must cast grave doubt on the ability of the ordinary investor to protect himself against inflation by putting his money in things. Quite a few categories of valuable. The investment philosopher Peter L. Bernstein feels that Graham was dead wrong about precious metals, particularly gold, which, at least in the years after Graham wrote this chapter, has shown a robust ability to outpace inflation. Financial advisor William Bernstein agrees, pointing out that a tiny allocation to a precious metals fund, say, 2% of your total assets, is too small to hurt your overall returns when gold does poorly. But, when gold does well, its returns are often so spectacular as sometimes exceeding 100%. Objects have had striking advances in market value over the years, such as diamonds, paintings by masters, first editions of books, rare stamps, and coins, etc. But in many, perhaps most, of these cases there seems to be an element of the artificial or the precarious or even the unreal about the quoted prices. Somehow it is hard to think of paying $67,500 for a US silver dollar dated 1804, but not even minted that year, as an investment operation. For we acknowledge we are out of our depth in this area. Very few of our readers will find the swimming safe and easy there. The outright ownership of real estate has long been considered as a sound long-term investment, carrying with it a goodly amount of protection against inflation. Unfortunately, real estate values are also subject to wide fluctuations. Serious errors can be made in location, price paid, etc. There are pitfalls in salesmen's wiles. Finally, diversification is not practical for the investor of moderate means, except by various types of participations with others and with the special hazards that attach to new flotation saw not too different from common stock ownership. This too is not our field. All we should say to the investor is, be sure it's yours before you go into it. Conclusion. Naturally, we return to the policy recommended in our previous chapter. Just because of the uncertainties of the future, the investor cannot afford to put all his funds into one basket and neither in the bond basket, despite the unprecedentedly high returns that bonds have recently offered, nor in the stock basket, despite the prospect of continuing inflation. The more the investor depends on his portfolio and the income therefrom, the more necessary it is for him to guard against the in a year that it can, all by itself, set an otherwise lackluster portfolio glittering. However, the intelligent investor avoids investing in gold directly, with its high storage and insurance costs. Instead, seek out a well-diversified mutual fund specializing in the stocks of precious metal companies and charging below 1% in annual expenses. Limit your stake to 2% of your total financial assets, or perhaps 5% if you are over the age of 65. Unexpected and the disconcerting in this part of his life. It is axiomatic that the conservative investor should seek to minimize his risks. We think strongly that the risks involved in buying, say, a telephone company bond at yields of nearly 7.5% are much less than those involved in buying the DJIA at 900, or any stock list equivalent thereto. But the possibility of large-scale inflation remains, and the investor must carry some insurance against it. There is no certainty that a stock component will insure adequately against such inflation, but it should carry more protection than the bond component. This is what we said on the subject in our 1965 edition, p. 97. And we would write the same today. It must be evident to the reader that we have no enthusiasm for common stocks at these levels, 892 for the DJIA. For reasons already given, we feel that the defensive investor cannot afford to be without an appreciable proportion of common stocks in his portfolio, even if we regard them as the lesser of two evils, the greater being the risks in an all-bond holding. Commentary on Chapter 2. Americans are getting stronger. 20 years ago, it took two people to carry $10 worth of groceries. Today, a 5-year-old can do it. A Henny Youngman. Inflation. Who cares about that? After all, the annual rise in the cost of goods and services averaged less than 2.2% between 1997 and 2002, and economists believe that even that rock-bottom rate may be overstated. 1. Think, for instance, of how the prices of computers and home electronics have plummeted and how the quality of many goods has risen, meaning that consumers are getting better value for their money. In recent years, the true rate of inflation in the United States has probably run around 1% annually, an increase so infinitesimal that many pundits have proclaimed that inflation is dead. 2. The U.S. Bureau of Labor Statistics, which calculates the consumer price index that measures inflation, maintains a comprehensive and helpful website at www.bls.gov. For a lively discussion of the inflation is dead scenario, see www.pbs. In 1996, the Boskin Commission, a group of economists asked by the government to investigate whether the official rate of inflation is accurate, estimated that it has been overstated, often by nearly 2 percentage points per year. For the Commission's report, see www.ssa.gov. Many investment experts now feel that deflation, or falling prices, is an even greater threat than inflation. The best way to hedge against that risk is by including bonds as a permanent component of your portfolio. See the commentary on Chapter 4. Commentary on Chapter 2. The money illusion. There's another reason investors overlook the importance of inflation. What psychologists call the money illusion. If you receive a 2% raise in a year when inflation runs at 4%, you will almost certainly feel better than you will if you take a 2% pay cut during a year when inflation is 0. Yet both changes in your salary leave you in a virtually identical position, 2% worse off after inflation. So long as the nominal, or absolute, change is positive, we view it as a good thing, even if the real, or after inflation, result is negative. And any change in your own salary is more vivid and specific than the generalized change of prices. In the economy as a whole. 3 Likewise, investors were delighted to earn 11% on bank certificates of deposit, CDs, in 1980 and are bitterly disappointed to be earning only around 2% in 2003, even though they were losing money after inflation back then but are keeping up with inflation now. The nominal rate we earn is printed in the bank's ads and posted in its window, where a high number makes us feel good. But inflation eats away at that high number in secret. Instead of taking out ads, inflation just takes away our wealth. That's why inflation is so easy to overlook and why it's so important to measure your investing success not just by what you make, but by how much you keep after inflation. More basically still, the intelligent investor must always be on guard against whatever is unexpected and underestimated. There are 3 good reasons to believe that inflation is not dead. As recently as 1982, the United States went through one of the most painful bursts of inflation in our history. As measured by the Consumer Price Index, prices more than doubled over that period, rising at an annualized rate of nearly 9%. In 1979 alone, inflation raged at 13.3%, paralyzing the economy in what became known as stagflation and leading many commentators to question whether America could compete in the global market. For more insights into this behavioral pitfall, see Eldar Schaefer, Peter Diamond, and Amos Tversky, Money Illusion, in Daniel Kahneman and Amos Tversky, eds, Choices, Values, and Frames, Cambridge University Press. 2000, pages 335-355. Place point for goods and services priced at $100 in the beginning of 1973 cost $230 by the end of 1982, shriveling the value of $1 to less than 45 cents. No one who lived through it would scoff at such destruction of wealth. No one who is prudent can fail to protect against the risk that it might recur. Since 1960, 69% of the world's market-oriented countries have suffered at least one year in which inflation ran at an annualized rate of 25% or more. On average, those inflationary periods destroyed 53% of an investor's purchasing power. 5 We would be crazy not to hope that America is somehow exempt from such a disaster. But we would be even crazier to conclude that it can never happen here. 6. Rising prices allow Uncle Sam to pay off his debts with dollars that have been cheapened by inflation, completely eradicating inflation runs against the economic self-interest of any government that regularly borrows money. 7. That year, President Jimmy Carter gave his famous malaise speech, in which he warned of a crisis in confidence that strikes at the very heart and soul and spirit of our national will and threatens to destroy the social and the political fabric of America. See Stanley Fischer, Ratna Sahai, and Carlos A. Zweig, Modern Hype and High Inflations, National Bureau of Economic Research, Working Paper 8930, at www.northbyestar.org. In fact, the United States has had 2 periods of hyperinflation. During the American Revolution, prices roughly tripled every year from 1777 through 1779, with a pound of butter costing $12 and a barrel of flour fetching nearly $1,600 in revolutionary Massachusetts. During the Civil War, inflation raged at annual rates of 29% in the North, and nearly 200% in the Confederacy. As recently as 1946, inflation hit 18.1% in the United States. I am indebted to Lawrence Siegel of the Ford Foundation for this cynical but accurate insight. Conversely, in a time of deflation, or steadily falling prices, it's more advantageous to be a lender than a borrower, which is why most investors should keep at least a small portion of their assets in bonds, as a form of insurance against deflating prices. Commentary on Chapter 2. Half a hedge. What, then, can the intelligent investor do to guard against inflation? The standard answer is buy stocks A, but, as common answers so often are, it is not entirely true. Figure 2:1 shows, for each year from 1926 through 2002, the relationship between inflation and stock prices. As you can see, in years when the prices of consumer goods and services fell, as on the left side of the graph, stock returns were terrible, with the market losing up to 43% of its value. 8 When inflation shot above 6%, as in the years on the right end of the graph, stocks also stank. The stock market lost money in 8 of the 14 years in which inflation exceeded 6%, the average return for those 14 years was a measly 2.6%. While mild inflation allows companies to pass the increased costs of their own raw materials onto customers, high inflation wreaks havoc, forcing customers to slash their purchases and depressing activity throughout the economy. The historical evidence is clear. Since the advent of accurate stock market data in 1926, there have been 64 5-year periods, i.e., 1926A 1930, 1927A 1931, 1928A 1932, and so on through 1998A 2002. In 50 of those 64 5-year periods, or 78% of the time, stocks outpaced inflation. 9 That's impressive, but imperfect. It means that stocks failed to keep up with inflation about 1/5 of the time. When inflation is negative, it is technically termed deflation. Regularly falling prices may at first sound appealing, until you think of the Japanese example. Prices have been deflating in Japan since 1989, with real estate and the stock market dropping in value year after year, a relentless water torture for the world's second largest economy. 9. Ibbotson Associates, Stocks, Bonds, Bills, and Inflation, 2003 Handbook. Ibbotson Associates, Chicago, 2003, Table 2-8. The same pattern is evident outside the United States, in Belgium, Italy, and Germany, where inflation was especially high in the 20th century. Inflation appears to have had a negative impact on both stock and bond markets, note Elroy Dimson, Paul Marsh, and Mike Stanton in Triumph of the Optimists, 101 Years of Global Investment Returns, Princeton University Press, 2002, p. 53. How well do stocks hedge against inflation? Inflation. Return on stocks. Source, Ibbotson Associates. This graph shows inflation and stock returns for each year between 1926 and 2002, arrayed not in chronological order but from the lowest annual inflation rates to the highest. When inflation is highly negative, see far left, stocks do very poorly. When inflation is moderate, as it was in most years during this period, stocks generally do well. But when inflation heats up to very high levels, see far right, stocks perform erratically, often losing at least 10%. Total return on stocks and rate of inflation, percent. Commentary on Chapter 2. 63. 2 Acronym S to THERESEUE. Fortunately, you can bolster your defenses against inflation by branching out beyond stocks. Since Graham last wrote, 2 inflation fighters have become widely available to investors. REITs. Real estate investment trusts, or REITs, pronounced REITs, are companies that own and collect rent from commercial and residential properties. 10 Bundled into real estate mutual funds. REITs do a decent job of combating inflation. The best choice is Vanguard REIT Index Fund. Other relatively low-cost choices include Cohen & Steers Realty Shares, Columbia Real Estate Equity Fund, and Fidelity Real Estate Investment Fund. 11 While a REIT fund is unlikely to be a foolproof inflation fighter, in the long run it should give you some defense against the erosion of purchasing power without hampering your overall returns. Tips. Treasury Inflation Protected Securities, or TIPS, are U.S. government bonds, first issued in 1997, that automatically go up in value when inflation rises. Because the full faith and credit of the United States stands behind them, all Treasury bonds are safe from the risk of default, or non-payment of interest. But TIPS also guarantee that the value of your investment won't be eroded by inflation. In one easy package, you insure yourself against financial loss and the loss of purchasing power. Point 12. There is one catch, however. When the value of your TIPS bond rises as inflation heats up, the Internal Revenue Service regards that increase in value as taxable income, even though it is purely a paper. Thorough, if sometimes outdated, information on rights can be found at www.naright.com. The case for investing in a right fund is weaker if you own a home, since that gives you an inherent stake in real estate ownership. A good introduction to TIPS can be found at www.publicdebt.trees.gov. Why does this make sense to the IRS? The intelligent investor will remember the wise words of financial analyst Mark Schweber: the one question never to ask a bureaucrat is a why. Because of this exasperating tax complication, TIPS are best suited for a tax-deferred retirement account like an IRA, KIA, or 401k, where they will not jack up your taxable income. You can buy TIPS directly from the U.S. government at www.publicdebt.trees.gov, or in a low-cost mutual fund like Vanguard Inflation Protected Securities or Fidelity Inflation Protected Bond Fund. Point 13. Either directly or through a fund, TIPS are the ideal substitute for the proportion of your retirement funds you would otherwise keep in cash. Do not trade them. TIPS can be volatile in the short run, so they work best as a permanent, lifelong holding. For most investors, allocating at least 10% of your retirement assets to TIPS is an intelligent way to keep a portion of your money absolutely safe and entirely beyond the reach of the long, invisible claws of inflation. Chapter 3. A Century of Stock Market History. The level of stock prices in early 1972. The investor's portfolio of common stocks will represent a small cross-section of that immense and formidable institution known as the stock market. Prudence suggests that he have an adequate idea of stock market history, in terms particularly of the major fluctuations in its price level and of the varying relationships between stock prices as a whole and their earnings and dividends. With this background, he may be in a position to form some worthwhile judgment of the attractiveness or dangers of the level of the market, as it presents itself at different times. By a coincidence, useful statistical data on prices, earnings, and dividends go back just 100 years, to 1871. The material is not nearly as full or dependable in the first half period as in the second, but it will serve. In this chapter we shall present the figures, in highly condensed form, with two objects in view. The first is to show the general manner in which stocks have made their underlying advance through the many cycles of the past century. The second is to view the picture in terms of successive 10-year averages, not only of stock prices, but of earnings and dividends as well, to bring out the varying relationship between the three important factors. With this wealth of material as a background, we shall pass to a consideration of the level of stock prices at the beginning of 1972. The long-term history of the stock market is summarized in two tables and a chart. Table 3-1 sets forth the low and high points of 19 bear and bull market cycles in the past 100 years. We have used two indexes here. The first represents a combination of an early study by the Cowles Commission going back to 1870, which has been spliced onto and continued to date in the WELL 65. A Century of Stock Market History. Known Standard & Poor's Composite Index of 500 stocks. The second is the even more celebrated Dow Jones Industrial Average, the DJIA, or the Dow, which dates back to 1897. It contains 30 companies, of which one is American Telephone and Telegraph, and the other 29 are large industrial enterprises. Point 1. Chart I, presented by courtesy of Standard & Poor's, depicts the market fluctuations of its 425 industrial stock index from 1900 through 1970. A corresponding chart available for the DJIA will look very much the same. The reader will note three quite distinct patterns, each covering about a third of the 70 years. The first runs from 1900 to 1924, and shows for the most part a series of rather similar market cycles lasting from 3 to 5 years. The annual advance in this period averaged just about 3%. We move on to the new era bull market, culminating in 1929, with its terrible aftermath of collapse, followed by quite irregular fluctuations until 1949. Comparing the average level of 1949 with that of 1924, we find the annual rate of advance to be a mere 1.5%, hence the close of our second period found the public with no enthusiasm at all for common stocks. By the rule of opposites, the time was ripe for the beginning of the greatest bull market in our history, presented in the last third of our chart. This phenomenon may have reached its culmination in December 1968 at 118 for Standard & Poor's 425 Industrials, and 108 for its 500 stock composite. As Table 3:1 shows, there were fairly important setbacks between 1949 and 1968. Especially in 1956A57 and 1961A62, but the recoveries therefrom were so rapid that they had to be denominated, in the long accepted semantics, as recessions in a single bull market, rather than as separate market cycles. Between the low level of 162 for the Dow in mid-1949 and the high of 995 in early 1966, the advance had been more than six-fold in 17 years, so which is at the average compounded rate of 11% per year, not counting dividends, of, say, 3.5% per annum. The advance for the Standard & Poor's Composite Index was somewhat greater than that of the GIA, actually from 14 to 96. These 14% and better returns were documented in 1963, and later, in a much publicized study *2, it created a natural satisfaction. *, the study, in its final form, was Lawrence Fisher and James H. Lowry. Rates of return on investments in common stock, the year by year. Chart 1. A Century of Stock Market History. On Wall Street, with such fine achievements, and a quite illogical and dangerous conviction that equally marvelous results could be expected for common stocks in the future, few people seem to have been bothered by the thought that the very extent of the rise might indicate that it had been overdone. The subsequent decline from the 1968 high to the 1970 low was 36% for the Standard & Poor's Composite, and 37% for the DJIA, the largest since the 44% suffered in 1939A 1942, which had reflected the perils and uncertainties after Pearl Harbor. In the dramatic manner so characteristic of Wall Street, the low level of May 1970 was followed by a massive and speedy recovery of both averages, and the establishment of a new all-time high for the Standard & Poor's Industrials in early 1972. The annual rate of price advance between 1949 and 1970 works out at about 9% for the S&P Composite, or the Industrial Index, using the average figures for both years. That rate of climb was, of course, much greater than for any similar period before 1950. But in the last decade the rate of advance was much lower of 5.14% for the S&P Composite Index and only the once familiar 3% for the DJIA. The record of price movements should be supplemented by corresponding figures for earnings and dividends, in order to provide an overall view of what has happened to our share economy over the 10 decades. We present a conspectus of this kind in our table 3-2, p. 71. It is a good deal to expect from the reader that he study all these figures with care, but for some we hope they will be interesting and instructive. Let us comment on them as follows: the full decade figures smooth out the year-to-year fluctuations and leave a general picture of persistent growth. Only 2 of the 9 decades after the first show a decrease in earnings and average prices, in 1891-1900 and 1931-1940, and no decade after 1900 shows a decrease in average dividends. But the rates of growth in all 3 categories are quite variable. In general, the performance since World War II has been superior to that of earlier decades, but the advance in the 1960s was less pronounced than that of the 1950s. Today's Investor Record, 1926A65, The Journal of Business, Vol. XLI, Number 3, July, 1968. Pages 291A316. For a summary of the study's wide influence, see http://library.dfos.com. Cannot tell from this record what percentage gain in earnings, dividends and prices he may expect in the next 10 years, but it does supply all the encouragement he needs for a consistent policy of common stock investment. However, a point should be made here that is not disclosed in our table. The year 1970 was marked by a definite deterioration in the overall earnings posture of our corporations. The rate of profit on invested capital fell to the lowest percentage since the World War years. Equally striking is the fact that a considerable number of companies reported net losses for the year. Many became financially troubled, and for the first time in 3 decades there were quite a few important bankruptcy proceedings. These facts, as much as any others, have prompted the statement made above asterisk that the Great Boom era may have come to an end in 1969-1970. A striking feature of Table 3-2 is the change in the price/earnings ratios since World War II. In June 1949 the S&P Composite Index sold at only 6.3 times the applicable earnings of the past 12 months. In March 1961 the ratio was 22.9 times. Similarly, the dividend yield on the S&P index had fallen from over 7% in 1949 to only 3.0% in 1961, a contrast heightened by the fact that interest rates on high-grade bonds had meanwhile risen from 2.60% to 4.50%. This is certainly the most remarkable turnabout in the public's attitude in all stock market history. To people of long experience and innate caution the passage from one extreme to another carried a strong warning of trouble ahead. They could not help thinking apprehensively of the 1926-1929 bull market and its tragic aftermath. But these fears have not been confirmed by the event. True, the closing price of the DJIA, the price/earnings ratio of a stock, or of a market average like the S&P 500 stock index, is a simple tool for taking the market's temperature. If, for instance, a company earned $1 per share of net income over the past year, and its stock is selling at $8.93 per share, its price/earnings ratio would be 8.93, if, however, the stock is selling at $69.70, then the price/earnings ratio would be 69.7. In general, a price/earnings ratio, or P/E ratio, below 10 is considered low, between 10 and 20 is considered moderate, and greater than 20 is considered expensive. For more on P/E ratios, see P 168. Annual growth rate tab. Earnings. Dividends. The annual growth rate figures are Molodovsky compilations covering successive 21-year periods ending in 1890, 1900, etc. Growth rate for 1968A 1970 versus 1958A 1960. These growth rate figures are for 1954A 1956 versus 1947A 1949, 1961A 1963 versus 1954A 1956, and for 1968A 1970 versus 1958A 1960. The following data based largely on figures appearing in N. Molodovsky's article, Stock Values and Stock Prices, Financial Analyst's Journal. May 1960. These, in turn, are taken from the Cowles Commission book Common Stock Indexes for years before 1926 and from the spliced-on Standard & Poor's 500 Stock Composite Index for 1926 to date. In 1970 was the same as it was 6.5 years earlier, and the much heralded soaring 60s proved to be mainly a march up a series of high hills and then down again. But nothing has happened either to business or to stock prices that can compare with the bear market and depression of 1929A 1932. The stock market level in early 1972. With a century-long conspectus of stock, prices, earnings, and dividends before our eyes, let us try to draw some conclusions. About the level of 900 for the DJIA and 100 for the S&P Composite Index in January 1972. In each of our former editions we have discussed the level of the stock market at the time of writing, and endeavored to answer the question whether it was too high for conservative purchase. The reader may find it informing to review the conclusions we reached on these earlier occasions. This is not entirely an exercise in self-punishment. It will supply a sort of connecting tissue that links the various stages of the stock market in the past 20 years and also a taken-from-life picture of the difficulties facing anyone who tries to reach an informed and critical judgment of current market levels. Let us, first, reproduce the summary of the 1948, 1953, and 1959 analyses that we gave in the 1965 edition. In 1948 we applied conservative standards to the Dow Jones level of 180, and found no difficulty in reaching the conclusion that it was not too high in relation to underlying values. When we approached this problem in 1953, the average market level for that year had reached 275, a gain of over 50% in 5 years. We asked ourselves the same question, namely, whether in our opinion the level of 275 for the Dow Jones Industrials was or was not too high for sound investment. In the light of the subsequent spectacular advance, it may seem strange to have to report that it was by no means easy for us to reach a definitive conclusion as to the attractiveness of the 1953 level. We did say, positively enough, that from the standpoint of value indication saw our chief investment idea the conclusion about 1953 stock prices must be favorable. But we were concerned about the fact that in 1953, the averages had advanced for a longer period than in most bull markets of a century of stock market history past, and that its absolute level was historically high. Setting these factors against our favorable value judgment, we advised a cautious or compromise policy. As it turned out, This was not a particularly brilliant counsel. A good prophet would have foreseen that the market level was due to advance an additional 100% in the next 5 years. Perhaps we should add in self-defense that few, if any, of those whose business was stock market forecasting as ours was known to had any better inkling than we did of what lay ahead. At the beginning of 1959 we found the DJIA at an all-time high of 584. Our lengthy analysis made from all points of view may be summarized in the following, from page 59 of the 1959 edition. In sum, we feel compelled to express the conclusion that the present level of stock prices is a dangerous one. It may well be perilous, because prices are already far too high. But even if this is not the case, the market's momentum is such as inevitably to carry it to unjustifiable heights. Frankly, we cannot imagine a market of the future in which there will never be any serious losses, and in which every tyro will be guaranteed a large profit on his stock purchases. The caution we expressed in 1959 was somewhat better justified by the sequel than was our corresponding attitude in 1954. Yet, it was far from fully vindicated. The DJIA advanced to 685 in 1961. Then fell a little below our 584 level, to 566, later in the year. Advanced again to 735 in late 1961, and then declined in near panic to 536 in May 1962, showing a loss of 27% within the brief period of 6 months. At the same time there was a far more serious shrinkage in the most popular growth stocks, as evidenced by the striking fall of the indisputable leader, international business machines, from a high of 607 in December 1961 to a low of 300 in June 1962. This period saw a complete debacle in a host of newly launched common stocks of small enterprise, so the so-called hot issue ESA, which had been offered to the public at ridiculously high prices, and then had been further pushed up by needless speculation to levels little short of insane. Many of these lost 90% and more of the quotations in just a few months. The collapse in the first half of 1962 was disconcerting, if not disastrous, to many self-acknowledged speculators and perhaps to many more imprudent people who called themselves investors. But the turnabout that came later that year was equally unsuspected by the financial community. The stock market averages resumed their upward course, producing the following sequence. The recovery and new ascent of common stock prices was indeed remarkable and created a corresponding revision of Wall Street sentiment. At the low level of June 1962, predictions had appeared predominantly bearish, and after the partial recovery to the end of that year they were mixed, leaning to the skeptical side. But at the outset of 1964 the natural optimism of brokerage firms was again manifest. Nearly all the forecasts were on the bullish side, and they so continued through the 1964 advance. We then approached the task of appraising the November 1964 levels of the stock market, 892 for the DJIA. After discussing it learnedly from numerous angles, we reached three main conclusions. The first was that old standards of valuation appear inapplicable, new standards have not yet been tested by time. The second was that the investor must base his policy on the existence of major uncertainties. The possibilities compass the extremes, on the one hand, of a protracted and further advance in the market's level, say by 50%, or to 1,350 for the DJIA, or, on the other hand, of a largely unheralded collapse of the same magnitude, bringing the average in the neighborhood of, say, 450. p. 63. The third was expressed in much more definite terms. We said, speaking bluntly, if the 1964 price level is not too high, how could we say that any price level is too high? And the chapter closed as follows. A century of stock market history. What course to follow? Investors should not conclude that the 1964 market level is dangerous merely because they read it in this book. They must weigh our reasoning against the contrary reasoning they will hear from most competent and experienced people on Wall Street. In the end, each one must make his own decision and accept responsibility. Therefore, we suggest, however, that if the investor is in doubt as to which course to pursue, he should choose the path of caution. The principles of investment, as set forth herein, would call for the following policy under 1964 conditions, in order of urgency. 1. No borrowing to buy or hold securities. 2. No increase in the proportion of funds held in common stocks. 3. A reduction in common stock holdings where needed to bring it down to a maximum of 50% of the total portfolio. The capital gains tax must be paid with as good grace as possible, and the proceeds invested in first-quality bonds or held as a savings deposit. Investors who for some time have been following a bona fide dollar cost averaging plan can in logic elect either to continue their periodic purchases unchanged or to suspend them until they feel the market level is no longer dangerous. We should advise rather strongly against the initiation of a new dollar averaging plan at the late 1964 levels, since many investors would not have the stamina to pursue such a scheme if the results soon after initiation should appear highly unfavorable. This time we can say that our caution was vindicated. The DJIA advanced about 11% further, to 995, but then fell irregularly to a low of 632 in 1970, and finished that year at 839. The same kind of debacle took place in the price of hot issues AIE, with declines running as much as 90% as had happened in the 1961A62 setback. And, as pointed out in the introduction, the whole financial picture appeared to have changed in the direction of less enthusiasm and greater doubts. A single fact may summarize the story. The DJIA closed 1970 at a level lower than 6 years before the first time such a thing had happened since 1944. Such were our efforts to evaluate former stock market levels. Is there anything we and our readers can learn from them? We considered the market level favorable for investment in 1948 and 1953. But too cautiously in the latter year, dangerous in 1959, at 584 for DJIA, and too high, at 892, in 1964. All of these judgments could be defended even today by adroit arguments. But it is doubtful if they have been as useful as our more pedestrian counsel saw in favor of a consistent and controlled common stock policy on the one hand, and discouraging endeavors to beat the market or to pick the winners on the other. Nonetheless, we think our readers may derive some benefit from a renewed consideration of the level of the stock market at this time. As of late 1971A, even if what we have to say will prove more interesting than practically useful, or more indicative than conclusive, there is a fine passage near the beginning of Aristotle's Ethics that goes, "It is the mark of an educated mind to expect that amount of exactness which the nature of the particular subject admits. It is equally unreasonable to accept merely probable conclusions from a mathematician and to demand strict demonstration from an orator. The work of a financial analyst falls somewhere in the middle, between that of a mathematician and of an orator." At various times in 1971 the Dow Jones Industrial Average stood at the 892 level of November 1964 that we considered in our previous edition. but in the present statistical study we have decided to use the price level and the related data for the Standard & Poor's Composite Index, or S&P 500, because it is more comprehensive and representative of the general market than the 30-stock DJIA. We shall concentrate on a comparison of this material near the four dates of our former edition saw, namely the year ends of 1948, 1953, 1958 and 19638 plus 1968. For the current price level we shall take the convenient figure of 100, which was registered at various times in 1971 and in early 1972. The salient data are set forth in Table 3-3. For our earnings figures we present both the last year's showing and the average of 3 calendar years. For 1971 dividends we use the last 12 months figures, and for 1971 bond interest and wholesale prices those of August 1971. The 3-year price/earnings ratio for the market was lower in October 1971 than at year-end 1963 and 1968. It was about the same as in 1958, but much higher than in the early years of the long bull market. This important indicator, taken by itself, could not be construed to indicate that the market was especially high in January 1972, but when the interest yield on high-grade bonds is brought into the picture, the implications become much less favorable. The reader will note from our table that the ratio of stock returns, earnings/price, to bond returns has grown worse during the entire period, so that the January 1972 figure was less favorable to stocks by this criterion than in any of the previous years examined. When dividend yields are compared with bond yields we find that the relationship was completely reversed between 1948 and 1972. In the early year stocks yielded twice as much as bonds. Now bonds yield twice as much, and more, than stocks. Our final judgment is that the adverse change in the bond yield/stock yield ratio fully offsets the better price/earnings ratio for late 1971, based on the 3-year earnings figures. Hence our view of the early 1972 market level would tend to be the same as it was some 7 years ago, i.e., that it is an unattractive one from the standpoint of conservative investment. This would apply to most of the 1971 price range of the DJIA, between, say, 800 and 950. In terms of historical market swings, the 1971 picture would still appear to be one of irregular recovery from the bad setback suffered in 1969A 1970. In the past, such recoveries have ushered in a new stage of the recurrent and persistent bull market that began in 1949. This was the expectation of Wall Street generally during 1971, after the terrible experience suffered by the public buyers of low-grade common stock offerings in the 1968A 1970 cycle. It is too early, in 1971, for another twirl of the new issue merry-go-round. Hence that dependable sign of imminent danger in the market is lacking now, as it was at the 892 level of the DJIA in November 1964, considered in our previous edition. Technically, then, the outlook would appear to favor another substantial rise far beyond the 900 DJIA level before the next serious setback or collapse. But we cannot quite leave the matter there, as perhaps we should. To us, the early 1971 market's disregard of the harrowing experiences of less than a year before is a disquieting sign. Can such heedlessness go unpunished? We think the investor must be prepared for difficult times ahead of, perhaps in the form of a fairly quick replay of the 1969A 1970 decline, or perhaps in the form of another bull market fling, to be followed by a more catastrophic collapse. Point 3. A century of stock market history. What course to follow? Turn back to what we said in the last edition, reproduced on p75. This is our view at the same price level as say 900A for the DJIA in early 1972 as it was in late 1964. Commentary on Chapter 3. You've got to be careful if you don't know where you're going. 'Cause you might not get there. A. Yogi Berra. Bull Market Baloney. In this chapter, Graham shows how prophetic he can be. He looks 2 years ahead, foreseeing the catastrophic bear market of 1973 a 1974, in which U.S. stocks lost 37% of their value. 1 He also looks more than 2 decades into the future, eviscerating the logic of market gurus and best-selling books that were not even on the horizon in his lifetime. The heart of Graham's argument is that the intelligent investor must never forecast the future exclusively by extrapolating the past. Unfortunately, that's exactly the mistake that one pundit after another made in the 1990s. A stream of bullish books followed Wharton finance professor Jeremy Siegel's Stocks for the Long Run, 1994, culminating in a wild crescendo, with James Glassman and Kevin Hassett's Dow 36,000, David Elias Dow 40,000, and Charles Cadleck's Dow 100,000, all published in 1999. Forecasters argued that stocks had returned an annual average of 7% after inflation ever since 1802. Therefore, they concluded, that's what investors should expect in the future. Some bulls went further. Since stocks had always beaten bonds over any period of at least 30 years, stocks must be less risky than bonds or even cash in the bank. And if you can eliminate all the risk of owning stocks simply by hanging on to them long enough, then why? If dividends are not included, stocks fell 47.8% in those 2 years. Commentary on Chapter 3. Quibble over how much you pay for them in the first place? To find out why, see the sidebar on p82. In 1999 and early 2000, bull market baloney was everywhere. On December 7, 1999, Kevin Landis, portfolio manager of the first-hand mutual funds, appeared on CNN's Moneyline telecast. Asked if wireless telecommunication stocks were overvalued, with many trading at infinite multiples of their earnings, Landis had a ready answer. It's not a mania, he shot back. Look at the outright growth, the absolute value of the growth. It's big. On January 18, 2000, Robert Froelich, chief investment strategist at the Kemper Funds, declared in the Wall Street Journal, it's a new world order. We see people discard all the right companies with all the right people with the right vision because their stock price is too high. That's the worst mistake an investor can make. In the April 10, 2000, issue of Business Week, Jeffrey M. Applegate, then the chief investment strategist at Lehman Brothers, asked rhetorically, is the stock market riskier today than 2 years ago simply because prices are higher? The answer is no. But the answer is yes. It always has been. It always will be. And when Graham asked, can such heedlessness go unpunished, he knew that the eternal answer to that question is no. Like an enraged Greek god, the stock market crushed everyone who had come to believe that the high returns of the late 1990s were some kind of divine right. Just look at how those forecasts by Landis, Froelich, and Applegate held up. From 2000 through 2002, the most stable of Landis's pet wireless stocks, Nokia, lost only 67%, while the worst, Winstar Communications, lost 99.9%. Froelich's favorite stocks, Cisco Systems and Motorola, fell more than 70% by late 2002. Investors lost over $400 billion on Cisco. Alonia more than the annual economic output of Hong Kong, Israel, Kuwait, and Singapore combined. In April 2000, when Applegate asked his rhetorical question, the Dow Jones Industrial stood at 11,187, the Nasdaq Composite Index was at 4,446. By the end of 2002, the Dow was hobbling around the 8,300 level, while Nasdaq had withered to roughly 1300, eradicating all its gains over the previous 6 years. Survival of the fat test. There was a fatal flaw in the argument that stocks have always beaten bonds in the long run. Reliable figures before 1871 do not exist. The indexes used to represent the U.S. stock market's earliest returns contain as few as 7 stocks. 1 by 1800, however, there were some 300 companies in America. Many in the Jeffersonian equivalents of the Internet, wooden turnpikes and canals. Most went bankrupt, and their investors lost their knickers. But the stock indexes ignore all the companies that went bust in those early years, a problem technically known as survivorship bias. Thus these indexes wildly overstate the results earned by real-life investors who lacked the 20/20th hindsight necessary to know exactly which 7 stocks to buy. A lonely handful of companies, including Bank of New York and J.P. Morgan Chase, have prospered continuously since the 1790s. But for every such miraculous survivor, there were thousands of financial disasters like the dismal Swamp Canal Co., the Pennsylvania Cultivation of Vines Co., and the Snickers's Gap Turnpike Co., all omitted from the historical stock indexes. Jeremy Siegel's data show that, after inflation, from 1802 through 1870, stocks gained 7.0% per year, bonds 4.8%, and cash 5.1%. But Elroy Dimson and his colleagues at London Business School estimate that the pre-1871 stock returns are overstated by at least 2 percentage points per year. 2 In the real world, then, stocks did no better than cash and bonds, and perhaps a bit worse. Anyone who claims that the long-term record proves that stocks are guaranteed to outperform bonds or cash is an ignoramus. By the 1840s, these indexes had widened to include a maximum of 7 financial stocks and 27 railroad stocks, is still an absurdly unrepresentative sample of the rambunctious young American stock market. See Jason Zweig, New Cause for Caution on Stocks, Time, May 6, 2002. p. 71. As Graham hints on p. 65, even the stock indexes between 1871 and the 1920s suffer from survivorship bias, thanks to the hundreds of automobile, aviation, and radio companies that went bust without a trace. These returns, too, are probably overstated by 1 to 2 percentage points. Commentary on Chapter 3. The higher they go, the harder ll. As the enduring antidote to this kind of bull market baloney, Graham urges the intelligent investor to ask some simple, skeptical questions. Why should the future returns of stocks always be the same as their past returns? When every investor comes to believe that stocks are guaranteed to make money in the long run, won't the market end up being wildly overpriced? And once that happens, how can future returns possibly be high? Graham's answers, as always, are rooted in logic and common sense. The value of any investment is, and always must be, a function of the price you pay for it. By the late 1990s, inflation was withering away, corporate profits appeared to be booming, and most of the world was at peace. But that did not mean, nor could it ever mean, that stocks were worth buying at any price. Since the profits that companies can earn are finite, the price that investors should be willing to pay for stocks must also be finite. Think of it this way, Michael Jordan may well have been the greatest basketball player of all time, and he pulled fans into Chicago Stadium like a giant electromagnet. The Chicago Bulls got a bargain by paying Jordan up to $34 million a year to bounce a big leather ball around a wooden floor. But that does not mean the Bulls would have been justified paying him $340 million, or $3.4 billion, or $34 billion per season. The limits of optimism. Focusing on the market's recent returns when they have been rosy, warns Graham, will lead to a quite illogical and dangerous conclusion. That equally marvelous results could be expected for common stocks in the future. From 1995 through 1999, as the market rose by at least 20% each year, a surge unprecedented in American history, stock buyers became ever more optimistic. In mid-1998, investors surveyed by the Gallup organization for the Paine-Webber brokerage firm expected their portfolios to earn an average of roughly 13% over the year to come. By early 2000, their average expected return had jumped to more than 18%. Commentary on Chapter 3. Sophisticated professionals were just as bullish, jacking up their own assumptions of future returns. In 2001, for instance, SBC Communications raised the projected return on its pension plan from 8.5% to 9.5%. By 2002, the average assumed rate of return on the pension plans of companies in the Standard & Poor's 500 stock index had swollen to a record high 9.2%. A quick follow-up shows the awful aftermath of excess enthusiasm. Gallup found in 2001 and 2002 that the average expectation of one-year returns on stocks had slumped to 7%, even though investors could now buy at prices nearly 50% lower than in 2000.2. Those gung-ho assumptions about the returns on their pension plans will cost the companies in the S&P 500 a bare minimum of $32 billion between 2002 and 2004, according to recent Wall Street estimates. Even though investors all know they're supposed to buy low and sell high, in practice they often end up getting it backwards. Graham's warning in this chapter is simple: by the rule of opposites, the more enthusiastic investors become about the stock market in the long run, the more certain they are to be proved wrong in the short run. On March 24, 2000, the total value of the U.S. stock market peaked at $14.75 trillion. By October 9, 2002, just 30 months later, the total U.S. stock market was worth $7.34 trillion, or 50.2% less, a loss of $7.41 trillion. Meanwhile, many market pundits turned sourly bearish, predicting flat, or even negative market returns for years, even decades to come. At this point, Graham would ask one simple question, considering how calamitously wrong the experts were the last time they agreed on something: why on earth should the intelligent investor believe them now? Those cheaper stock prices do not mean, of course, that investors' expectation of a 7% stock return will be realized. Commentary on Chapter 3. What's next? Instead, let's tune out the noise and think about future returns as Graham might. The stock market's performance depends on three factors: real growth, the rise of companies' earnings and dividends; inflationary growth, the general rise of prices throughout the economy; speculative growth or decline, any increase or decrease in the investing public's appetite for stocks. In the long run, the yearly growth in corporate earnings per share has averaged 1.5% to 2%, not counting inflation, 0.3 as of early 2003. Inflation was running around 2.4% annually, the dividend yield on stocks was 1.9%. So, 1.5% to 2%, plus 2.4%, plus 1.9%, equals 5.8% to 6.3%. In the long run, that means you can reasonably expect stocks to average roughly a 6% return, or 4% after inflation. If the investing public gets greedy again and sends stocks back into orbit, then that speculative fever will temporarily drive returns higher. If, instead, investors are full of fear, as they were in the 1930s and 1970s, the returns on stocks will go temporarily lower. That's where we are in 2003. Robert Shiller, a finance professor at Yale University, says Graham inspired his valuation approach. Shiller compares the current price of the Standard & Poor's 500 stock index against average corporate profits over the past 10 years, after inflation. By scanning the historical record, Shiller has shown that when his ratio goes well above 20, the market usually delivers poor returns afterward. When it drops well. See Jeremy Siegel, Stocks for the Long Run, McGraw-Hill, 2002, p. 94. And Robert Arnott and William Bernstein, The 2% Dilution, Working Paper, July, 2002. Commentary on Chapter 3. Below 10, stocks typically produce handsome gains down the road. In early 2003, by Shiller's math, stocks were priced at about 22.8 times. The average inflation-adjusted earnings of the past decade is still in the danger zone, but way down from their demented level of 44.2 times. Earnings in December 1999. How has the market done in the past when it was priced around today's levels? Figure 3:1 shows the previous periods when stocks were at similar highs, and how they fared over the 10-year stretches that followed. Price/earnings ratio. Total return over next 10 years. Jack Wilson and Charles Jones, an analysis of the S&P 500 index and Cowell's extensions, price index and stock returns, 1870-1999, The Journal of Business, Vol. 75, Number 3, July, 2002, pages 527-529, Ibbotson Associates. Notes, price/earnings ratio is Shiller calculation, 10-year average real earnings of S&P 500 stock index divided by December 31 index value. Total return is nominal. Annual average. Commentary on Chapter 3. So, from valuation levels similar to those of early 2003, the stock market has sometimes done very well in the ensuing 10 years, sometimes poorly, and muddled along the rest of the time. I think Graham, ever the conservative, would split the difference between the lowest and highest past returns and project that over the next decade stocks will earn roughly 6% annually, or 4% after inflation. Interestingly, that projection matches the estimate we got earlier when we added together real growth, inflationary growth, and speculative growth. Compared to the 1990s, 6% is chicken feed. But it's a whisker better than the gains that bonds are likely to produce, and reason enough for most investors to hang on to stocks as part of a diversified portfolio. But there is a second lesson in Graham's approach. The only thing you can be confident of while forecasting future stock returns is that you will probably turn out to be wrong. The only indisputable truth that the past teaches us is that the future will always surprise us, always. And the corollary to that law of financial history is that the markets will most brutally surprise the very people who are most certain that their views about the future are right. Staying humble about your forecasting powers, as Graham did, will keep you from risking too much on a view of the future that may well turn out to be wrong. So, by all means, you should lower your expectations, but take care not to depress your spirit. For the intelligent investor, hope always springs eternal, because it should. In the financial markets, the worse the future looks, the better it usually turns out to be. A cynic once told G.K. Chesterton, the British novelist and essayist, "Blessed is he who expectateth nothing, for he shall not be disappointed." Chesterton's rejoinder: "Blessed is he who expectateth nothing, for he shall enjoy everything." Chapter 4. General Portfolio Policy. The Defensive Investor. The basic characteristics of an investment portfolio are usually determined by the position and characteristics of the owner or owners. At one extreme we have had savings banks, life insurance companies, and so-called legal trust funds. A generation ago their investments were limited by law in many states to high-grade bonds and, in some cases, high-grade preferred stocks. At the other extreme we have the well-to-do and experienced businessman, who will include any kind of bond or stock in his security list provided he considers it an attractive purchase. It has been an old and sound principle that those who cannot afford to take risks should be content with a relatively low return on their invested funds. From this there has developed the general notion that the rate of return which the investor should aim for is more or less proportionate to the degree of risk he is ready to run. Our view is different. The rate of return sought should be dependent, rather, on the amount of intelligent effort the investor is willing and able to bring to bear on his task. The minimum return goes to our passive investor, who wants both safety and freedom from concern. The maximum return would be realized by the alert and enterprising investor who exercises maximum intelligence and skill. In 1965 we added, in many cases there may be less real risk associated with buying a bargain issue offering the chance of a large profit than with a conventional bond purchase yielding about 4.5%. This statement had more truth in it than we ourselves suspected, since in subsequent years even the best long-term bonds lost a substantial part of their market value because of the rise in interest rates. General Portfolio Policy. The basic problem of bond stock allocation. We have already outlined in briefest form the portfolio policy of the defensive investor. He should divide his funds between high-grade bonds and high-grade common stocks. We have suggested as a fundamental guiding rule that the investor should never have less than 25% or more than 75% of his funds in common stocks, with a consequent inverse range of between 75% and 25% in bonds. There is an implication here that the standard division should be an equal 1, or 50-50, between the two major investment mediums. According to tradition, the sound reason for increasing the percentage in common stocks would be the appearance of the bargain price levels created in a protracted bear market. Conversely, sound procedure would call for reducing the common stock component below 50% when in the judgment of the investor the market level has become dangerously high. These copybook maxims have always been easy to enunciate and always difficult to follow because they go against that very human nature which produces that excesses of bull and bear markets. It is almost a contradiction in terms to suggest as a feasible policy for the average stock owner that he lighten his holdings when the market advances beyond a certain point and add to them after a corresponding decline. It is because the average man operates, and apparently must operate, in opposite fashion that we have had the great advances and collapses of the past, and this writer believes we are likely to have them in the future. if the division between investment and speculative operations were as clear now as once it was, we might be able to envisage investors as a shrewd, experienced group who sell out to the heedless, hapless speculators at high prices and buy back from them at depressed levels. This picture may have had some verisimilitude in bygone days, but it is hard to identify it with financial developments since 1949. There is no indication that such professional operations as those of the mutual funds have been conducted in this fashion. The percentage of the portfolio held in equities by the two major types of funds of balanced and common stock A has changed very little from year to year. Their selling activities have been largely related to endeavors to switch from less to more promising holdings. If, as we have long believed, the stock market has lost contact with its old bounds, and if new ones have not yet been established, then we can give the investor no reliable rules by which to reduce his common stock holdings toward the 25% minimum and rebuild them later to the 75% maximum. We can urge that in general the investor should not have more than one half in equities unless he has strong confidence in the soundness of his stock position and is sure that he could view a market decline of the 1969A70 type with equanimity. It is hard for us to see how such strong confidence can be justified at the levels existing in early 1972. Thus we would counsel against a greater than 50% apportionment to common stocks at this time. But, for complementary reasons, it is almost equally difficult to advise a reduction of the figure well below 50%, unless the investor is disquieted in his own mind about the current market level, and will be satisfied also to limit his participation in any further rise to, say, 25% of his total funds. We are thus led to put forward for most of our readers what may appear to be an oversimplified 50A50 formula. Under this plan, the guiding rule is to maintain as nearly as practicable an equal division between bond and stock holdings. When changes in the market level have raised the common stock component to, say, 55%, the balance would be restored by a sale of 1/11 of the stock portfolio and the transfer of the proceeds to bonds. Conversely, a fall in the common stock proportion to 45% would call for the use of 1/11 of the bond fund to buy additional equities. Yale University followed a somewhat similar plan for a number of years after 1937, but it was geared around a 35% normal holding in common stocks. In the early 1950s, however, Yale seems to have given up its once famous formula, and in 1969 held 61% of its portfolio in equities, including some convertibles. At that time, the endowment funds of 71 such institutions, totaling $7.6 billion, held 60.3% in common stocks. The Yale example illustrates the almost lethal effect of the great market advance upon the once popular formula approach to investment. Nonetheless, we are convinced that our 50A50 version of this approach makes good sense for the general portfolio policy. Defensive investor. It is extremely simple, it aims unquestionably in the right direction, it gives the follower the feeling that he is at least making some moves in response to market developments. Most important of all, it will restrain him from being drawn more and more heavily into common stocks as the market rises to more and more dangerous heights. Furthermore, a truly conservative investor will be satisfied with the gains shown on half his portfolio in a rising market, while in a severe decline he may derive much solace from reflecting how much better off he is than many of his more venturesome friends. While our proposed 50A50 division is undoubtedly the simplest all-purpose program devisable, it may not turn out to be the best in terms of results achieved. Of course, no approach, mechanical or otherwise, can be advanced with any assurance that it will work out better than another. The much larger income return now offered by good bonds than by representative stocks is a potent argument for favoring the bond component. The investor's choice between 50% or a lower figure in stocks may well rest mainly on his own temperament and attitude. If he can act as a cold-blooded weigher of the odds, he would be likely to favor the low 25% stock component at this time, with the idea of waiting until the DJIA dividend yield was, say, 2/3 of the bond yield before he would establish his median 50/50 division between bonds and stocks. Starting from 900 for the DJIA and dividends of $36 on the unit. This would require either a fall in taxable bond yields from 7.5% to about 5.5% without any change in the present return on leading stocks, or a fall in the DJIA to as low as 660 if there is no reduction in bond yields and no increase in dividends. A combination of intermediate changes could produce the same buying point. A program of that kind is not especially complicated, the hard part is to adopt it and to stick to it, not to mention the possibility that it may turn out to have been much too conservative. The bond component. The choice of issues in the bond component of the investor's portfolio will turn about two main questions: should he buy taxable or tax-free bonds, and should he buy shorter or longer-term maturities? The tax decision should be mainly a matter of arithmetic, turning on the difference in yields as compared with the investor's tax bracket. In January 1972, the choice in 20-year maturities was between obtaining, say, 7.5% on Grade A corporate bonds and 5.3% on prime tax-free issues. The term municipals is generally applied to all species of tax-exempt bonds, including state obligations. There was thus for this maturity a loss in income of some 30% in passing from the corporate to the municipal field. Hence, if the investor was in a maximum tax bracket higher than 30%, he would have a net saving after taxes by choosing the municipal bonds. The opposite, if his maximum tax was less than 30%. A single person starts paying a 30% rate when his income after deductions passes $10,000, for a married couple the rate applies when combined taxable income passes $20,000. It is evident that a large proportion of individual investors would obtain a higher return after taxes from good municipals than from good corporate bonds. The choice of longer versus shorter maturities involves quite a different question, viz., does the investor want to assure himself against a decline in the price of his bonds, but at the cost of 1. A lower annual yield and 2. Loss of the possibility of an appreciable gain in principal value? We think it best to discuss this question in Chapter 8, The Investor and Market Fluctuations. For a period of many years in the past, the only sensible bond purchases for individuals were the U.S. savings issues. Their safety, WASA and ISA unquestioned, they gave a higher return than other bond investments of first quality. They had a money-back option and other privileges which added greatly to their attractiveness. In our earlier editions we had an entire chapter entitled U.S. Savings Bonds, a boon to investors. As we shall point out, U.S. savings bonds still possess certain unique merits that make them a suitable purchase by any individual investor. For the man of modest capitala with, say, not more than $10,000 to put into bonds, so we think they are still the easiest and the best choice. But those with larger funds may find other mediums more desirable. Let us list a few major types of bonds that deserve investor consideration, and discuss them briefly with respect to general description, safety, yield, market price, risk, income tax status, and other features. General portfolio policy. 1. U.S. Savings Bonds, Series E and Series H. We shall first summarize their important provisions, and then discuss briefly the numerous advantages of these unique, attractive, and exceedingly convenient investments. The Series H bonds pay interest semi-annually, as do other bonds. The rate is 4.29% for the first year, and then a flat 5.10% for the next 9 years to maturity. Interest on the Series E bonds is not paid out, but accrues to the holder through increase in redemption value. The bonds are sold at 75% of their face value, and mature at 100% in 5 years 10 months after purchase. If held to maturity, the yield works out at 5%, compounded semi-annually. If redeemed earlier, the yield moves up from a minimum of 4.01% in the first year to an average of 5.20% in the next 4-5-6 years. Interest on the bonds is subject to federal income tax, but is exempt from state income tax. However, federal income tax on the Series E bonds may be paid at the holder's option either annually, as the interest accrues, through higher redemption value, or not, until the bond is actually disposed of. Owners of Series E bonds may cash them in at any time, shortly after purchase, at their current redemption value. Holders of Series H bonds have similar rights to cash them in at par value, cost. Series E bonds are exchangeable for Series H bonds, with certain tax advantages. Bonds lost, destroyed, or stolen may be replaced without cost. There are limitations on annual purchases, but liberal provisions for CO ownership by family members make it possible for most investors to buy as many as they can afford. Comment. There is no other investment that combines 1. Absolute assurance of principal and interest payments, 2. The right to demand full money back at any time, and 3. Guarantee of at least a 5% interest rate for at least 10 years. Holders of the earlier issues of Series E bonds have had the right to extend their bonds at maturity, and thus to continue to accumulate annual values at successively higher rates. The deferral of income tax payments over these long periods has been of great dollar advantage. We calculate it has increased the effective net after-tax rate received by as much as a third in typical cases. Conversely, the right to cash in the bonds at cost price or better has given the purchasers in former years of low interest rates complete protection against the shrinkage in principal value that befell many bond investors. Otherwise stated, it gave them the possibility of benefiting from the rise in interest rates by switching their low interest holdings into very high coupon issues on an even money basis. In our view, the special advantages enjoyed by owners of savings bonds now will more than compensate for their lower current return as compared with other direct government obligations. 2 other United States bonds. A profusion of these issues exists, covering a wide variety of coupon rates and maturity dates. All of them are completely safe with respect to payment of interest and principal. They are subject to federal income taxes but free from state income tax. In late 1971, the long-term issue ESA over 10 years showed an average yield of 6.09%, intermediate issues, 3 to 5 years, returned 6.35%, and short issues returned 6.03%. In 1970 it was possible to buy a number of old issues at large discounts. Some of these are accepted at PAR in settlement of estate taxes. Example, the U.S. Treasury 3.5s due 1990 are in this category. They sold at 60 in 1970, but closed 1970 above 77. It is interesting to note also that in many cases the indirect obligations of the U.S. government yield appreciably more than its direct obligations of the same maturity. As we write, an offering appears of 7.05% of certificates fully guaranteed by the Secretary of Transportation of the Department of Transportation of the United States. The yield was fully 1% more than that on direct obligations of the U.S., maturing the same year, 1986. The certificates were actually issued in the name of the trustees of the Penn Central Transportation Co., but they were sold on the basis of a statement by the U.S. Attorney General that the guarantee brings into being a general obligation of the United States, backed by its full faith and credit. Quite a number of indirect obligations of this sort have been assumed by the U.S. government in the past, and all of them have been scrupulously honored. The reader may wonder why all this hocus-pocus, involving an apparently personal guarantee by our Secretary of Transportation, and a higher cost to the taxpayer in the end. The chief reason for the indirection has been the debt limit imposed on government borrowing by the Congress. Apparently guarantees by the government are not regarded as debts, a semantic windfall for shrewder investors. Perhaps the chief impact of this situation has been the creation of tax-free housing authority bonds, enjoying general portfolio policy, the equivalent of a U.S. guarantee, and virtually the only tax-exempt issues that are equivalent to government bonds. Another type of government-backed issues is the recently created new community debentures, offered to yield 7.60% in September 1971. 3 state and municipal bonds. These enjoy exemption from federal income tax. They are also ordinarily free of income tax in the state of issue but not elsewhere. They are either direct obligations of a state or subdivision, or revenue bonds dependent for interest payments on receipts from a toll road, bridge, building, lease, etc. Not all tax-free bonds are strongly enough protected to justify their purchase by a defensive investor. He may be guided in his selection by the rating given to each issue by Moody's or Standard & Poor's. One of 3 highest ratings by both services, a AAA, AA, or A, should constitute a sufficient indication of adequate safety. The yield on these bonds will vary both with the quality and the maturity, with the shorter maturities giving the lower return. In late 1971 the issues represented in Standard & Poor's Municipal Bond Index averaged AA in quality rating, 20 years in maturity, and 5.78% in yield. A typical offering of Vineland, N.J., bonds, rated AA for A and gave a yield of only 3%. On the 1-year maturity, rising to 5.8% to the 1995 and 1996 maturities. 1. For corporation bonds. These bonds are subject to both federal and state tax. In early 1972 those of highest quality yielded 7.19%. For a 25-year maturity, as reflected in the published yield of Moody's AAA Corporate Bond Index. The so-called lower medium grade issues are rated by A returned 8.23% for long maturities. In each class shorter term issues would yield somewhat less than longer term obligations. Comment. The above summaries indicate that the average investor has several choices among high-grade bonds. Those in high income tax brackets can undoubtedly obtain a better net yield from good tax-free issues than from taxable ones. For others the early 1972 range of taxable yield would seem to be from 5.00% on U.S. savings bonds, with their special options, to about 7.5% on high-grade corporate issues. Higher-yielding bond investments. By sacrificing quality an investor can obtain a higher income. Return from his bonds. Long experience has demonstrated that the ordinary investor is wiser to keep away from such high-yield bonds. While, taken as a whole, they may work out somewhat better in terms of overall return than the first quality issues, they expose the owner to too many individual risks of untoward developments, ranging from disquieting price declines to actual default. It is true that bargain opportunities occur fairly often in lower grade bonds, but these require special study and skill to exploit successfully. Asterisk. Perhaps we should add here that the limits imposed by Congress on direct bond issues of the United States have produced at least two sorts of bargain opportunities for investors in the purchase of government-backed obligations. One is provided by the tax-exempt new housing issues, and the other by the recently created, taxable, new community debentures. An offering of new housing issues in July 1971 yielded as high as 5.8%, free from both federal and state taxes, while an issue of taxable, new community debentures sold in September 1971 yielded 7.60%. Both obligations have the full faith and credit of the United States government behind them and hence are safe without question. And on a net basis they yield considerably more than ordinary United States bonds. Graham's objection to high-yield bonds is mitigated today by the widespread availability of mutual funds that spread the risk and do the research of owning junk bonds. See the commentary on Chapter 6 for more detail. The new housing bonds and new community debentures are no more. New Housing Authority bonds were backed by the U.S. Department of Housing and Urban Development, HUD, and were exempt from income tax, but they have not been issued since 1974. New community debentures, also backed by HUD, were authorized by a federal law passed in 1968. About $350 million of these debentures were issued through 1975, but the program was terminated in 1983. General Portfolio Policy. Savings deposits in lieu of bonds. An investor may now obtain as high an interest rate from a savings deposit in a commercial or savings bank, or from a bank certificate of deposit, as he can from a first-grade bond of short maturity. The interest rate on bank savings accounts may be lowered in the future, but under present conditions they are a suitable substitute for short-term bond investment by the individual. Convertible issues. These are discussed in Chapter 16. The price variability of bonds, in general, is treated in Chapter 8, the investor and market fluctuations. Call provisions. In previous editions we had a fairly long discussion of this aspect of bond financing, because it involved a serious but little noticed injustice to the investor. In the typical case, bonds were callable fairly soon after issuance, and at modest premiums, say 5% above the issue price. This meant that during a period of wide fluctuations in the underlying interest rates, the investor had to bear the full brunt of unfavorable changes and was deprived of all but a meager participation in favorable ones. Example, our standard example has been the issue of American Gas and Electric 100-year 5% debentures, sold to the public at 101 in 1928. 4 years later, under near-panic conditions, the price of these good bonds fell to 62.5, yielding 8%. By 1946, in a great reversal, bonds of this type could be sold to yield only 3%, and the 5% issue should have been quoted at close to 160. But at that point the company took advantage of the call provision and redeemed the issue at a mere 106. The call feature in these bond contracts was a thinly disguised instance of heads I win, tails you lose. At long last, the bond-buying institutions refused to accept this unfair arrangement. In Recent years' most long-term high-coupon issues have been protected against redemption for 10 years or more after issuance. This still limits their possible price rise, but not inequitably. In practical terms, we advise the investor in long-term issues to sacrifice a small amount of yield to obtain the assurance of non-callability, say for 20 or 25 years. Similarly, there is an advantage in buying a low-coupon bond asterisk at a discount rather than a high-coupon bond selling at about par and callable in a few years. 4. The discount e.g., of a 3.5% bond at 63.5%, yielding 7.85% A carries full protection against adverse call action. Strata, i.e., non-convertible preferred stocks. Certain general observations should be made here on the subject of preferred stocks. Really good preferred stocks can and do exist, but they are good in spite of their investment form, which is an inherently bad one. The typical preferred shareholder is dependent for his safety on the ability and desire of the company to pay dividends on its common stock. Once the common dividends are omitted, or even in danger, his own position becomes precarious. 4. The directors are under no obligation to continue paying him unless they also pay on the common. On the other hand, the typical preferred stock carries no share in the company's profits beyond a fixed dividend rate. Thus the preferred holder lacks both the legal claim of the bondholder, or creditor, and the profit possibilities of a common shareholder, or partner. These weaknesses in the legal position of preferred stocks tend to come to the fore recurrently in periods of depression. Only a small percentage of all preferred issues are so strongly entrenched as to maintain an unquestioned investment status through all vicissitudes. Experience teaches that the time to buy preferred stocks is when their price is unduly depressed by temporary adversity. At such times they may be well suited to the aggressive investor but too unconventional for the defensive investor. In other words, they should be bought on a bargain basis or not at all. We shall refer later to convertible and similarly privileged issues, which carry some special possibilities of profits. These are not ordinarily selected for a conservative portfolio. Another peculiarity in the general position of preferred stocks. Asterisk a bond's coupon is its interest rate. A low coupon bond pays a rate of interest income below the market average. General portfolio policy deserves mention. They have a much better tax status for corporation buyers than for individual investors. Corporations pay income tax on only 15% of the income they receive in dividends, but on the full amount of their ordinary interest income. Since the 1972 corporate rate is 48%, this means that $100 received as preferred stock dividends is taxed only $7.20, whereas $100 received as bond interest is taxed $48. On the other hand, individual investors pay exactly the same tax on preferred stock investments as on bond interest, except for a recent minor exemption. Thus, in strict logic, all investment-grade preferred stocks should be bought by corporations, just as all tax-exempt bonds should be bought by investors who pay income tax asterisk. Security forms. The bond form and the preferred stock form, as hitherto discussed, are well understood and relatively simple matters. A bondholder is entitled to receive fixed interest and payment of principal on a definite date. The owner of a preferred stock is entitled to a fixed dividend, and no more, which must be paid before any common dividend. His principal value does not come due on any specified date. The dividend may be cumulative or non-cumulative. He may or may not have a vote. The above describes the standard provisions and, no doubt, the majority of bond and preferred issues, but there are innumerable departures from these forms. The best known types are convertible and similar issues, and income bonds. In the latter type, interest does not have to be paid unless it is earned by the company. Unpaid interest may accumulate as a charge against future earnings, but the period is often limited to 3 years. Income bonds should be used by corporations much more. While Graham's logic remains valid, the numbers have changed. Corporations can currently deduct 70% of the income they receive from dividends. And the standard corporate tax rate is 35%. Thus, a corporation would pay roughly $24.50 in tax on $100 in dividends from preferred stock versus $35 in tax on $100 in interest income. Individuals pay the same rate of income tax on dividend income that they do on interest income, so preferred stock offers them no tax advantage. Extensively than they are. Their avoidance apparently arises from a mere accident of economic hysteria, namely, that they were first employed in quantity in connection with railroad reorganizations. And hence they have been associated from the start with financial weakness and poor investment status. But the form itself has several practical advantages, especially in comparison with and in substitution for the numerous, convertible, preferred stock issues of recent years. Chief of these is the deductibility of the interest paid from the company's taxable income, which in effect cuts the cost of that form of capital in half. From the investor's standpoint, it is probably best for him in most cases that he should have, 1. An unconditional right to receive interest payments when they are earned by the company, and 2. A right to other forms of protection. Then bankruptcy proceedings if interest is not earned and paid. The terms of income bonds can be tailored to the advantage of both the borrower and the lender in the manner best suited to both. Conversion privileges can, of course, be included. The acceptance by everybody of the inherently weak preferred stock form and the rejection of the stronger income bond form is a fascinating illustration of the way in which traditional institutions and habits often tend to persist on Wall Street despite new conditions calling for a fresh point of view. With every new wave of optimism or pessimism, we are ready to abandon history and time-tested principles, but we cling tenaciously and unquestioningly to our prejudices. Commentary on Chapter 4. When you leave it to chance, then all of a sudden you don't have any more luck. A basketball coach Pat Riley. How aggressive should your portfolio be? That, says Graham, depends less on what kinds of investments you own than on what kind of investor you are. There are 2 ways to be an intelligent investor. By continually researching, selecting, and monitoring a dynamic mix of stocks, bonds, or mutual funds. Or by creating a permanent portfolio that runs on autopilot and requires no further effort, but generates very little excitement. Graham calls the first approach active or enterprising. It takes lots of time and loads of energy. The passive or defensive strategy takes little time or effort but requires an almost ascetic detachment from the alluring hullabaloo of the market. As the investment thinker Charles Ellis has explained, the enterprising approach is physically and intellectually taxing, while the defensive approach is emotionally demanding. Point 1. If you have time to spare, are highly competitive, think like a sports fan, and relish a complicated intellectual challenge, then the active. For more about the distinction between physically and intellectually difficult investing on the one hand, and emotionally difficult investing on the other, see Chapter 8 and also Charles D. Ellis, 3 Ways to Succeed as an Investor, in Charles D. Ellis and James R. Verton, eds, The Investor's Anthology, John Wiley & Sons, 1997, p. 72. Commentary on Chapter 4. Approach is up your alley. If you always feel rushed, crave simplicity, and don't relish thinking about money, then the passive approach is for you. Some people will feel most comfortable combining both methods, creating a portfolio that is mainly active and partly passive, or vice versa. Both approaches are equally intelligent, and you can be successful with either, but only if you know yourself well enough to pick the right one. Stick with it over the course of your investing lifetime, and keep your costs and emotions under control. Graham's distinction between active and passive investors is another of his reminders that financial risk lies not only where most of us look for it in the economy or in our investments, but also within ourselves. Can you be brave, or will you cave? How, then, should a defensive investor get started? The first and most basic decision is how much to put in stocks and how much to put in bonds and cash. Note that Graham deliberately places this discussion after his chapter on inflation, forearming you with the knowledge that inflation is one of your worst enemies. The most striking thing about Graham's discussion of how to allocate your assets between stocks and bonds is that he never mentions the word age. That sets his advice firmly against the winds of conventional wisdom, which holds that how much investing risk you ought to take depends mainly on how old you are. Point 2. A traditional rule of thumb was to subtract your age from 100 and invest that percentage of your assets in stocks, with the rest in bonds or cash. A 28-year-old would put 72% of her money in stocks, an 81-year-old would put only 19%. There. Like everything else, these assumptions got overheated in the late 1990s. By 1999, a popular book argued that if you were younger than 30, you should put 95% of your money in stocks, even if you had only a moderate tolerance for risk. 3. A recent Google search for the phrase age and asset allocation turned up more than 30,000 online references. James K. Glassman and Kevin A. Hassett, Dow. 36,000, The New Strategy for Profiting from the Coming Rise in the Stock Market, Times Business. 1999, p. 250. Commentary on Chapter 4. Unless you've allowed the proponents of this advice to subtract 100 from your IQ, you should be able to tell that something is wrong here. Why should your age determine how much risk you can take? An 89-year-old with $3 million, an ample pension, and a gaggle of grandchildren would be foolish to move most of her money into bonds. She already has plenty of income, and her grandchildren, who will eventually inherit her stocks, have decades of investing ahead of them. On the other hand, a 25-year-old who is saving for his wedding and a house down payment would be out of his mind to put all his money in stocks. If the stock market takes an Acapulco high dive, he will have no bond income to cover his downside or his backside. What's more, no matter how young you are, you might suddenly need to yank your money out of stocks not 40 years from now, but 40 minutes from now. Without a whiff of warning, you could lose your job, get divorced, become disabled, or suffer who knows what other kind of surprise. The unexpected can strike anyone, at any age. Everyone must keep some assets in the riskless haven of cash. Finally, many people stop investing precisely because the stock market goes down. Psychologists have shown that most of us do a very poor job of predicting today how we will feel about an emotionally charged event in the future. Point 4. When stocks are going up 15% or 20% a year, as they did in the 1980s and 1990s, it's easy to imagine that you and your stocks are married for life. But when you watch every dollar you invested getting bashed down to a dime, it's hard to resist bailing out into the safety of bonds and cash. Instead of buying and holding their stocks, many people end up buying high selling low, and holding nothing but their own head in their hands. Because so few investors have the guts to cling to stocks in a falling market, Graham insists that everyone should keep a minimum of 25% in bonds. That cushion, he argues, will give you the courage to keep the rest of your money in stocks even when stocks stink. To get a better feel for how much risk you can take, think about the fundamental circumstances of your life, when they will kick in, when they might change, and how they are likely to affect your need for cash. For a fascinating essay on this psychological phenomenon, see Daniel Gilbert and Timothy Wilson's Miswanting, at www.wjh.harvard.edu/DTG. Gilbert_and_Wilson, Miswanting.pdf. Commentary on Chapter 4. Are you single or married? What does your spouse or partner do for a living? Do you or will you have children? When will the tuition bills hit home? Will you inherit money, or will you end up financially responsible for aging, ailing parents? What factors might hurt your career? If you work for a bank or a home builder, a jump in interest rates could put you out of a job. If you work for a chemical manufacturer, soaring oil prices could be bad news. If you are self-employed, how long do businesses similar to yours tend to survive? Do you need your investments to supplement your cash income? In general, bonds will, stocks won't. Given your salary and your spending needs, how much money can you afford to lose on your investments? If, after considering these factors, you feel you can take the higher risks inherent in greater ownership of stocks, you belong around Graham's minimum of 25% in bonds or cash. If not, then steer mostly clear of stocks, edging toward Graham's maximum of 75% in bonds or cash. To find out whether you can go up to 100%, see the sidebar on P105. Once you set these target percentages, change them only as your life circumstances change. Do not buy more stocks because the stock market has gone up, do not sell them because it has gone down. The very heart of Graham's approach is to replace guesswork with discipline. Fortunately, through your 401k, it's easy to put your portfolio on permanent autopilot. Let's say you are comfortable with a fairly high level of risk, as say, 70% of your assets in stocks and 30% in bonds. If the stock market rises 25%, but bonds stay steady, you will now have just under 75% in stocks and only 25% in bonds. 5. Visit your 401k's website, or call its toll-free number, and sell enough of your stock funds to rebalance back to your 70830 target. The key is to rebalance on a predictable, patient schedule and not so often that you will. For the sake of simplicity, this example assumes that stocks rose instantaneously. Commentary on Chapter 4. Why not 100% stocks? Graham advises you never to have more than 75% of your total assets in stocks, but is putting all your money into the stock market inadvisable for everyone? For a tiny minority of investors, a 100% stock portfolio may make sense. You are one of them. If you have set aside enough cash to support your family for at least 1 year, will be investing steadily for at least 20 years to come. Survived the bear market that began in 2000. Did not sell stocks during the bear market that began in 2000. Bought more stocks during the bear market that began in 2000. Have read Chapter 8 in this book and implemented a formal plan to control your own investing behavior. Unless you can honestly pass all these tests, you have no Business putting all your money in stocks. Anyone who panicked in the last bear market is going to panic in the next oni and will regret having no cushion of cash and bonds. Drive yourself crazy, and not so seldom that your targets will get out of whack. I suggest that you rebalance every 6 months, no more and no less, on easy to remember dates like New Year's and the 4th of July. The beauty of this periodic rebalancing is that it forces you to base your investing decisions on a simple, objective standard. Do I now own more of this asset than my plan calls for, instead of the sheer guesswork of where interest rates are heading or whether you think the Dow is about to drop dead? Some mutual fund companies, including T. Rowe Price, may soon introduce services that will automatically rebalance your 401k portfolio to your preset targets, so you will never need to make an active decision. Commentary on Chapter 4. The ins and outs of income investing. In Graham's day, bond investors faced two basic choices: taxable or tax-free, short-term or long-term. Today there is a third: bonds or bond funds, taxable or tax-free. Unless you're in the lowest tax bracket 6, you should buy only tax-free, municipal bonds outside your retirement accounts. Otherwise, too much of your bond income will end up in the hands of the IRS. The only place to own taxable bonds is inside your 401k, or another sheltered account, where you will owe no current tax on their income, and where municipal bonds have no place, since their tax advantage goes to waste. 7. Short-term or long-term. Bonds and interest rates teeter on opposite ends of a seesaw. If interest rates rise, bond prices fall. Although a short-term bond falls far less than a long-term bond. On the other hand, if interest rates fall, bond prices rise, and a long-term bond will outperform shorter ones. 8. You can split the difference simply. For the 2003 tax year, the bottom federal tax bracket is for single people earning less than $28,400 or married people, filing jointly, earning less than $47,450. Two good online calculators that will help you compare the after-tax income of municipal and taxable bonds can be found at www.investinginbonds.com/cgibin/calculator.pl and www.leventhal.com/index_infocenter.html. 2. Decide if a muni is right for you. Find the taxable equivalent yield generated by these calculators, then compare that number to the yield currently available on Treasury bonds. If the yield on Treasury bonds is higher than the taxable equivalent yield, munis are not for you. In any case, be warned that municipal bonds and funds produce lower income, and more price fluctuation, than most taxable bonds. Also, the alternative minimum tax, which now hits many middle-income Americans, can negate the advantages of municipal bonds. For an excellent introduction to bond investing, see http://flagship.ban. Guard.com. For an even simpler explanation of bonds, see http://money.cnn.com. A laddered portfolio, holding bonds across a range of maturities, is another way of hedging interest rate risk. Commentary on Chapter 4. By buying intermediate-term bonds maturing in 5 to 10 years, which do not soar when their side of the seesaw rises, but do not slam into the ground either. For most investors, intermediate bonds are the simplest choice, since they enable you to get out of the game of guessing what interest rates will do. Bonds or bond funds. Since bonds are generally sold in $10,000 lots and you need a bare minimum of 10 bonds to diversify away the risk that any one of them might go bust, buying individual bonds Makes no sense unless you have at least $100,000 to invest. The only exception is bonds issued by the U.S. Treasury, since they're protected against default by the full force of the American government. Bond funds offer cheap and easy diversification, along with the convenience of monthly income, which you can reinvest right back into the fund at current rates without paying a commission. For most investors, bond funds beat individual bonds hands down. The main exceptions are Treasury securities and some municipal bonds. Major firms like Vanguard, Fidelity, Schwab, and T. Rowe Price offer a broad menu of bond funds at low cost. 9. The choices for bond investors have proliferated like rabbits, so let's update Graham's list of what's available. As of 2003, interest rates have fallen so low that investors are starved for yield, but there are ways of amplifying your interest income without taking on excessive risk. 10 Figure 4:1 summarizes the pros and cons. Now let's look at a few types of bond investments that can fill special needs. Cash is not trash. How can you wring more income out of your cash? The intelligent investor should consider moving out of bank certificates of deposit or money market accounts which have offered meager returns lately into some of these cash alternatives. Treasury securities, as obligations of the U.S. government, carry. For more information, see www.vanguard.com, www.fidelity.com, www.schwab.com, and www.troprice.com. For an accessible online summary of bond investing, see www.aa2.com. Commentary on Chapter 4. Sources: Bankrate.com, Bloomberg, Lehman Brothers, Merrill Lynch, Morningstar. www.savingsbonds.gov. Notes: D. Purchased directly. F. Purchased through a mutual fund. Ease of sale before maturity indicates how readily you can sell at a fair price before maturity date. Mutual funds typically offer better ease of sale than individual bonds. Money market funds are federally insured up to $100,000 if purchased at an FDIC member bank, but otherwise carry only an implicit pledge not to lose value. Federal income tax on savings bonds is deferred until redemption or maturity. Municipal bonds are generally exempt from state income tax only in the state where they were issued. Commentary on Chapter 4. Virtually no credit risk is since, instead of defaulting on his debts, Uncle Sam can just jack up taxes or print more money at will. Treasury bills mature in 4, 13, or 26 weeks. Because of their very short maturities, T-bills barely get dented when rising interest rates knock down the prices of other income investments. Longer-term Treasury debt, however, suffers severely when interest rates rise. The interest income on Treasury securities is generally free from state, but not federal income tax. And, with $3.7 trillion in public hands, the market for Treasury debt is immense, so you can readily find a buyer if you need your money back before maturity. You can buy Treasury bills, short-term notes, and long-term bonds directly from the government, with no brokerage fees, at www.publicdebt.trees.gov. For more on inflation-protected tips, see the commentary on Chapter 2. Savings bonds, unlike treasuries, are not marketable. You cannot. Commentary on Chapter 4. Sell them to another investor, and you'll forfeit 3 months of interest if you redeem them in less than 5 years. Thus they are suitable mainly as set-aside money to meet a future spending need, a gift for a religious ceremony that's years away, or a jump start on putting your newborn through Harvard. They come in denominations as low as $25, making them ideal as gifts to grandchildren. For investors who can confidently leave some cash untouched for years to come, inflation-protected I-bonds recently offered an attractive yield of around 4%. To learn more, see www.savingsbonds.gov. Moving beyond Uncle Sam. Mortgage securities. Pooled together from thousands of mortgages around the United States, these bonds are issued by agencies like the Federal National Mortgage Association, Fannie Mae, or the Government National Mortgage Association, Ginnie Mae. However, they are not backed by the U.S. Treasury, so they sell at higher yields to reflect their greater risk. Mortgage bonds generally underperform when interest rates fall and bomb when rates rise. Over the long run, those swings tend to even out and the higher average yields pay off. Good mortgage bond funds are available from Vanguard, Fidelity, and PIMCO. But if a broker ever tries to sell you an individual mortgage bond or CMO, tell him you are late for an appointment with your proctologist. Annuities. These insurance-like investments enable you to defer current taxes and capture a stream of income after you retire. Fixed annuities offer a set rate of return, variable ones provide a fluctuating return. But what the defensive investor really needs to defend against here are the hard-selling insurance agents, stockbrokers, and financial planners who peddle annuities at rapaciously high costs. In most cases, the high expenses of owning an annuity, including surrender charges that gnaw away at your early withdrawal, will overwhelm its advantages. The few good annuities are bought, not sold. If an annuity produces fat commissions for the seller, chances are it will produce meager results for the buyer. Consider only those you can buy directly from providers with rock-bottom costs like Ameritas, TIAA CREF, and Vanguard. 11. In general, variable annuities are not attractive for investors under the age of 50 who expect to be in a high-tax bracket during retirement or who have. Commentary on Chapter 4. Preferred stock. Preferred shares are a worst of both worlds. Investment. They are less secure than bonds, since they have only a secondary claim on a company's assets if it goes bankrupt. And they offer less profit potential than common stocks do, since companies typically call, or forcibly buy back, their preferred shares when interest rates drop or their credit rating improves. Unlike the interest payments on most of its bonds, an issuing company cannot deduct preferred dividend payments from its corporate tax bill. Ask yourself, if this company is healthy enough to deserve my investment, why is it paying a fat dividend on its preferred stock instead of issuing bonds and getting a tax break? The likely answer is that the company is not healthy, the market for its bonds is glutted, and you should approach its preferred shares as you would approach an unrefrigerated dead fish. Common stock. A visit to the stock screener at http://screen. Yahoo.com in early 2003 showed that 115 of the stocks in the Standard & Poor's 500 index had dividend yields of 3.0% or greater. No intelligent investor, no matter how starved for yield, would ever buy a stock for its dividend income alone. The company and its businesses must be solid, and its stock price must be reasonable. But, thanks to the bear market that began in 2000, some leading stocks are now out-yielding treasury bonds. So even the most defensive investor should realize that selectively adding stocks to an AL bond or mostly bond portfolio can increase its income yield and raise its potential return. 12. Not already contributed the maximum to their existing 401k, or IRA accounts. Fixed annuities, with the notable exception of those from TIAA CREF, can change their guaranteed rates and smack you with nasty surrender fees. For thorough and objective analysis of annuities, see 2. Superb articles by Walter Updegrave, Income for Life, Money, July, 2002. Pages 89-96, and Annuity Buyer's Guide, Money, November, 2002, pp. 104a-110. For more on the role of dividends in a portfolio, see Chapter 19. Chapter 5. The Defensive Investor and Common Stocks. Investment Merits of Common Stocks. In our first edition, 1949, we found it necessary at this point to insert a long exposition of the case for including a substantial common stock component in all investment portfolios. Common stocks were generally viewed as highly speculative and therefore unsafe. They had declined fairly substantially from the high levels of 1946, but instead of attracting investors to them because of their reasonable prices, this fall had had the opposite effect of undermining confidence in equity securities. We have commented on the converse situation that has developed in the ensuing 20 years, whereby the big advance in stock prices made them appear safe and profitable investments at record high levels, which might actually carry with them a considerable degree of risk. The argument we made for common stocks in 1949 turned on. At the beginning of 1949, the average annual return produced by stocks over the previous 20 years was 3.1%, versus 3.9% for long-term Treasury bonds, meaning that $10,000 invested in stocks would have grown to $18,415 over that period, while the same amount in bonds would have turned into $21,494. Naturally enough, 1949 turned out to be a fabulous time to buy stocks. Over the next decade, the Standard & Poor's 500 stock index gained an average of 20.1% per year, one of the best long-term returns in the history of the U.S. stock market. Graham's earlier comments on this subject appear on pages 19-20. Just imagine what he would have thought about the stock market of the late 1990s, in which each new record-setting high was considered further proof that stocks were the riskless way to wealth. The defensive investor and common stocks. Two main points. The first was that they had offered a considerable degree of protection against the erosion of the investor's dollar caused by inflation, whereas bonds offered no protection at all. The second advantage of common stocks lay in their higher average return to investors over the years. This was produced both by an average dividend income exceeding the yield on good bonds and by an underlying tendency for market value to increase over the years in consequence of the reinvestment of undistributed profits. While these two advantages have been of major importance and have given common stocks a far better record than bonds over the long-term, we have consistently warned that these benefits could be lost by the stock buyer if he pays too high a price for his shares. This was clearly the case in 1929, and it took 25 years for the market level to climb back to the ledge from which it had abysmally fallen in 1929-1932 *. Since 1957, common stocks have once again, through their high prices, lost their traditional advantage in dividend yield over bond interest rates. It remains to the Dow Jones Industrial Average closed at a then record high of 381.17 on September 3, 1929. It did not close above that level until November 23, 1954, a more than a quarter of a century later, when it hit 382.74. When you say you intend to own stocks for the long run, do you realize just how long the long run can be, or that many investors who bought in 1929 were no longer even alive by 1954? However, for patient investors who reinvested their income, stock returns were positive over this otherwise dismal period. Simply because dividend yields averaged more than 5.6% per year. According to Professors Elroy Dimson, Paul Marsh, and Mike Stanton of London Business School, if you had invested $1 in US stocks in 1900 and spent all your dividends, your stock portfolio would have grown to $198 by 2000. But if you had reinvested all your dividends, your stock portfolio would have been worth $16,797. Far from being an afterthought, dividends are the greatest force in stock investing. Why do the high prices of stocks affect their dividend yields? A stock's yield is the ratio of its cash dividend to the price of one share of common stock. If a company pays a $2 annual dividend when its stock price is $100 per share, its yield is 2%. But if the stock price doubles while the dividend stays constant, the dividend yield will drop to 1%. In 1959, when the trend gram spotted in 1957 became noticeable to everyone, most Wall Street be seen whether the inflation factor and the economic growth factor will make up in the future for this significantly adverse development. It should be evident to the reader that we have no enthusiasm for common stocks in general at the 900 DJIA level of late 1971. For reasons already given *, we feel that the defensive investor cannot afford to be without an appreciable proportion of common stocks in his portfolio, even if he must regard them as the lesser of two evils, the greater being the risks attached to an all-bond holding. Rules for the common stock component. The selection of common stocks for the portfolio of the defensive investor should be a relatively simple matter. Here we would suggest 4 rules to be followed. 1. There should be adequate though not excessive diversification. This might mean a minimum of 10 different issues and a maximum of about 30. 2. Each company selected should be large, prominent, and conservatively financed. Indefinite as these adjectives must be, their general sense is clear. Observations on this point are added at the end of the chapter. 3. Each company should have a long record of continuous dividend payments. All the issues in the Dow Jones Industrial Aver pundits declared that it could not possibly last. Never before had stocks yielded less than bonds. After all, since stocks are riskier than bonds, why would anyone buy them at all unless they pay extra dividend income to compensate for their greater risk? The experts argued that bonds would out-yield stocks for a few months at most, and then things would revert to normal. More than 4 decades later, the relationship has never been normal again. The yield on stocks has, so far, continuously stayed below the yield on bonds. See pages 56a 57 and 88a 89. For another view of diversification, see the sidebar in the commentary on Chapter 14, p. 368. The defensive investor and common stocks. Age met this dividend requirement in 1971. To be specific on this point, we would suggest the requirement of continuous dividend payments beginning at least in 1950 *. For the investor should impose some limit on the price he will pay for an issue in relation to its average earnings over, say, the past 7 years. We suggest that this limit be set at 25 times such average earnings, and not more than 20 times those of the last 12-month period. But such a restriction would eliminate nearly all the strongest and most popular companies from the portfolio. In particular, it would ban virtually the entire category of growth stocks, which have for some years past been the favorites of both speculators and institutional investors. We must give our reasons for proposing so drastic an exclusion. Growth stocks and the defensive investor. The term growth stock is applied to one which has increased its per-share earnings in the past at well above the rate for common stocks generally and is expected to continue to do so in the future. Some authorities would say that a true growth stock should be expected at least to double its per-share earnings in 10 years, i.e., to increase them at a compounded annual rate of over 7.1%. Obviously, stocks of this kind are attractive to buy and to own, provided the price paid is not excessive. The problem lies there, of today's defensive investor should probably insist on at least 10 years of continuous dividend payments, which would eliminate from consideration only one member of the Dow Jones Industrial Average, Microsoft, and would still leave at least 317 stocks to choose from among the S&P 500 index. Even insisting on 20 years of uninterrupted dividend payments would not be overly restrictive. According to Morgan Stanley, 255 companies in the S&P 500 met that standard as of year-end 2002. The rule of 72 is a handy mental tool to estimate the length of time an amount of money takes to double. Simply divide its assumed growth rate into 72. At 6%, for instance, money will double in 12 years. 72 divided by 6 equals 12. At the 7.1% rate cited by Graham, a growth stock will double its earnings in just over 10 years. 72/7.1 equals 10.1 years. Course, since growth stocks have long sold at high prices in relation to current earnings and at much higher multiples of their average profits over a past period. This has introduced a speculative element of considerable weight in the growth stock picture and has made successful operations in this field a far from simple matter. The leading growth issue has long been international business machines, and it has brought phenomenal rewards to those who bought it years ago and held onto it tenaciously. But we have already pointed out that this best of common stocks actually lost 50% of its market price in a 6-month decline during 1961-62, and nearly the same percentage in 1969-70. Other growth stocks have been even more vulnerable to adverse developments. In some cases, not only has the price fallen back but the earnings as well, thus causing a double discomfiture to those who own them. A good second example for our purpose is Texas Instruments, which in 6 years rose from 5 to 256, without paying a dividend, while its earnings increased from 40 cents to $3.91 per share. Note that the price advanced 5 times as fast as the profits. This is characteristic of popular common stocks. But 2 years later the earnings had dropped off by nearly 50% and the price by 4/5, to 49. The reader will understand from these instances why we regard growth stocks as a whole as too uncertain and risky a vehicle for the defensive investor. Of course, wonders can be accomplished with the right individual selections, bought at the right levels, and later sold after a huge rise and before the probable decline. But the average investor can no more expect to accomplish this than to find money growing on trees. In contrast, we think that the group of Graham makes this point on p73. To show that Graham's observations are perennially true, we can substitute Microsoft for IBM and Cisco for Texas Instruments. 30 years apart. The results are uncannily similar. Microsoft stock dropped 55.7% from 2000 through 2002, while Cisco's stock, which had risen roughly 50-fold over the previous 6 years, lost 76% of its value from 2000 through 2002. As with Texas Instruments, the drop in Cisco's stock price was sharper than the fall in its earnings, which dropped just 39.2%, comparing the 3-year average for 1997 1999 against 2000 2002. As always, the hotter they are, the harder they fall. The defensive investor and common stocks. Large companies that are relatively unpopular, and therefore obtainable at reasonable earnings multipliers * offers a sound if unspectacular area of choice by the general public. We shall illustrate this idea in our chapter on portfolio selection. Portfolio changes. It is now standard practice to submit all security lists for periodic inspection in order to see whether their quality can be improved. This, of course, is a major part of the service provided for clients by investment counselors. Nearly all brokerage houses are ready to make corresponding suggestions, without special fee, in return for the commission business involved. Some brokerage houses maintain investment services on a fee basis. Presumably our defensive investor should obtain at least once a year the same kind of advice regarding changes in his portfolio as he sought when his funds were first committed. Since he will have little expertness of his own on which to rely, it is essential that he entrust himself only to firms of the highest reputation, otherwise he may easily fall into incompetent or unscrupulous hands. It is important, in any case, that at every such consultation he make clear to his advisor that he wishes to adhere closely to the 4 rules of common stock selection given earlier in this chapter. Incidentally, if his list has been competently selected in the first instance, there should be no need for frequent or numerous changes. Earnings multiplier is a synonym for P/E or price/earnings ratios, which measure how much investors are willing to pay for a stock compared to the profitability of the underlying business. See footnote on P70 in Chapter 3. Investors can now set up their own automated system to monitor the quality of their holdings by using interactive portfolio trackers at such websites as www.quicken.com, moneycentral.msn.com, finance.yahoo.com, and www.morningstar.com. Graham would, however, warn against relying exclusively on such a system. You must use your own judgment to supplement the software. Dollar cost averaging. The New York Stock Exchange has put considerable effort into popularizing its monthly purchase plan, under which an investor devotes the same dollar amount each month to buying one or more common stocks. This is an application of a special type of formula investment known as dollar cost averaging. During the predominantly rising market experience since 1949, the results from such a procedure were certain to be highly satisfactory, especially since they prevented the practitioner from concentrating his buying at the wrong times. In Lucille Tomlinson's comprehensive study of formula investment plans 1, the author presented a calculation of the results of dollar cost averaging in the group of stocks making up the Dow Jones Industrial Index. Tests were made covering 23 10-year purchase periods, the first ending in 1929, the last in 1952. Every test showed a profit either at the close of the purchase period or within 5 years thereafter. The average indicated profit at the end of the 23 buying periods was 21.5%, exclusive of dividends received. Needless to say, in some instances there was a substantial temporary depreciation at market value. Miss Tomlinson ends her discussion of this ultra-simple investment formula with the striking sentence, "No one has yet discovered any other formula for investing which can be used with so much confidence of ultimate success, regardless of what may happen to security prices, as dollar cost averaging." It may be objected that dollar cost averaging, while sound in principle, is rather unrealistic in practice, because few people are so situated that they can have available for common stock investment the same amount of money each year for, say, 20 years. It seems to me that this apparent objection has lost much of its force in recent years. Common stocks are becoming generally accepted as a necessary component of a sound savings investment program. Thus, Systematic and uniform purchases of common stocks may present no more psychological and financial difficulties than similar continuous payments for United States savings bonds and for life insurance, to which they should be complementary. The monthly amount may be small, but the results after 20 or more years can be impressive and important to the saver. The defensive investor and common stocks. The investor's personal situation. At the beginning of this chapter we referred briefly to the position of the individual portfolio owner. Let us return to this matter in the light of our subsequent discussion of general policy. To what extent should the type of security selected by the investor vary with his circumstances? As concrete examples representing widely different conditions, we shall take 1. A widow left $200,000 with which to support herself and her children. 2. A successful doctor in mid-career, with savings of $100,000 and yearly accretions of $10,000, and 3. A young man earning $200 per week and saving $1,000 a year *. For the widow, the problem of living on her income is a very difficult one. On the other hand, the need for conservatism in her investments is paramount. A division of her fund about equally between United States bonds and first-grade common stocks is a compromise between these objectives and corresponds to our general prescription for the defensive investor. The stock component may be placed as high as 75% if the investor is psychologically prepared for this decision, and if she can be almost certain she is not buying at too high a level. Assuredly this is not the case in early 1972. We do not preclude the possibility that the widow may qualify as an enterprising investor, in which case her objectives and methods will be quite different. The one thing the widow must not do is to take speculative chances in order to make some extra income. By this we mean trying for profits or high income without the necessary equipment to warrant full confidence in overall success. It would be far better for her to draw $2,000 per year out of her principal, in order to make both ends meet, than to risk half of it in poorly grounded, and therefore speculative, ventures. The prosperous doctor has none of the widow's pressures and compulsions, yet we believe that his choices are pretty much the same. Is he willing to take a serious interest in the business of investment? If he lacks the impulse or the flair, he will do best to update Graham's figures, take each dollar amount in this section and multiply it by 5. Accept the easy role of the defensive investor. The division of his portfolio should then be no different from that of the typical widow, and there would be the same area of personal choice in fixing the size of the stock component. The annual savings should be invested in about the same proportions as the total fund. The average doctor may be more likely than the average widow to elect to become an enterprising investor, and he is perhaps more likely to succeed in the undertaking. He has one important handicap, however, the fact that he has less time available to give to his investment education and to the administration of his funds. In fact, medical men have been notoriously unsuccessful in their security dealings. The reason for this is that they usually have an ample confidence in their own intelligence and a strong desire to make a good return on their money, without the realization that to do so successfully requires both considerable attention to the matter and something of a professional approach to security values. Finally, the young man who saves $1,000 a year and expects to do better gradually finds himself with the same choices, though for still different reasons. Some of his savings should go automatically into Series E bonds. The balance is so modest that it seems hardly worthwhile for him to undergo a tough educational and temperamental discipline in order to qualify as an aggressive investor. Thus a simple resort to our standard program for the Defensive investor would be at once the easiest and the most logical policy. Let us not ignore human nature at this point. Finance has a fascination for many bright young people with limited means. They would like to be both intelligent and enterprising in the placement of their savings, even though investment income is much less important to them than their salaries. This attitude is all to the good. There is a great advantage for the young capitalist to begin his financial education and experience early. If he is going to operate as an aggressive investor, he is certain to make some mistakes and to take some losses. Youth can stand these disappointments and profit by them. We urge the beginner in security buying not to waste his efforts and his money in trying to beat the market. Let him study security values and initially test out his judgment on price versus value with the smallest possible sums. Thus we return to the statement, made at the outset, that the defensive investor and common stocks kind of securities to be purchased and the rate of return to be sought depend not on the investor's financial resources but on his financial equipment in terms of knowledge, experience, and temperament. Note on the concept of risk. It is conventional to speak of good bonds as less risky than good preferred stocks and of the latter as less risky than good common stocks. From this was derived the popular prejudice against common stocks because they are not safe, which was demonstrated in the Federal Reserve Board survey of 1948. We should like to point out that the words risk and safety are applied to securities in two different senses, with a resultant confusion in thought. A bond is clearly proved unsafe when it defaults its interest or principal payments. Similarly, if a preferred stock or even a common stock is bought with the expectation that a given rate of dividend will be continued, then a reduction or passing of the dividend means that it has proved unsafe. It is also true that an investment contains a risk if there is a fair possibility that the holder may have to sell at a time when the price is well below cost. Nevertheless, the idea of risk is often extended to apply to a possible decline in the price of a security, even though the decline may be of a cyclical and temporary nature and even though the holder is unlikely to be forced to sell at such times. These chances are present in all securities, other than United States savings bonds, and to a greater extent in the general run of common stocks than in senior issues as a class. But we believe that what is here involved is not a true risk in the useful sense of the term. The man who holds a mortgage on a building might have to take a substantial loss if he were forced to sell it at an unfavorable time. That element is not taken into account in judging the safety or risk of ordinary real estate mortgages, the only criterion being the certainty of punctual payments. In the same way, the risk attached to an ordinary commercial business is measured by the chance of its losing money, not by what would happen if the owner were forced to sell. In Chapter 8 we shall set forth our conviction that the bona fide investor does not lose money merely because the market price of his holdings declines, hence the fact that a decline may occur does not mean that he is running a true risk of loss. If a group of well-selected common stock investments shows a satisfactory overall return, as measured through a fair number of years, then this group investment has proved to be safe. During that period its market value is bound to fluctuate, and as likely as not it will sell for a while under the buyer's cost. If that fact makes the investment risky, it would then have to be called both risky and safe at the same time. This confusion may be avoided if we apply the concept of risk solely to a loss of value which either is realized through actual sale, or is caused by a significant deterioration in the company's position or, more frequently perhaps, is the result of the payment of an excessive price in relation to the intrinsic worth of the security. Point 2. Many common stocks do involve risks of such deterioration. But It is our thesis that a properly executed group investment in common stocks does not carry any substantial risk of this sort, and that, therefore, it should not be termed risky merely because of the element of price fluctuation. But such risk is present if there is danger that the price may prove to have been clearly too high by intrinsic value standards, even if any subsequent severe market decline may be recouped many years later. Note on the category of large, prominent, and conservatively financed corporations. The quoted phrase in our caption was used earlier in the chapter to describe the kind of common stocks to which defensive investors should limit their purchases, provided also that they had paid continuous dividends for a considerable number of years. A criterion based on adjectives is always ambiguous. Where is the dividing line for size, for prominence, and for conservatism of financial structure? On the last point we can suggest a specific standard that, though arbitrary, is in line with accepted thinking. In industrial companies, finances are not conservative unless the common stock, at book value, represents at least half of the total capitalization, including all bank debt. 3 For a railroad or public utility, the figure should be at least 30%. The words large and prominent carry the notion of substantial size combined with a leading position in the industry. Such, the defensive investor and common stocks companies are often referred to as primary, all other common stocks are then called secondary, except that growth stocks are ordinarily placed in a separate class by those who buy them as such. To supply an element of concreteness here, let us suggest that, to be large in present-day terms, a company should have $50 million of assets or do $50 million of business. Again, to be prominent, a company should rank among the first quarter or first third in size within its industry group. It would be foolish, however, to insist upon such arbitrary criteria. They are offered merely as guides to those who may ask for guidance. But any rule which the investor may set for himself and which does no violence to the common sense meanings of large and prominent should be acceptable. By the very nature of the case, there must be a large group of companies that some will and others will not include among those suitable for defensive investment. There is no harm in such diversity of opinion and action. In fact, it has a salutary effect upon stock market conditions, because it permits a gradual differentiation or transition between the categories of primary and secondary stock issues. In today's markets, to be considered large, a company should have a total stock value, or market capitalization, of at least $10 billion. According to the online stock screener at http://screen.yahoo.com, that gave you roughly 300 stocks to choose from as of early 2003. Commentary on Chapter 5. Human felicity is product not so much by great pieces of good fortune that seldom happen, as by little advantages that occur every day. A. Benjamin Franklin. The best defense is a good offense. After the stock market bloodbath of the past few years, why would any defensive investor put a dime into stocks? First, remember Graham's insistence that how defensive you should be depends less on your tolerance for risk than on your willingness to put time and energy into your portfolio. And if you go about it the right way, investing in stocks is just as easy as parking your money in bonds and cash. As we'll see in Chapter 9, you can buy a stock market index fund with no more effort than it takes to get dressed in the morning. Amidst the bear market that began in 2000, it's understandable if you feel burned, and if, in turn, that feeling makes you determined never to buy another stock again. As an old Turkish proverb says, after you burn your mouth on hot milk, you blow on your yogurt. Because the crash of 2000-2002 was so terrible, many investors now view stocks as scaldingly risky, but, paradoxically, the very act of crashing has taken much of the risk out of the stock market. It was hot milk before, but it is room temperature yogurt now. Viewed logically, the decision of whether to own stocks today has nothing to do with how much money you might have lost by owning them a few years ago. When stocks are priced reasonably enough to give you future growth, then you should own them, regardless of the losses they may have cost you in the recent past. That's all the more true when bond yields are low, reducing the future returns on income-producing investments. Commentary on Chapter 5. As we have seen in Chapter 3, stocks are, as of early 2003, only mildly overpriced by historical standards. Meanwhile, at recent prices, bonds offer such low yields that an investor who buys them for their supposed safety is like a smoker who thinks he can protect himself against lung cancer by smoking low-tar cigarettes. No matter how defensive an investor you are in Graham's sense of low maintenance, or in the contemporary sense of low risk at today's values, mean that you must keep at least some of your money in stocks. Fortunately, it's never been easier for a defensive investor to buy stocks. And a permanent autopilot portfolio, which effortlessly puts a little bit of your money to work every month in predetermined investments, can defend you against the need to dedicate a large part of your life to stock picking. Should you buy what you know? But first, let's look at something the defensive investor must always defend against: the belief that you can pick stocks without doing any homework. In the 1980s and early 1990s, one of the most popular investing slogans was "Buy what you know." Peter Lynch, who from 1977 through 1990 piloted Fidelity Magellan to the best track record ever compiled by a mutual fund, was the most charismatic preacher of this gospel. Lynch argued that amateur investors have an advantage that professional investors have forgotten how to use: the power of common knowledge. If you discover a great new restaurant, car, toothpaste, or jeans, or if you notice that the parking lot at a nearby business is always full, or that people are still working at a company's headquarters long after Jay Leno goes off the air, then you have a personal insight into a stock that a professional analyst or portfolio manager might never pick up on. As Lynch put it, during a lifetime of buying cars or cameras, you develop a sense of what's good and what's bad, what sells and what doesn't, and the most important part is, you know it before Wall Street knows it. 1. Lynch's rule: you can outperform the experts if you use your edge by investing in companies or industries you already understand. Isn't Peter Lynch with John Rothschild, One Up on Wall Street, Penguin, 1989. p. 23. Commentary on Chapter 5. Totally implausible, and thousands of investors have profited from it over the years. But Lynch's rule can work only if you follow its corollary as well. Finding the promising company is only the first step. The next step is doing the research. To his credit, Lynch insists that no one should ever invest in a company, no matter how great its products or how crowded its parking lot, without studying its financial statements and estimating its business value. Unfortunately, most stock buyers have ignored that part. Barbara Streisand, the day trading diva, personified the way people abuse Lynch's teachings. In 1999 she burbled, "We go to Starbucks every day, so I buy Starbucks stock." But the funny girl forgot that no matter how much you love those tall skinny lats, you still have to analyze Starbucks's financial statements and make sure the stock isn't even more overpriced than the coffee. Countless stock buyers made the same mistake by loading up on shares of Amazon.com because they loved the website, or buying E*trade stock because it was their own online broker. Experts gave the idea credence too. In an interview televised on CNN in late 1999, portfolio manager Kevin Landis of the First Hand Funds was asked plaintively, "How do you do it? Why can't I do it?" Kevin. From 1995 through the end of 1999, the First Hand Technology Value Fund produced an astounding 58.2% average annualized gain. "Well, you can do it," Landis chirped. "All you really need to do is focus on the things that you know, and stay close to an industry, and talk to people who work in it every day." 2. The most painful perversion of Lynch's rule occurred in corporate retirement plans. If you're supposed to buy what you know, then what could possibly be a better investment for your 401k than your own company's stock? After all, you work there, don't you know more about the company than an outsider ever could? Sadly, the employees. Kevin Landis interview on CNN in the Money, November 5, 1999, 11 a.m. Eastern Standard Time. If Landis's own record is any indication, focusing on the things that you know is not all you really need to do to pick stocks successfully. From the end of 1999 through the end of 2002, Landis's fund, full of technology companies that he claimed to know firsthand from his base in Silicon Valley, lost 73.2% of its value, and even worse pounding than the average technology fund suffered over that period. Commentary on Chapter 5 of Enron, Global Crossing, and WorldCom, many of whom put nearly all their retirement assets in their own company's stock, only to be wiped out. Learned that insiders often possess only the illusion of knowledge, not the real thing. Psychologists led by Barak Fischhoff of Carnegie Mellon University have documented a disturbing fact: becoming more familiar with a subject does not significantly reduce people's tendency to exaggerate how much they actually know about it. Point 3. That's why investing in what you know can be so dangerous. The more you know going in, the less likely you are to probe a stock for weaknesses. This pernicious form of overconfidence is called home bias, or the habit of sticking to what is already familiar. Individual investors own 3 times more shares in their local phone company than in all other phone companies combined. The typical mutual fund owns stocks whose headquarters are 115 miles closer to the fund's main office than the average U.S. company is. 401k investors keep between 25% and 30% of their retirement assets in the stock of their own company. Point 4. In short, familiarity breeds complacency. On the TV news, isn't it always the neighbor or the best friend or the parent of the criminal who says in a shocked voice, "He was such a nice guy"? That's because whenever we are too close to someone or something, we take our beliefs for granted, instead of questioning them as we do when we confront something more remote. The more familiar a stock is, the more likely it is to turn a defensive investor into a lazy one who thinks there's no need to do any homework. Don't let that happen to you. Commentary on Chapter 5. Can you roll your own? Fortunately, for a defensive investor who is willing to do the required homework for assembling a stock portfolio, this is the golden age. Never before in financial history has owning stocks been so cheap and convenient. Point 5. Do it yourself. Through specialized online brokerages like www.sharebuilder.com, www.foliofn.com, and www.buyandhold.com, you can buy stocks automatically even if you have very little cash to spare. These websites charge as little as $4 for each periodic purchase of any of the thousands of U.S. stocks they make available. You can invest every week or every month, reinvest the dividends, and even trickle your money into stocks through electronic withdrawals from your bank account or direct deposit from your paycheck. Share Builder charges more to sell than to buy, reminding you, like a little whack across the nose with a rolled up newspaper, that rapid selling isn't investing. No, while Folio FN offers an excellent tax tracking tool. Unlike traditional brokers or mutual funds that won't let you in the door for less than $2,000 or $3,000, these online firms have no minimum account balances and are tailor-made for beginning investors who want to put fledgling portfolios on autopilot. To be sure, a transaction fee of $4 takes a monstrous 8% bite out of a $50 monthly investment, but if that's all the money you can spare, then these micro-investing sites are the only game in town for building a diversified portfolio. You can also buy individual stocks straight from the issuing companies. In 1994, the U.S. Securities and Exchange Commission loosened the handcuffs it had long ago clamped onto the direct sale of stocks to the public. Hundreds of companies responded by creating internet-based programs allowing investors to buy shares without going through a broker. Some helpful online sources of information on buying stocks directly include www.dripcentral.com, www.netstockdirect.com, an affiliate of ShareBuilder, and www.stockpower.com. According to finance professor Charles Jones of Columbia Business School, the cost of a small, one-way trade, either a buy or a sell, in a New York Stock Exchange-listed stock dropped from about 1.25% in Graham's day to about 0.25% in 2000. For institutions like mutual funds, those costs are actually higher. See Charles M. Jones, A Century of Stock Market Liquidity and Trading Costs, at http://papers.ssrn.com. Commentary on Chapter 5. You may often incur a variety of nuisance fees that can exceed $25 per year. Even so, direct stock purchase programs are usually cheaper than stockbrokers. Be warned, however, that buying stocks in tiny increments for years on end can set off big tax headaches. If you are not prepared to keep a permanent and exhaustively detailed record of your purchases, do not buy in the first place. Finally, don't invest in only one stock or even just a handful of different stocks. Unless you are not willing to spread your bets, you shouldn't bet at all. Graham's guideline of owning between 10 and 30 stocks remains a good starting point for investors who want to pick their own stocks, but you must make sure that you are not overexposed to one industry. 6. For more on how to pick the individual stocks that will make up your portfolio, see pages 114a-115 and chapters 11, 14, and 15. If, after you set up such an online autopilot portfolio, you find yourself trading more than twice a year or spending more than an hour or two per month, total, on your investments, then something has gone badly wrong. Do not let the ease and up-to-the-minute feel of the internet seduce you into becoming a speculator. A defensive investor runs and wins the race by sitting still. Get some help. A defensive investor can also own stocks through a discount broker, a financial planner, or a full-service stockbroker. At a discount brokerage, you'll need to do most of the stock-picking work yourself. Graham's guidelines will help you create a core portfolio requiring minimal maintenance and offering maximal odds of a steady return. On the other hand, if you cannot spare the time or summon the interest to do it yourself, there's no reason to feel any shame in hiring someone to pick stocks or mutual funds for you. But there's one responsibility that you must never delegate. You, and no one but you, must investigate, before you hand over your money, whether an advisor is trustworthy and charges reasonable fees. For more pointers, See Chapter 10. Farm it out. Mutual funds are the ultimate way for a defensive investor to capture the upside of stock ownership without the down. To help determine whether the stocks you own are sufficiently diversified across different industrial sectors, you can use the free Instant X-ray function at www.morningstar.com or consult the Sector Information, Global Industry Classification Standard, at www.standardandpoors.com. Commentary on Chapter 5. Side of having to police your own portfolio. At relatively low cost, you can buy a high degree of diversification and convenience, letting a professional pick and watch the stocks for you in their finest form. Index portfolios. Mutual funds can require virtually no monitoring or maintenance whatsoever. Index funds are a kind of Rip Van Winkle investment that is highly unlikely to cause any suffering or surprises. Even if, like Washington Irving's lazy farmer, you fall asleep for 20 years. They are a defensive investor's dream come true. For more detail, see Chapter 9. Filling in the potholes. As the financial markets heave and crash their way up and down day after day, the defensive investor can take control of the chaos. Your very refusal to be active, your renunciation of any pretended ability to predict the future, can become your most powerful weapons. By putting every investment decision on autopilot, you drop any self-delusion that you know where stocks are headed, and you take away the market's power to upset you no matter how bizarrely it bounces. As Graham notes, dollar cost averaging enables you to put a fixed amount of money into an investment at regular intervals. Every week, month, or calendar quarter, you buy more whether the markets have gone, or are about to go, up, down, or sideways. Any major mutual fund company or brokerage firm can automatically and safely transfer the money electronically for you, so you never have to write a check or feel the conscious pang of payment. It's all out of sight, out of mind. The ideal way to dollar cost average is into a portfolio of index funds, which own every stock or bond worth having. That way, you renounce not only the guessing game of where the market is going, but which sectors of the market and which particular stocks or bonds within thema will do the best. Let's say you can spare $500 a month by owning and dollar cost averaging into just 3 index funds, $300 into one that holds the total US stock market, $100 into one that holds foreign stocks, and $100 into one that holds US bonds, so you can ensure that you own almost every investment on the planet that's worth owning. 7 every. For more on the rationale for keeping a portion of your portfolio in foreign stocks, see pages 186a-187. Commentary on Chapter 5. Month, like clockwork, you buy more. If the market has dropped, your preset amount goes further, buying you more shares than the month before. If the market has gone up, then your money buys you fewer shares. By putting your portfolio on permanent autopilot this way, you prevent yourself from either flinging money at the market just when it seems most alluring, and is actually most dangerous, or refusing to buy more after a market crash has made investments truly cheaper, but seemingly more risky. According to Ibbotson Associates, the leading financial research firm, if you had invested $12,000 in the Standard & Poor's 500 stock index at the beginning of September 1929, 10 years later you would have had only $7,223 left. But if you had started with a paltry $100, and simply invested another $100 every single month, then by August 1939, your money would have grown to $15,571. That's the power of disciplined buying even in the face of the Great Depression and the worst bear market of all time. Point 8. Figure 5:1 shows the magic of dollar cost averaging in a more recent bear market. Best of all, once you build a permanent autopilot portfolio with index funds as its heart and core, you'll be able to answer every market question with the most powerful response a defensive investor could ever have: I don't know and I don't care. If someone asks whether bonds will outperform stocks, just answer, I don't know and I don't care. After all, you're automatically buying both. Will healthcare stocks make high-tech stocks look sick? I don't know and I don't care. You're a permanent owner of both. What's the next Microsoft? I don't know and I don't care. As soon as it's big enough to own, your index fund will have it, and you'll go along for the ride. Will foreign stocks beat US stocks next year? I don't know and I don't care. If they do, you'll capture that gain. If they don't, you'll get to buy more at lower prices. By enabling you to say I don't know and I don't care, a permanent autopilot portfolio liberates you from the feeling that you need to forecast what the financial markets are about to do and the illusion that source, spreadsheet data provided courtesy of Ibbotson Associates. Although it was not possible for retail investors to buy the entire S&P 500 index until 1976, the example nevertheless proves the power of buying more when stock prices go down. Commentary on Chapter 5. Every little bit helps. Cumulative value of $100 invested monthly in Vanguard 500 Index Fund. Monthly closing price, Standard & Poor's 500 Stock Index. From the end of 1999 through the end of 2002, the S&P 500 stock average fell relentlessly. But if you had opened an index fund account with a $3,000 minimum investment and added $100 every month, your total outlay of $6,600 would have lost 30.2%, considerably less than the 41.3% plunge in the market. Better yet, your steady buying at lower prices would build the base for an explosive recovery when the market rebounds. Source: The Vanguard Group. Anyone else can. The knowledge of how little you can know about the future, coupled with the acceptance of your ignorance, is a defensive investor's most powerful weapon. Chapter 6. Portfolio Policy for the Enterprising Investor, Negative Approach. The aggressive investor should start from the same base as the defensive investor, namely, a division of his funds between high-grade bonds and high-grade common stocks bought at reasonable prices. He will be prepared to branch out into other kinds of security commitments, but in each case he will want a well-reasoned justification for the departure. There is a difficulty in discussing this topic in orderly fashion, because there is no single or ideal pattern for aggressive operations. The field of choice is wide. The selection should depend not only on the individual's competence and equipment but perhaps equally well upon his interests and preferences. The most useful generalizations for the enterprising investor are of a negative sort. Let him leave high-grade preferred stocks to corporate buyers. Let him also avoid inferior types of bonds and preferred stocks unless they can be bought at bargain levels, which means ordinarily at prices at least 30% under par for high coupon. Here Graham has made a slip of the tongue. After insisting in Chapter 1 that the definition of an enterprising investor depends not on the amount of risk you seek, but the amount of work you are willing to put in, Graham falls back on the conventional notion that enterprising investors are more aggressive. The rest of the chapter, however, makes clear that Graham stands by his original definition. The great British economist John Maynard Keynes appears to have been the first to use the term enterprise as a synonym for analytical investment issues, and much less for the lower coupons. He will let someone else buy foreign government bond issues, even though the yield may be attractive. He will also be wary of all kinds of new issues, including convertible bonds and preferreds that seem quite tempting, and common stocks with excellent earnings confined to the recent past. For standard bond investments, the aggressive investor would do well to follow the pattern suggested to his defensive confrere, and make his choice between high-grade taxable issues, which can now be selected to yield about 7.18%, and good quality tax-free bonds, which yield up to 5.30% on longer maturities. Second-grade bonds and preferred stocks. Since in late 1971 it is possible to find first-rate corporate bonds to yield 7.18%, and even more, it would not make much sense to buy second-grade issues merely for the higher return they offer. In fact, corporations with relatively poor credit standing have found it virtually impossible to sell straight bonds, i.e., non-convertible SO, to the public in the past 2 years. Hence their debt financing has been done by the sale of convertible bonds, or bonds with warrants attached, which place them in a separate category. It follows that virtually all the non-convertible bonds of inferior rating represent older issues which are selling at a large discount. Thus they offer the possibility of a substantial gain in principal value under favorable future conditions, which would mean here a combination of an improved credit rating for the company and lower general interest rates. Asterisk high coupon issues are corporate bonds paying above average interest rates, in today's markets, at least 8%, or preferred stocks paying large dividend yields, 10% or more. If a company must pay high rates of interest in order to borrow money, that is a fundamental signal that it is risky. For more on high yield or junk bonds, see pages 145a-147. As of early 2003, the equivalent yields are roughly 5.1% on high-grade corporate bonds and 4.7% on 20-year tax-free municipal bonds. To update these yields, see www.bondsonline.com/asp/news/composites/html or www.bloomberg.com/markets/rates.html and www.bloomberg.com/markets. Samuni.html. Portfolio policy for the enterprising investor, negative approach. But even in the matter of price discounts and resultant chance of principal gain, the second-grade bonds are in competition with better issues. Some of the well-entrenched obligations with old-style coupon rates, 2.5% to 4%, sold at about 50 cents on the dollar in 1970. Examples: American Telephone and Telegraph 25A8S, due 1986. Sold at 51, Atchison Topeka and Santa FERR4s, due 1995, sold at 51. McGraw-Hill 3.87S, due 1992, sold at 50.5. Hence, under conditions of late 1971, the enterprising investors can probably get from good grade bonds selling at a large discount all that he should reasonably desire in the form of both income and chance of appreciation. Throughout this book we refer to the possibility that any well-defined and protracted market situation of the past may return in the future. Hence we should consider what policy the aggressive investor might have to choose in the bond field if prices and yields of high-grade issues should return to former normals. For this reason we shall reprint here our observations on that point made in the 1965 edition, when high-grade bonds yielded only 4.5%. Something should be said now about investing in second-grade issues, which can readily be found to yield any specified return up to 8% or more. The main difference between first and second-grade bonds is usually found in the number of times the interest charges have been covered by earnings. Example: in early 1964, Chicago, Milwaukee, St. Paul, and Pacific 5% income debenture bonds, at 68, yielded 7.35%. But the total interest charges of the road, before income taxes, were earned only 1.5 times in 1963. Against our requirement of 5 times for a well-protected railroad. Issue point 1. Many investors buy securities of this kind because they need income and cannot get along with the meager return offered by top-grade issues. Experience clearly shows that it is unwise to buy a bond or a preferred which lacks adequate safety merely because the yield is attractive. Here the word merely implies that the issue is not selling at a large discount and thus does not offer an opportunity for a substantial gain in principal value. Where such securities are bought at full price, so that is, not many points under. For a recent example that painfully reinforces Graham's point, CP 146. Below 100 *A, the chances are very great that at some future time the holder will see much lower quotations. For when bad business comes, or just a bad market, issues of this kind prove highly susceptible to severe sinking spells. Often interest or dividends are suspended or at least endangered, and frequently there is a pronounced price weakness even though the operating results are not at all bad. As a specific illustration of this characteristic of second quality senior issues, let us summarize the price behavior of a group of 10 railroad income bonds in 1946-47. These comprise all of those which sold at 96 or more in 1946, their high prices averaging 102.5. By the following year the group had registered low prices averaging only 68, a loss of 1/3 of the market value in a very short time. Peculiarly enough, the railroads of the country were showing much better earnings in 1947 than in 1946, hence the drastic price decline ran counter to the business picture and was a reflection of the sell-off in the general market. But it should be pointed out that the shrinkage in these income bonds was proportionately larger than that in the common stocks in the Dow Jones Industrial List. About 23%. Obviously the purchaser of these bonds at a cost above 100 could not have expected to participate to any extent in a further rise in the securities market. The only attractive feature was the income yield, averaging about 4.25%, against 2.50% for first-grade bonds, an advantage of 1.75% in annual income. Yet the sequel showed all too soon and too plainly that for the minor advantage in annual income the buyer of these second-grade bonds was risking the loss of a substantial part of his principal. The above example permits us to pay our respects to the popular fallacy that goes under the sobriquet of a businessman's investment. That involves the purchase of a security showing a larger yield than is obtainable on a high-grade issue and carrying a correspondingly greater risk. It is bad business to accept an asterisk bond prices are quoted in percentages of par value, or 100. A bond priced at 85 is selling at 85% of its principal value. A bond originally offered for $10,000, but now selling at 85, will cost $8,500. When bonds sell below 100, they are called discount bonds. Above 100, they become premium bonds. Portfolio policy for the enterprising investor, negative approach. Acknowledged possibility of a loss of principal in exchange for a mere 1 or 2% of additional yearly income. If you are willing to assume some risk, you should be certain that you can realize a really substantial gain in principal value if things go well. Hence a second-grade 5.5 or 6% bond selling at par is almost always a bad purchase. The same issue at 70 might make more sense, and if you are patient you will probably be able to buy it at that level. Second-grade bonds and preferred stocks possess two contradictory attributes which the intelligent investor must bear clearly in mind. Nearly all suffer severe sinking spells in bad markets. On the other hand, a large proportion recover their position when favorable conditions return, and these ultimately work out all right. This is true even of cumulative preferred stocks that fail to pay dividends for many years. There were a number of such issues. In the early 1940s, as a consequence of the long depression of the 1930s during the post-war boom period of 1945–1947, many of these large accumulations were paid off either in cash or in new securities, and the principal was often discharged as well. As a result, large profits were made by people who, a few years previously, had bought these issues when they were friendless and sold at low prices. Point 2. It may well be true that, in an overall accounting, the higher yields obtainable on second-grade senior issues will prove to have offset those principal losses that were irrecoverable. In other words, an investor who bought all such issues at their offering prices might conceivably fare as well, in the long run, as one who limited himself to first-quality securities, or even somewhat better. Point 3. But for practical purposes the question is largely irrelevant. Regardless of the outcome, the buyer of second-grade issues at full prices will be worried and discommoded when their price declines precipitately. Furthermore, he cannot buy enough issues to assure an average result, nor is he in a position to set aside a portion of his larger income to offset or amortize those principal losses, which prove to be permanent. Finally, it is mere common sense to abstain from buying securities at around 100 if long experience indicates that they can probably be bought at 70 or less in the next weak market. Foreign government bonds. All investors with even small experience know that foreign bonds, as a whole, have had a bad investment history since 1914. This was inevitable in the light of two world wars and an intervening world depression of unexampled depth. Yet every few years, market conditions are sufficiently favorable to permit the sale of some new foreign issues at a price of about par. This phenomenon tells us a good deal about the working of the average investors minda, and not only in the field of bonds. We have no concrete reason to be concerned about the future history of well-regarded foreign bonds such as those of Australia or Norway. But we do know that, if and when trouble should come, the owner of foreign obligations has no legal or other means of enforcing his claim. Those who bought Republic of Cuba 4.5s as high as 117 in 1953 saw them default their interest and then sell as low as 20 cents on the dollar in 1963. The New York Stock Exchange bond list in that year also included Belgian Congo 51A4s at 36, Greek 7s at 30, and various issues of Poland as low as 7. How many readers have any idea of the repeated vicissitudes of the 8% bonds of Czechoslovakia, since they were first offered in this country in 1922 at 96.5. They advanced to 112 in 1928, declined to 673A4 in 1932, recovered to 106 in 1936, collapsed to 6 in 1939, recovered unbelievably to 117 in 1946, fell promptly to 35 in 1948, and sold as low as 8 in 1970. Years ago an argument of sorts was made for the purchase of foreign bonds here on the grounds that a rich creditor nation such as ours was under moral obligation to lend abroad. Time, which brings so many revenges, now finds us dealing with an intractable balance of payments problem of our own, part of which is ascribable to the large-scale purchase of foreign bonds by American investors seeking a small advantage in yield. For many years past, we have questioned the inherent attractiveness of such investments from the standpoint of the buyer. Perhaps we should add, now, that the latter would benefit both his country and himself if he declined these opportunities. Portfolio policy for the enterprising investor, negative approach. New issues generally. It might seem ill-advised to attempt any broad statements about new issues as a class, since they cover the widest possible range of quality and attractiveness. Certainly there will be exceptions to any suggested rule. Our one recommendation is that all investors should be wary of new issue ESA, which means, simply, that these should be subjected to careful examination and unusually severe tests before they are purchased. There are two reasons for this double caveat. The first is that new issues have special salesmanship behind them, which calls, therefore, for a special degree of sales resistance. The second is that most new issues are sold under favorable market conditions, which means favorable for the seller and consequently less favorable for the buyer. The effect of these considerations becomes steadily more important as we go down the scale from the highest quality bonds through second-grade senior issues to common stock flotations at the bottom. A tremendous amount of financing, consisting of the repayment of existing bonds at call price and their replacement by new issues with lower coupons, was done in the past. Most of this was in the category of high-grade bonds and preferred stocks. The buyers were largely financial institutions, amply qualified to protect their interests. Hence these offerings were carefully priced to new issues of common stock. Initial public offerings, or IPSA, normally are sold with an underwriting discount, a built-in commission, of 7%. By contrast, the buyer's commission on older shares of common stock typically ranges below 4%. Whenever Wall Street makes roughly twice as much for selling something new as it does for selling something old, the new will get the harder sell. Recently, finance professors Owen Lamont of the University of Chicago and Paul Schultz of the University of Notre Dame have shown that corporations choose to offer new shares to the public when the stock market is near a peak. For technical discussion of these issues, see Lamont's Evaluating Value Weighting, Corporate Events and Market Timing, and Schultz's Pseudo-Market Timing and the Long-Run Performance of IPOs at http://papers.ssrn.com. Meet the going rate for comparable issues, and high-powered salesmanship had little effect on the outcome. As interest rates fell lower and lower, the buyers finally came to pay too high a price for these issues, and many of them later declined appreciably in the market. This is one aspect of the general tendency to sell new securities of all types when conditions are most favorable to the issuer. But in the case of first-quality issues, the ill effects to the purchaser are likely to be unpleasant rather than serious. The situation proves somewhat different when we study the lower-grade bonds and preferred stocks sold during the 1945-46 and 1960-61 periods. Here the effect of the selling effort is more apparent, because most of these issues were probably placed with individual and inexpert investors. It was characteristic of these offerings that they did not make an adequate showing when judged by the performance of the companies over a sufficient number of years. They did look safe enough, for the most part, if it could be assumed that the recent earnings would continue without a serious setback. The investment bankers who brought out these issues presumably accepted this assumption, and their salesmen had little difficulty in persuading themselves and their customers to a like effect. Nevertheless, it was an unsound approach to investment, and one likely to prove costly. Bull market periods are usually characterized by the transformation of a large number of privately owned businesses into companies with quoted shares. This was the case in 1945-46 and again, beginning in 1960. The process then reached extraordinary proportions until brought to a catastrophic close in May 1962. After the usual swearing-off period of several years, the whole tragicomedy was repeated, step by step, in 1967-1969 ****. In the 2 years from June 1960, through May 1962, more than 850 companies sold their stock to the public for the first time, an average of more than one per day. In late 1967 the IPO market heated up again. In 1969 an astonishing 781 new stocks were born. That oversupply helped create the bear markets of 1969 and 1973-1974. In 1974 the IPO market was so dead that only 9 new stocks were created all year. 1975 saw only 14 stocks born. That undersupply, in turn, helped feed the bull market of the 1980s, when roughly 4,000 new stocks flooded the market, helping to trigger the portfolio policy for the enterprising investor, negative approach. New common stock offerings. The following paragraphs are reproduced unchanged from the 1959 edition, with comment added. Common stock financing takes 2 different forms. In the case of companies already listed, additional shares are offered pro rata to the existing stockholders. The subscription price is set below the current market, and the rights to subscribe have an initial money value ***. The sale of the new shares is almost always underwritten by one or more investment banking houses, but it is the general hope and expectation that all the new shares will be taken by the exercise of the subscription rights. Thus the sale of additional common stock of listed companies does not ordinarily call for active selling effort on the part of distributing firms. The second type is the placement with the public of common stock of what were formerly privately owned enterprises. Most of this stock is sold for the account of the controlling interests to enable them to cash in on a favorable market and to diversify their enthusiasm that led to the 1987 crash. Then the cycle swung the other way again as IPOs dried up in 1988-1990. That shortage contributed to the bull market of the 1990 SA and, right on cue, Wall Street got back into the business of creating new stocks, cranking out nearly 5,000 IPOs. Then, after the bubble burst in 2000, only 88 IPOs were issued in 2001, the lowest annual total since 1979. In every case, the public has gotten burned on IPOs, has stayed away for at least 2 years, but has always returned for another scalding. For as long as stock markets have existed, investors have gone through this manic depressive cycle. In America's first great IPO boom, back in 1825, a man was said to have been squeezed to death in the stampede of speculators trying to buy shares in the new Bank of Southwark. The wealthiest buyers hired thugs to punch their way to the front of the line. Sure enough, by 1829, stocks had lost roughly 25% of their value. Here Graham is describing rights offerings, in which investors who already own a stock are asked to pony up even more money to maintain the same proportional interest in the company. This form of financing, still widespread in Europe, has become rare in the United States, except among closed-end funds. Own finances. When new money is raised for the business, it comes often via the sale of preferred stock, as previously noted. This activity follows a well-defined pattern, which by the nature of the security markets must bring many losses and disappointments to the public. The dangers arise both from the character of the businesses that are thus financed and from the market conditions that make the financing possible. In the early part of the century, a large proportion of our leading companies were introduced to public trading. As time went on, the number of enterprises of first rank that remained closely held steadily diminished, hence original common stock flotations have tended to be concentrated more and more on relatively small concerns. By an unfortunate correlation, during the same period the stock buying public has been developing an ingrained preference for the major companies and a similar prejudice against the minor ones. This prejudice, like many others, tends to become weaker as bull markets are built up. The large and quick profits shown by common stocks as a whole are sufficient to dull the public's critical faculty, just as they sharpen its acquisitive instinct. During these periods, also, quite a number of privately owned concerns can be found that are enjoying excellent results, although most of these would not present too impressive a record if the figures were carried back, say, 10 years or more. When these factors are put together, the following consequences emerge. Somewhere in the middle of the bull market, the first common stock flotations make their appearance. These are priced not unattractively, and some large profits are made by the buyers of the early issues. As the market rise continues, this brand of financing grows more frequent, the quality of the companies becomes steadily poorer, the prices asked and obtained verge on the exorbitant. 1. Fairly dependable sign of the approaching end of a bull swing is the fact that new common stocks of small and nondescript companies are offered at prices somewhat higher than the current level for many medium-sized companies with a long market history. It should be added that very little of this common stock financing is ordinarily done by banking houses of prime size and reputation. Asterisk in Graham's day, the most prestigious investment banks generally steered clear of the IPO business, which was regarded as an undignified portfolio policy for the enterprising investor. Negative approach. The heedlessness of the public and the willingness of selling organizations to sell whatever may be profitably sold can have only one result: a price collapse. In many cases the new issues lose 75% and more of their offering price. The situation is worsened by the aforementioned fact that, at bottom, the public has a real aversion to the very kind of small issue that it bought so readily in its careless moments. Many of these issues fall, proportionately, as much below their true value as they formerly sold above it. An elementary requirement for the intelligent investor is an ability to resist the blandishments of salesmen offering new common stock issues during bull markets. Even if one or two can be found that can pass severe tests of quality and value, it is probably bad policy to get mixed up in this sort of business. Of course, the salesman will point to many such issues which have had good-sized market advances, including some that go up spectacularly the very day they are sold. But all this is part of the speculative atmosphere. It is easy money. For every dollar you make in this way you will be lucky if you end up by losing only 2. Some of these issues may prove excellent buys a few years later, when nobody wants them and they can be had at a small fraction of their true worth. In the 1965 edition we continued our discussion of this subject as follows. While the broader aspects of the stock market's behavior since 1949 have not lent themselves well to analysis based on long experience, the development of new common stock flotations proceeded exactly in accordance with ancient prescription. It is doubtful whether we ever before had so many new issues offered of such low quality, and with such extreme price collapses, as we should of naive investors. By the peak of the IPO boom in late 1999 and early 2000, however, Wall Street's biggest investment banks had jumped in with both feet. Venerable firms cast off their traditional prudence and behaved like drunken mud wrestlers, scrambling to foist ludicrously overvalued stocks on a desperately eager public. Graham's description of how the IPO process works is a classic that should be required reading in investment banking ethics classes, if there are any. Experienced in 1960–1962.4 The ability of the stock market as a whole to disengage itself rapidly from that disaster is indeed an extraordinary phenomenon, bringing back long-buried memories of the similar invulnerability it showed to the great Florida real estate collapse in 1925. Must there be a return of the new stock offering madness before the present bull market can come to its definitive close? Who knows? But we do know that an intelligent investor will not forget what happened in 1962 and will let others make the next batch of quick profits in this area and experience the consequent harrowing losses. We followed these paragraphs in the 1965 edition by citing a horrible example, namely, the sale of stock of Aetna Maintenance Co. at $9 in November 1961. In typical fashion the shares promptly advanced to $15, the next year they fell to 2.37, and in 1964 to 0.87. The later history of this company was on the extraordinary side, and illustrates some of the strange metamorphoses that have taken place in American business, great and small, in recent years. The curious reader will find the older and newer history of this enterprise in Appendix 5. It is by no means difficult to provide even more harrowing examples taken from the more recent version of the same old story, which covered the years 1967–1970. Nothing could be more pat to our purpose than the case of AAA Enterprises, which happens to be the first company then listed in Standard & Poor's stock guide. The shares were sold to the public at $14 in 1968, promptly advanced to 28, but in early 1971 were quoted at a dismal 25 cent. Even this price represented a gross overvaluation of the enterprise, since it had just entered the bankruptcy court in a hopeless condition. There is so much to be learned, and such important warnings to be gleaned, from the story of this flotation that we have reserved it for detailed treatment below, in Chapter 17. Commentary on Chapter 6. The punches you miss are the ones that wear you out. A boxing trainer Angelo Dundee. For the aggressive as well as the defensive investor, what you don't do is as important to your success as what you do. In this chapter, Graham lists his don'ts for aggressive investors. Here is a list for today.
If you are visiting Kidomelon for the first time, please click the subscribe button to get new video updates.